hurricanes Gustav and Ike, the catastrophe and individual risk segment reported significant profits of $776 million in relation to its $955 million premium volume. Profits included $224 million from a contract that would have required Berkshire to purchase up to $4 billion of revenue bonds issued by the Florida Hurricane Catastrophe Fund Finance Corporation under certain conditions. The entire premium went to the bottom line as the $25 billion threshold for losses wasn't met. The economics of the transaction were favorable to Berkshire since it represented a commitment to lend rather than coverage of losses. In effect, Berkshire was paid a 5.6% fee on the $4 billion commitment for incurring credit risk related to the fund and its participating insurance companies. The fund was willing to enter the transaction because of uncertainty in credit markets. The other multi-line segment benefited from a 5-year 20% quota share contract with Swiss Re, which increased premiums 50% to $3.9 billion. Underwriting profits swelled from $325 million in 2007 to $962 million in 2008, largely from a $930 million adjustment to its foreign-denominated liabilities. The worldwide turmoil in 2008 led to a significant strengthening of the dollar as it became a safe haven. In the turmoil of 2008, Ajit Jain found more opportunity for BHRG. At the end of 2007, BHRG formed Berkshire Hathaway Assurance Corporation, which wrote insurance on municipal bonds. This new entity, licensed in 49 states and seeded with $1 billion of capital, wrote $595 million in premium volume during 2008. Some of that was secondary insurance, where Berkshire was paid for taking on the risk of the primary insurer going broke. In 2008, Ajit and Berkshire were paid handsomely for their willingness to make calculated bets based only on logic while panic gripped almost every financial market. As Buffett put it, the investment world has gone from underpricing risk to overpricing it. Geico. Geico's operating results showed continued strength and growth. By allowing premiums per policy to fall, the company passed along more savings to its customers. This, combined with additional advertising expenditures, led to an 8.2% increase in voluntary auto policies in force, a 7.7% market share, and strong profits of $916 million on $12.5 billion of earned premiums. Berkshire Hathaway Primary Group. The primary group continued to produce consistent profits and float for Berkshire, even though volume and underwriting profits declined. Pre-tax underwriting profit fell 25% to $210 million on $1.95 billion of earned premiums, down 2.5%. Buffett assured the managers of the many companies in this group that he and Munger recognized and appreciated their contributions to Berkshire, even though Berkshire's other insurance dwarfed them in comparison. Regulated utility business. Berkshire's utilities, under the umbrella of Mid-American Energy Holdings, thrived in 2008. EBIT from its operating units grew 3% to $2 billion, and a large one-time gain swelled the bottom line. At Kern River, approved rate increases and stronger demand drove EBIT up 26%. Its Pacific Core and UK utilities units maintained steady earnings. Home services was the glaring exception to the general rule of stability in Mid-America's operations and swung to a $45 million pre-tax loss as home sales fell. Mid-American earned almost $1.1 billion pre-tax during 2008, on top of regular operating earnings, from an investment in Constellation Energy Holdings, another energy holding company. Constellation was within hours of bankruptcy when Mid-American acquired it, proving the value of being able to move very quickly. Buffett told shareholders at the annual meeting the next year that we literally went from a phone call that Dave, so-called, made to me at noon or 1 o'clock to handing them a firm bid that evening in Baltimore. Within months of agreeing to the deal, Constellation reneged in favor of another suitor. Berkshire was left without a new operating subsidiary, but with a $175 million breakup fee and a $917 million profit on last-minute preferred stock investment that provided Constellation with liquidity to keep operating. Mid-America's ability to make deals quickly rested on its financial strength and its good reputation with regulators. As Buffett proudly told shareholders in his chairman's letter, a 2009 report on customer satisfaction with pipelines ranked Kern River and Northern Natural first and third respectively, a significant improvement from 9th and 39th when Berkshire acquired them in 2002. Mid-American's Iowa electric operations had not increased electric prices since 1995 and did not plan to do so until after 2013. By focusing on efficiency and without the need to distribute earnings, Berkshire's utility operations could maintain a strong balance sheet and invest any sum necessary to provide the best service. In return, said Buffett, we have been allowed to earn a fair return on the huge sums we have invested. Manufacturing, service, and retailing. The diversity of the MSR businesses led to diverse results amid the backdrop of the accelerating recession. Buffett said the full-year results were satisfactory, but many businesses in this group hit the skids in the fourth quarter. Ominously, he added, prospects for 2009 look worse. The businesses tied to construction and retail suffered the most, though some subsidiaries reported improved results. This group was also joined by a very large sister company during 2008, Marmon Holdings, discussed below. These businesses collectively earned a 21.8% pre-tax return on tangible capital, down from 27.6%, and 17.9% on average tangible equity, down from 22.8%. Shaw, Berkshire's largest existing MSR business, and one directly tied to building and real estate, saw a 6% decline in revenues to $5 billion. Its earnings fell 53% to $205 million as raw material costs eroded gross margin and lower demand prevented economies of scale. Shaw closed some manufacturing plants and laid off some employees, an unwelcome but necessary reality that also hurt earnings. The other manufacturing segment included many economically sensitive businesses. Within this segment, pre-tax earnings for Berkshire's building products manufacturers fell 28%. Earnings in apparel fell 34%, and at Forest River, especially subject to consumer spending being the outdoor recreation equipment business, earnings dropped 56%. Like Shaw, some of these businesses were forced to reduce headcount to right-size operations. The only business in this category identified as growing was Berskhire. Berkshire's only standalone service business was its distributor, McLean. Because the SEC-based segment reporting requirements on revenues and not profits, Because the SEC-based segment reporting requirements on revenues and not profits, McLean could not be grouped with Berkshire's other service businesses. In 2008, revenues increased 6% to $29.9 billion, and earnings increased 19% to $276 million. The company benefited from additional customers, higher prices, and slightly wider gross margins. In the other service segment, which included NetJets, Flight Safety, TTI, Business Wire, The Pampered Chef, and International Dairy Queen, the impact of the recession was minimal until the last quarter of 2008 as the recession intensified. Overall, revenues of other service businesses increased 8%. However, had TTI, the new electronic components distributor acquired in 2007, not been included, revenues would have increased just 2%. The segment's pre-tax earnings of $971 million were on par with the prior year, but augmented in 2008 with a full-year earnings from TTI. NetJets wrote down its fleet by $54 million. With its direct line to consumer spending, the change in economic fortunes impacted retailing most. This group included Berkshire's 4 furniture retailers, 3 jewelry retailers, and See's Candies. Together, revenues in this segment declined 9% to $3.1 billion, with all but one, identified, business experiencing a decline. Every one of the businesses, however, had lower earnings and pre-tax earnings, which overall declined 41%, to $163 million compared to 2007. If that wasn't bad enough, the fourth quarter was the worst. Revenues and pre-tax earnings down 17% and 33%. And conditions were expected to worsen going into 2009. Amid the weakening economic landscape of 2008, Berkshire's MSR businesses took steps to improve their long-term economic positions via acquisitions. This was the moat building Buffett praised so highly. To be sure, these businesses reduced overhead and personnel where necessary, but while others were myopically focused on today, many of the building product subsidiaries made tuck-in acquisitions that bolstered their long-term earning power. The most noteworthy acquisition of the year in the MSR segment was Berskhire's acquisition of Japanese-based Tungalloy for $1 billion. Marmon Group Incorporated. Berkshire's newest operating subsidiary was itself a large conglomerate with a long history. It was also Berkshire's largest cash acquisition. Berkshire's $4.5 billion purchase of 60% of Marmon on March 18, 2008, implied a $7.5 billion valuation for the entire business. Marmon's results were included in the MSR segment. The paths of one Marmon's founder, J. Pritzker, and Buffett crossed in 1954 when Buffett worked in New York for Graham Newman. Over the ensuing decades, Jay and his brother, Bob, grew Marmon to an over 100-business conglomerate operating across many different sectors. As of 2008, Marmon had 130 independently owned As of 2008, Marmon had 130 independently operated businesses within 11 sectors and operated more than 250 manufacturing, distribution, and service facilities, primarily in North America, Europe, and China. We do not have access to the same detailed historical finance reports as Buffett, but the summary of information for the 3 years ending 2007, the data Buffett had when he made the deal, support the conclusion that he most likely saw a group of well-established businesses with consistent earning power. All the sectors listed above were well-established and critical to the economy over the long term. We can also assume they met Buffett's tests of having good management in place and a reasonable purchase price given the quality of the underlying business. The purchase also included assumed debt and goodwill intangibles. If we assume Marmon's 2007 and 2008 financial performance was representative of the long-term earnings power of the business, Berkshire acquired a business earning solid double-digit pre-tax returns on tangible capital. Even after considering the premium Berkshire paid for the company, it would still earn more than the 10% pre-tax Buffett expected of Berkshire stock market investments. It's possible the general economic weakness or weakness in the It's possible the general economic weakness or weakness in the equity and or credit markets played a role in keeping the price down. Berkshire also agreed to purchase the remainder of the company over time based on a formula tied to earnings. By the end of 2008, Berkshire had acquired an additional interest, ending the year at 63.6% ownership. Finance and financial products. Berkshire's Clayton Homes subsidiary was at the center of the recession and credit crisis. Its business of building homes and financing them contained many lessons, and Buffett chose to devote over 2 pages of his chairman's letter to the subject. A major lesson was the power of incentives. Brokers earning commissions upon the sale of a home or lenders earning them upon closing a loan transaction had every incentive to see the deals go through, up to and including forging information. Compounding the problem, and perhaps part of the cause of it, was that commissions and fees were earned at closing with no negative repercussions if problems later developed. Lending institutions often securitized loans into packages that were carved up and sold to unsuspecting investors. No one, sometimes not even the homeowners, had much skin in the game. Home prices reached their peak in 2006. By 2007, they began a 2-year nosedive. During the rise, buyers and lenders pushed the envelope. Buyers bid up house prices fast and far. Lenders offered Lenders offered creative and cringeworthy loan terms to accommodate this, sometimes even resorting to forged incomes. Interest-only payments on loans meant the outstanding loan balances would never decline, and in some cases, negative amortization loans, where the interest is higher than the loan payment, allowed principal to grow over time. Both parties counted on house price appreciation to make this otherwise impossible situation work, Buffett told shareholders. This price appreciation incented builders to construct new housing, and build they did. 2 million housing units were created despite demand of just 1.3 million units. Once supply eclipsed this fundamental demand, housing prices had to fall. Housing starts then receded below demand, but it would take a while for the excess supply to be absorbed. Against this backdrop, Clayton was bruised but not broken. It avoided the major mistakes of its industry cousins by staying out of the fray. Where its peers securitized their loans, Clayton retained a portfolio of $12.6 billion of its own and others' loans. Its credit standards required a down payment of at least 10% and verified income. Losses from 2 hurricanes also inflicted pain during this period. Clayton's business was negatively affected by the recession in 2 major ways. 1. Lower volumes of units sold resulted in a 9% decrease in manufactured home sales and presumably the loss of certain economies of scale in manufacturing. Clayton countered the lower unit volume by closing certain manufacturing facilities, costing it related write-downs and charges. 2. A higher delinquency rate, while better than the industry average, resulted in higher loan loss provisions to cover future losses. Even though Clayton's average borrower had a credit score below the national average, its prudent lending was rewarded with a delinquency rate of just 3.6% in 2008, compared to a national average of 5%. These factors combined resulted in Clayton's pre-tax earnings falling 61% to $206 million. Paradoxically, Clayton's financial strength negatively affected its business. In order to help the country at large, the U.S. government and the Federal Reserve provided funding to banks and other financial companies at rates far below what their creditworthiness would otherwise have allowed. This meant that the 7 AAA-rated companies in the United States, including Berkshire, were penalized for their strength and had a higher cost of borrowing than financially shakier competitors. At the moment, it is much better to be a financial cripple with a government guarantee than a Rock of Gibraltar without one, Buffett wrote. Pre-tax earnings from the finance and financial products segment declined 22% to $787 million from the year before. Clayton's decline in earnings was a large reason for the deterioration, and the leasing operations also experienced a 22% decline in earnings, though each remained profitable. Investments. Berkshire's investment portfolio usually changed at a glacial pace, and this was okay with Buffett. Beware the investment activity that provides applause. The great moves are usually greeted by yawns, he wrote. Unfortunately, 2008 was memorable in the wrong way. A $15.1 billion after-tax decline in unrealized appreciation of the investment portfolio more than offset Berkshire's $5 billion of net earnings and was in fact the primary reason Berkshire reported a decline in book value. The silver lining was that stocks were now on sale and Berkshire could invest additional sums at attractive valuations. It did just that, investing a net $3.3 billion in equity securities during the year, as well as additional sums in negotiated transactions. Comparing the equity portfolio between 2007 and 2008, 5 names disappeared and 1 new investment made the $500 million reporting threshold. Gone were Anheuser-Busch, which was sold to InBev, a Belgian-based beer conglomerate, USG Corp, which remained in the portfolio but fell below the cutoff, and White Mountains Insurance Group, whose shares were sold. Additional purchases of BNSF stock made by Berkshire and share repurchases by Moody's caused them to fall off the list. At the close of the year, Berkshire owned 70.1 million shares, or 20.7% of BNSF, and its 48 million shares of Moody's, unchanged since 2000, now represented the 20.4% ownership interest. With that level of ownership, accounting rules required that Berkshire begin using the equity method. The change in methods required a $626 million increase in Berkshire shareholders' equity to bridge the gap between the underlying shareholders' equity and the fair value of the investments. 2 equity purchases are of note. The lone new name on the chairman's table was Swiss Re, a Swiss-based reinsurer, of which Berkshire owned 3.2% at year-end. Another was an almost $6 billion increase, at cost, in ConocoPhillips stock, which Buffett told shareholders was a mistake. Without urging from Charlie or anyone else, I bought a large amount of ConocoPhillips stock when oil and gas prices were near their peak, he confessed. The mistake cost Berkshire $2.6 billion between year-end 2007 and 2008. Investment opportunities were plentiful in the public stock and bond markets and in private transactions that leveraged Investment opportunities were plentiful in the public stock and bond markets and in private transactions that leveraged Buffett's and Berkshire's reputation. Over 2 weeks in October 2008, Berkshire invested $14.5 billion in 3 companies. The deals were reminiscent of the convertible preferred stock investments of the late 1980s. October 1st, a $5 billion issue of cumulative perpetual preferred stock of Goldman Sachs that carried a 10% coupon and came with warrants to purchase shares in the investment bank. October 6th, a $6.5 billion investment in Wrigley's to assist Mars Incorporated's acquisition of the chewing gum maker. October 16th, a $3 billion investment in 10% cumulative perpetual preferred stock issued by General Electric. That investment also came with warrants to purchase shares in GE. Unlike the Gillette or Solomon investments of the early 1990s, these 3 new investments didn't carry any serious risk to Berkshire's well-being. Where Solomon represented an investment approaching 10% of Berkshire's equity capital at the time, these were comparatively modest against Berkshire's average equity of $115 billion. To fund these commitments and others, Berkshire sold investments it otherwise would have held on to. This included halving its stake in Johnson & Johnson and reducing stakes in other marketable securities. It was a matter of opportunity cost, said Buffett, as well as ensuring Berkshire always had enough cash on hand to meet its obligations. Buffett also took advantage of mispricing in the derivatives market during 2008. Such moves were seemingly un-Buffett-like given his outspoken criticism of derivatives. That Berkshire wrote 4 derivatives contracts during the year did not reflect a change in attitude. Buffett's logic instead rested on the fact that even under a worst-case scenario, the 4 put contracts would amount to a long-term loan with a very reasonable interest rate. The 4 deals brought in $4.9 billion of premiums that would only pay out if the underlying major indexes declined between then and their expiration dates, which were far in the future. In the meantime, Berkshire could invest the premiums as it saw fit and had no requirements to post collateral. Berkshire also wrote $4 billion of credit default swap contracts during 2008. In this case, however, it spread the risk over 42 companies because it faced counterparty risk in collecting the $93 million of annual premiums it received. Berkshire's businesses were negatively impacted by the Great Recession, but not as much as other businesses. Led by Buffett, Berkshire's managers focused on building for the long term. Berkshire spent over $6 billion for acquisitions, which bolstered its earnings power even if results would take time to materialize. Its major investments during the year, an additional $3.3 billion net in equities and another $14.5 billion in arranged deals, were made on very favorable terms but served as a counterforce in the sea of selling and negativity. Berkshire Hathaway's actions, in Buffett's own words, he wrote an op-ed piece in the New York Times in October urging investors to buy American, I am, backed his conviction that America had the right recipe and would do fine over time. As Buffett indicated in his communication with shareholders, the pain of 2008 was just the start of what was to come. The economic recession would continue into 2009 and drag on longer than almost anyone imagined. The stock market itself would bottom in early 2009 before finally reaching positive territory at year-end. Berkshire soldiered on, ever on the lookout for opportunities. 2009. Like the year before, 2009 brought both challenges and opportunities for Berkshire Hathaway. The economy was still reeling from the deepest economic slowdown in generations. There were negative effects, to be sure, but there were also unique opportunities. In the latter part of the year, Berkshire lined up one of its largest acquisitions yet, the railroad company Burlington Northern Santa Fe, BNSF. In 2009, Berkshire showed once again that a long-term approach to business and capital allocation was best. Warren Buffett's high-level performance metric of change in book value gave up some ground during 2009, falling 6.7 percentage points behind its benchmark, the S&P 500. Still, Berkshire's absolute gain of 19.8% was just a half a point behind its 45-year average. a highly satisfactory result for the 11th largest company on the Fortune 500. With the BNSF acquisition completed when he penned his account of 2009, Buffett reminded all shareholders, new and old, that our defense has been better than our offense, and that's likely to continue. In other words, just as in 2008, Berkshire's relative outperformance came in the down years. Insurance. Berkshire's insurance group reported another year of underwriting profits and topped it off with an increase in float. Its $1.6 billion pre-tax underwriting gain marked the 7th consecutive year of underwriting profitability, enough evidence for Buffett to tell shareholders he thought Berkshire's insurers would write to a profit in most, though certainly not all, future years. Berkshire's significant reinsurance operations, particularly the catastrophe business, would all but guarantee some down years. Each of Berkshire's major insurance segments found ways to grow float, except for General Re, where it remained flat. The combined total float grew 6% to $62 billion at year-end. As usual, Geico and Berkshire Hathaway Reinsurance Group were the standout performers. During 2009, General Re acquired the remaining part of Cologne Re it did not already own. Berkshire owned a controlling interest in the German reinsurance operation since the 1998 Gen Re deal and gradually increased its ownership in the ensuing years. Buffett planned to celebrate with a visit to the operation later in 2010. General Re. For the 4th straight year, General Re posted underwriting profits, earning $477 million on premiums of $5.8 billion and Buffett's praise. Property risks appeared well managed and produced a $173 million underwriting gain from current year business, along with $305 million of favorable loss development on prior year events. Current year gains were after $48 million of catastrophe losses from a winter storm in Europe, bushfires in Australia, and an earthquake in Italy. Casualty workers' compensation again posted a loss. Higher loss trends on business written that year necessitated additional reserves, and the usual accounting charges for loss reserve, discount accretion, and deferred charge amortization, amounting to $118 million, led to a $178 million loss from the casualty segment. The life health business earned $177 million. Gen Re's float was $21 billion at year-end 2009 and represented a third of Berkshire's total float. Berkshire Hathaway Reinsurance Group. Berkshire Hathaway Reinsurance Group, BHRG, benefited from no meaningful catastrophe losses in 2009. It posted a smaller underwriting gain of $349 million compared to $1.3 billion the year before. Considering the accounting headwinds from the amortization of deferred charges on retroactive reinsurance contracts and $280 million of losses in multi-line from a weaker dollar that reevaluated foreign-denominated liabilities, this result was highly satisfactory. Berkshire benefited from both profits and float that grew 8.3% to $26.2 billion. With a new audience of BNSF Railroad shareholders, Buffett again recounted the story of Ajit Jain's arrival at Berkshire. He praised Jain and his small team of 30 employees at Berkshire Hathaway Reinsurance Group for their contributions. The team found other ways to increase business even though softening markets restrained volumes generally. One contribution was a 50-year life insurance contract that would start in 2010 and which might amount to $50 billion of premiums over time. Another was a $1.7 billion retroactive reinsurance contract with Swiss Re, known as an adverse loss development policy. Complex policy basically covered Swiss Re in the event its estimates of incurred loss proved incorrect. Swiss Re found itself in trouble after losing 6 billion Swiss francs, and the retro policy with Berkshire was one way of shoring up its balance sheet. Berkshire came to the aid of Swiss Re in another way. Early in 2009, it invested $2.7 billion in 12% convertible perpetual security that provided the insurer additional capital. Berkshire now had 3 relationships with Swiss Re as a partner via the quota share agreement from 2008, part owner of the firm via its investment in common equity, and as a creditor. While BHRG's overall earned premiums grew 32% to $6.7 billion, in large part because of the 2 Swiss Re contracts, it slowed down its written premium volume. Written premiums in catastrophe and individual risk fell 34% to $725 million, and other multi-line volume would have fallen 46% if not for the Swiss Re contract. This was both self-imposed and due to softening markets. As its net worth declined due to the significant drop in equity prices during the first quarter, BHRG reduced volumes to maintain a more conservative premium-to-equity ratio. Another reason to pull back was the pending acquisition of BNSF, which would be held within National Indemnity and soak up liquidity. Only at Berkshire Hathaway would an entire railroad be placed under the corporate umbrella of an insurance company. Why do this? BNSF's consistent earnings would be a natural offset to the volatility inherent in reinsurance. A drastic reduction in premiums written at the newly formed Berkshire Hathaway Assurance Corporation highlighted the market's shifting willingness to bear risk. During 2008, it wrote $595 million as fear gripped the markets. Volume in all of 2009 was concentrated in the first half of the year and amounted to just $40 million. Berkshire's approach was not the norm. Buffett said other municipal bond insurers took on more risk when premiums became too thin. That risk had reared its ugly head during the credit crisis. Berkshire had the discipline to walk away from bad deals. Geico. Geico's bottom line was in black 13 out of the 14 years under Berkshire's ownership, but that was only part of the luster. While 2009 profits were just $649 million on $13.6 billion of earned premiums, the 95.2% combined ratio was right in the company's sweet spot of delivering profits to its owner and value to its customers. Profits in the prior 2 years were too high, and Geico allowed premiums per policy to fall over that time. Higher accident frequency and severity also played a part. During the recession, Geico added policies at a record rate and increased its market share from 7.7% to 8.1%. This was counter to an expectation that some might look to reduce insurance costs during tough times by dropping policies. Instead, Geico's ability to save money for its customers translated into more business as people became more cost-conscious with their purchases. A big part of Geico's value was its float. At Berkshire, profitability was rule number one. After that, growth in float drove value. On that front, Geico delivered. Premium growth over the past 3 years had swelled float by over a third to $9.6 billion. Ever on the lookout to expand Geico's reach, Buffett informed shareholders of a failed experiment to offer credit cards to policyholders. He reasoned its generally above-average drivers were above-average credit risk. He was wrong. Instead, Buffett's idea, which Geico managers disagreed with, cost the company over $50 million. Berkshire Hathaway Primary Group. Premium volume and profits fell in the primary lines. Underwriting profit of $84 million was down 60% from the year before on earned premiums of $1.8 billion, down 9%. Competition hit each insurer under this group except for Boat US. Regulated utility businesses. Berkshire's collection of utility businesses demonstrated their resiliency as essential services, but also proved they weren't immune to the effects of recession. Earnings before interest and taxes, EBIT, declined 16% from the year before, adjusting for the one-time earnings from Constellation Energy in 2008. While some of the decline was due to depreciation on additional assets, unfavorable exchange rates, and milder temperatures, a portion was attributable to reduced demand due to the recession. Berkshire Hathaway Home Services, tucked into the utility segment, returned to profitability in 2009. Its EBIT increased to $43 million from a loss of $45 million the year before. The company added a Chicago firm to its roster of brokerages and continued to build out its business amid the ongoing recession. Buffett compared the acquisition of BNSF, discussed in more detail in 2010, to Berkshire's utility operations. He noted both had certain social compacts with society due to the crucial role each played in the economy. Both also had similar economic characteristics of providing essential fundamental services, requiring large investments in excess of depreciation, and being subject to price regulation. He added they would both use substantial amounts of debt that is not guaranteed by Berkshire. Like the utilities, the railroad would also retain most of its earnings once under the Berkshire umbrella. As economic cousins, the utilities and railroad would share the same reporting segment in Buffett's chairman's letter going forward. Manufacturing, service, and retailing. Berkshire's MSR businesses were hit hard by the recession. Consequently, pre-tax earnings were cut in half, down 49%, to $2.1 billion. Pre-tax return on tangible capital fell from 21.8% to 9.7%, and after-tax return tangible equity fell from 17.9% to 7.9%. But some of the businesses in this category managed to do better despite the challenges. Buffett specifically identified and praised 9 businesses and their CEOs for delivering higher profits despite lower revenues. Special praise was reserved for Grady Rosier, who led McLean to both higher revenues and profits. Not surprisingly, the manufacturing businesses were hit hardest. Revenues at Marmon, Berkshire's newest large acquisition, declined 27%. Owing to improved margins, which earned CEO Frank Tack Buffett's praise, earnings declined at a slower 26% rate. That earnings fell just about in line with sales is notable for Marmon, since one would expect to see lower revenues negatively affect margins. With a large drop in carpet sales volume, Shaw's revenues declined 21% to $4 billion, and its pre-tax earnings fell 30% to $144 million. Shaw's economic sensitivity was somewhat breathtaking. In just 3 years, pre-tax earnings fell 67% on 25% lower revenues. The smaller manufacturing businesses experienced similar pain. Revenues in apparel fell 11%, building products 20%, and other manufacturing businesses were off 16%. Earnings for this subsegment were hit even harder, falling 51% compared to 2008 to $814 million. McLean, the largest standalone service business, rightly earned Buffett's praise during 2009. Revenues increased 5% to $31.2 billion as increased grocery business more than offset a decline in food service business. Earnings swelled 25% to $344 million, due in part to the increase in revenues and lower operating costs. Another reason, however, was a substantial inventory price change gain related to tobacco product inventory. Manufacturers of tobacco products raised their prices ahead of an increase in taxes, which allowed businesses already in possession of inventory to book a one-time windfall. Taken as a group, the other service businesses generated the almost unthinkable, a pre-tax loss of $91 million. A closer look reveals the cause was one bad apple, NetJets. NetJets had a massive $711 million loss and was the overwhelming cause of the red ink. It had more planes than needed, and the company incurred costs of $676 million to downsize operations. An operating loss made up the difference. Buffett pointed to the sad reality that NetJets' cumulative pre-tax losses since Berkshire acquired the company amounted to $157 million, and its debt had swelled from $102 million to $1.9 billion. He also put David Sokal, the enormously talented builder and operator of Mid-American Energy, in charge of NetJets in August 2009. Sokal immediately began to right-size the company and generate profit. Excluding NetJets, the other service businesses were impacted by the recession, but to a lesser degree. Pre-tax profits fell 18% to $620 million. Results in the retail segment weren't as bad as manufacturing or service. Revenues dropped 8%, with home furnishings revenues sliding 7% and jewelry off 12%. Pre-tax earnings were flat at $161 million, and even though the year was difficult, See's, Star Furniture, and Nebraska Furniture Mart managed to increase earnings, which generated Buffett's praise and recognition. Finance and financial products. Clayton was now the largest modular home manufacturer in the U.S., as the 3 previous industry leaders all went bankrupt, including Oakwood, which Berkshire purchased in 2004. The industry was in shambles. Clayton suffered from broader housing-related issues and manufactured home-specific challenges, but it remained profitable. Its earnings were down 64% from their peak of $526 million in 2007 to $187 million in 2009. Berkshire's leasing operations, which included Court Furniture and Extra, barely eked out a profit in 2009 as fixed costs swamped their income statements. A revenue decline of 14% to $661 million translated into an 84% decline in pre-tax earnings, far below the $182 million earned in 2006. Because of a jump in life and annuity earnings, the sole line item to see an increase during the year, the finance and financial products segment overall earnings dropped less than 1% to $781 million. Berkshire's old partners at Leucadia came knocking again at the end of 2009 with another opportunity. The two companies had joined forces in 2001 as Berkshire to buy troubled finance firm Finova. With Finova successfully liquidated and the name available, the new venture was also called Berkshire, which prompted Buffett to remark that it should be called Son of Berkshire and jokingly look forward to a grandson of Berkshire someday. The present Berkshire was Berkshire Commercial Mortgage. Like the 2001 Berkshire, this one was the result of a failed company. Capmark Financial Group Incorporated filed for bankruptcy after overextending itself. Berkshire and Leucadia came to the rescue with a deal to buy the assets out of bankruptcy. They then rehired many former employees. Investments. With the stock market bottoming in March and companies in need of capital, Berkshire made some opportunistic changes to its equity portfolio and negotiated investments in additional non-traded securities. It also sold some investments to raise capital ahead of the BNSF acquisition. Within the existing equity portfolio, Berkshire doubled its stake in Walmart, bringing its ownership to $1.9 billion at cost from $942 million, or 1% of the company. It increased its investment in Wells Fargo, too, as bank stocks got punished. With almost one-fifth of the $59 billion equity portfolio in one company and over half in the top four, Berkshire continued its philosophy of concentration. One newcomer made the list in 2009, and it was unconventional in several ways. For starters, the idea came from Berkshire Vice Chairman Charlie Munger, a perennial skeptic who earned himself the nickname of the Abominable No Man from Buffett. The investment was a $232 million stake at cost in China-based BYD Company Limited that amounted to 9.9% of the company. This was the largest ownership stake allowed by the Chinese government. BYD manufactured electric vehicles and lithium batteries. Munger compared company founder Wang Changfu to Thomas Edison. While some outsiders saw the new holding as a venture capital-type investment, Munger saw otherwise. This is not some unproven, highly speculative activity. What it is a damn miracle. Munger was impressed that Changfu had been born into poverty and founded BYD from nothing to successfully compete against well-established competitors. That the investment was worth nearly 8.5 times its costs, about $2 billion at year-end 2009, was enough to silence more vocal skeptics. The year also brought additional opportunities to invest in non-traded securities like the Goldman Sachs, Wrigley, and General Electric deals completed in 2008. In addition to the $1.7 billion Swiss Re deal described earlier, Berkshire assisted Dow Chemical with its acquisition of Haas Company, investing $3 billion in a cumulative convertible perpetual preferred stock. Another $1 billion went to Wrigley to assist Mars in the form of 4- and 5-year senior notes. A $300 million investment in senior notes to Harley-Davidson provided insight into Buffett's decision-making process and how he thought about his circle of competence. In February 2009, Berkshire participated in a $600 million debt offering that carried a 15% coupon rate. The investment was too small to be identified in Berkshire's financial statements, but shareholders nonetheless picked up on it in Harley-Davidson's financials, and so did the financial press. They all had the same question. Why did Buffett lend Harley-Davidson money rather than buy the equity, which had more than doubled within a year? Buffett's response was telling. He had no view on Harley-Davidson's equity value since he couldn't gain clarity on the future of the motorcycle market or the company's margins or returns on capital. Lending to the company was relatively easy, however, since that decision was based on whether it was going to stay in business. He summed up the investment thesis in a way only Buffett could. "I like a business where your customers tattoo your name on their chest," he said. The few equity sales that occurred in 2009 were made to fund new commitments. ConocoPhillips was reduced by about 2/3 and was admittedly a mistake. Additional sales included Procter & Gamble and Johnson & Johnson, which were reduced modestly. Berkshire also sold some shares in Moody's, which reduced its holdings below the 20% threshold and therefore ceased reporting that investment on the equity basis. In a rare move, Buffett publicly criticized the management of an investee. Two interrelated capital allocation decisions made by Kraft Foods got his blood pressure boiling. One was its purchase of Cadbury, a candy company which he thought overpriced. The other was the divestiture of its frozen pizza business to raise the capital needed to buy Cadbury. He thought the deal underpriced and tax inefficient. "I think the odds are that both deals were dumb. Pizza deal was particularly dumb," he told the shareholders in response to a question at the annual meeting, adding Berkshire made its fair share of mistakes. Still, Berkshire didn't sell a share of Kraft stock. The details of the pizza divestiture show the low multiple Kraft received on the net proceeds from the sale and illustrate Buffett's thinking process. It wasn't the headline sale price that mattered to him. The relevant facts were the net proceeds from the sale compared to the pre-tax earnings of the business. See Table 7.16. A major lesson from 2009, big opportunities come in times of fear. Berkshire took advantage of the turmoil and made significant investments. In hindsight, Buffett wished he did more. When it's raining gold, reach for a bucket, not a thimble. It's been an ideal period for investors. A climate of fear is their best friend. Those who invest only when commentators are upbeat end up paying a heavy price for meaningless reassurance. In the end, what counts in investing is what you pay for a business through the purchase of a small piece of it in the stock market and what that business earns in the succeeding decade or two. Berkshire's capital allocation activity in 2009 extended to acquiring additional interest from minority partners, a practice that was common. Within the footnotes of the 2009 annual report lay a particularly interesting accounting change related to these activities. Effective that year, additional purchases of minority interests, that is, purchases of stock by Berkshire from non-controlling owners where Berkshire owned less than 100%, would be recorded as changes to shareholders' equity. Prior to the change, they were recorded as additional investments with any premium to book value placed on the balance sheet as goodwill. This was consistent with the accounting methodology at the time of the original investment. Purchases made this year, though, resulted in a $121 million reduction in equity because Berkshire paid a premium to acquire shares from minority partners. This accounting effectively required an immediate 100% write-off of goodwill created by subsequent investments when a brand new investment would still place goodwill on the balance sheet. Under the prior accounting, no such reduction in shareholders' equity would have been required for additional investments of this kind. On December 22, 2009, Berkshire's board of directors announced it had elected Stephen Burke to its board. At the time, Burke was COO of Comcast and served on the boards of J.P. Morgan Chase and the Children's Hospital of Philadelphia as chairman. At 51 years old, Burke was the second youngest member of the Berkshire board, behind Susan Decker, then 47 years old. If the name sounded familiar, it's because Burke was the son of Daniel Burke, the former president of Capital Cities, who together with Tom Murphy built and ultimately sold the company to Walt Disney Company. Stephen Burke cut his teeth at Disney before joining Comcast. Buffett clearly saw a pattern of successful businessmen in the Burkes, saying Stephen Burke was business-savvy, owner-oriented, and keenly interested in Berkshire, the three ingredients we look for in directors. The value of the Berkshire operating model was on display during the stress of 2009. One characteristic was not requiring its managers to submit budgets or projections to Buffett in Omaha. Some used budgets within their own operations, some didn't. Both Buffett and Munger knew the power of incentives. Buffett said if Berkshire required managers to submit budgets, they might become tempted to meet them by fudging numbers from time to time. Berkshire wanted to create a structure that minimizes that weakness in human behavior. Its managers were instead expected to tell how it was and act with integrity, even if it meant reporting bad news. Berkshire allocated a great deal of capital during the prior 2 years of turmoil. With perfect hindsight, more would have been possible, but the investments Berkshire made set it up for years of additional dividend and interest income. Its subsidiaries, while bruised, nevertheless remained secure within their castles, protected by the advantages of their economic positions. Chapter 13, 2010 to 2012. 2010. Berkshire's 13% growth in book value per share trailed the S&P 500 by 2.1 percentage points in 2010. It marked the second consecutive year of underperformance, a first in Berkshire's modern history. Many investors remained cautious about the state of the economy, having just come through one of the worst economic recessions in U.S. history. But Berkshire's capital allocators saw things differently. Some of its businesses, such as those tied directly or indirectly to construction, remained sluggish. Others, such as Marmon, Forest River, and Iscar, bounced back. Thanks to a focus on building businesses for the long term and good management, most of the Berkshire's diverse operating businesses emerged from the recession stronger than before. They were also joined by a gargantuan newcomer. The Berkshire conglomerate swallowed an entire railroad, its largest acquisition to date by more than fivefold, providing no question that the United States remained a land of opportunity. That opportunity, Buffett stressed, was only open to the fittest business. Having loads of liquidity, though, lets us sleep well. Moreover, during the episodes of financial chaos that occasionally erupt in our economy, we will be equipped both financially and emotionally to play offense while others scramble to survive. Despite Berkshire's good prospects, its share price in 2010 reflected pessimism. Whether it was a general caution or Berkshire specifically is unclear. The company's market capitalization ranged from a low of $160 billion to a high of $212 billion. This prompted Buffett to be more specific than usual about Berkshire's earning power to nudge shares closer to intrinsic value. Buffett estimated Berkshire's normal earning power at $17 billion pre-tax, or about $12 billion after tax, including the new BNSF acquisition and making allowances for insurance operation variability. His chairman's letter also supplied the two numerical components he suggested using to estimate Berkshire's intrinsic value: per-share investments and per-share pre-tax operating earnings. These were not-so-subtle hints that Berkshire was meaningfully undervalued. Burlington Northern Santa Fe, BNSF. The largest acquisition in Berkshire's history to date occurred on February 12, 2010. The acquisition increased Berkshire's normal earning power by 40% pre-tax and over 30% after tax. BNSF was the culmination of 150 years of acquisitions and mergers that consolidated 400 railroad lines. The industry had consolidated to the point of having just a handful of major Class I railroads serving large swaths of North America. BNSF moved freight from many industries, primarily across the western part of the United States, over 32,000 route miles. Its revenues were classified in four broad categories. See Figure 7.3. What attracted Berkshire to BNSF, an industry historically full of woes? Charlie Munger summarized these past troubles as high capital intensity, heavy unionization, intense regulation, and comparative disadvantage to long-haul trucks, the main alternative form of transport. That changed over time as the industry consolidated and deregulated. The railroads began successfully negotiating with unions to reduce labor costs and became more fuel efficient compared to trucking. By double-stacking freight cars, which required an investment in raising tunnels and strengthening bridges, the railroads became 3 times as efficient as trucks and carry a ton of freight 500 miles on 1 gallon of fuel. Buffett said agreeing to buy BNSF during the Great Recession was, all in all, a wager on the economic future of the United States. Investing in the common stock of railroads, as Berkshire had done since 2006, including BNSF, was one thing. It was something else to buy an entire railroad. Here are some factors that made BNSF attractive to purchase outright. 1. Improved industry economics. As noted above, railroads enjoyed improved operating margins and returns on capital compared to previous decades. Those returns were protected by a moat since the barriers to entry were high. It would be virtually impossible to assemble the land and rights necessary to build a new long-haul railroad from scratch in the 21st century. 2. Utility-like characteristics. As a major part of the American economy's circulatory system, the regulated railroad industry functioned like a utility, including known investment returns, just like Mid-American, with the same social compact. 3. Ability to invest huge sums. Again, like Mid-American, BNSF required huge amounts of capital investment to maintain its operations and, importantly, possessed the ability to invest more to expand. A known, but limited, return on additional capital investment would provide a place to invest cash generated from elsewhere within Berkshire. 4. Western population expansion. BNSF transported 11% of all inner-city ton-miles of freight in the United States. That was likely to increase as population growth in the western United States outpaced that of the east. BNSF would benefit from having a near monopoly on western rail traffic, including shipments of products originating in Asia to ports on the western seaboard. 5. Deferred taxes. BNSF's need to grow and its ability to take additional capital investment came with tax benefits. The U.S. allows companies to accelerate their depreciation for tax purposes compared to an asset's useful life. The result is an interest-free loan from the government, like deferred taxes on capital gains. BNSF's headline tax rate, total tax divided by taxable income, averaged between 35 and 38% in the 5 years ended 2009, but it paid an average rate of just 27% on its pre-tax income during this period. In dollar terms, that amounted to $1.5 billion. No small sum. 6. Lower borrowing costs. BNSF would benefit from Berkshire's credit rating even though Berkshire did not provide an explicit guarantee of BNSF's debt. Taken together, the factors above shed light on what appeared to be a very low initial return for Berkshire, see Table 7.17. Berkshire could accept a slightly lower pre-tax return for the existing business since BNSF could defer a portion of its income tax each year. Additionally, any incremental investment BNSF made would be at pre-tax returns solidly in the double digits. And since the company functioned like a utility with stable revenues and earnings, some debt was appropriate and would serve to increase the return on equity capital. Importantly, Berkshire purchased the company during a time of economic weakness. Berkshire's return would thus be higher if BNSF earned the kind of return it had in the recent 5-year period. The price tag for BNSF was $44.5 billion, including debt assumed in the acquisition. The price accounted for the shares Berkshire already owned. The remainder of the purchase price of $26.5 billion was paid in cash, half borrowed, and Berkshire shares. Berkshire issued 94,915 Class A share equivalents in connection with the acquisition. The implied valuation of Berkshire associated with the acquisition was about $184 billion. Berkshire's share traded at what appeared to be a meaningful discount to its intrinsic value during 2010, but Buffett and Munger judged the acquisition worthwhile nonetheless. Simultaneous with the acquisition, Berkshire split its B shares 50-1. This was done to allow more BNSF shareholders the opportunity to take Berkshire shares instead of cash. Before the split, each B share represented 1/30th of each A share. After the split, each B share represented 1/1500th of each A share. The voting rights were split accordingly, with each B share having 1/10,000th the vote of each A share. With BNSF gone from the public markets, an opening was created in the S&P 500 index. Splitting the B shares provided enough liquidity to meet the requirements, and Berkshire replaced BNSF in the index. One last aspect of the BNSF acquisition highlights the benefits of the Berkshire conglomerate structure. Berkshire reported BNSF as a standalone entity, but the railroad was purchased and is legally owned first by National Indemnity Company. This bolstered the capital and earnings of its insurance companies. As noted in the discussion on 2009, BNSF had utility-like earnings that did not widely fluctuate, which was a natural offset to the variability in underwriting results associated with reinsurance operations. Regulated, capital-intensive businesses. The pure utility businesses of Mid-American Energy were joined by BNSF in this category beginning in 2010. Buffett considered the businesses very similar. A key characteristic of both companies is the huge investment they have in very long-lived regulated assets, with these funded by large amounts of long-term debt that is not guaranteed by Berkshire. Both operated with a social compact that required them to invest large sums of capital into growth projects to support the growing needs of the country. In exchange, he expected regulators to be fair with their allowable returns. Taken together, Mid-America's operations reflected the inherent stability of a utility operation. Its various businesses, including electric generation and distribution, and its pipelines, delivered EBIT of $1.9 billion, up just 1% from the year before. Variability in results in some units couldn't be avoided altogether. EBIT from the pipelines declined 17% because of lower volume, and pricing associated with specific economic conditions, and EBIT from the UK utilities swelled 34% from a gain on the sale of an asset in Australia. Home Services, the real estate brokerage business, was as profitable in 2010 as the year before, with EBIT of $42 million. While BNSF's business was utility-like, it was more subject to business cycles than its mid-American cousin. BNSF's pre-tax earnings dipped 22% to $3.9 billion in 2009, along with a recession, but rebounded 48% to $4 billion in 2010. Some questioned the wisdom of Berkshire buying BNSF. Its results in 2010 would convince most people it had been a good investment. Insurance. Bolstered by the BNSF acquisition, Berkshire's insurance group ended 2010 with $94 billion of statutory capital, up 47%. Earned premiums grew 10% to $31 billion, but still represented just a third of capital, indicating a rock-solid balance sheet. Berkshire's insurers also delivered another year of underwriting gains, up 38% to $2 billion, that produced the cherished negative cost of float. Float grew 6% to end the year at $65.8 billion. Berkshire's insurers were in very good shape. Geico. Buffett used a section of his chairman's letter to highlight the value Geico had delivered to Berkshire and how that value was not always apparent. When Berkshire purchased the entirety of Geico in 1996, it paid $2.7 billion over the company's net worth, equal to 97% of Berkshire's annual premium volume. Since then, the resulting goodwill was amortized from $2.7 billion to $1.4 billion, yet Geico's premiums rose from $2.8 billion in 1996 to $14.3 billion in 2010. Buffett was hinting that Geico's value was not fully reflected on Berkshire's balance sheet. Clearly, a company able to grow policies in force and do so profitably was worth a premium price. Buffett called Geico the gift that keeps on giving, and it was. A combined ratio of 92.2% delivered another billion-dollar underwriting profit in 2010, $1.1 billion, and went along with a market share of 8.8%, up from 8.1% the previous year. Berkshire Hathaway Reinsurance Group. Buffett credited Ajit Jain for creating the $30 billion float insurer that was Berkshire Hathaway Reinsurance Group. Jain still found ways to increase business volume amid an industry backdrop of weakening pricing. Earned premiums grew 35% to $9.1 billion, and pre-tax underwriting profits declined from $250 million to $176 million. Earned premiums in catastrophe and individual risk contracted 24% to $623 million, and pre-tax underwriting profits fell 67% to $260 million. Significant, but unspecified, losses of $322 million impacted results. Retroactive premiums grew 32% to $2.6 billion, largely from a $2.25 billion contract with CNA Financial Corporation to assume certain asbestos and environmental pollution liabilities. Ongoing deferred charge amortization was responsible for a $90 million loss reported by this line. Other multi-line earned premiums fell 11% to $3.5 billion, but underwriting profits expanded from $15 million to $203 million. More impressive, profits were after $308 million in catastrophe losses relating to earthquakes in Chile and New Zealand, floods in Australia, and the BP Deepwater Horizon oil rig explosion. The Swiss Re life insurance deal negotiated the prior year, incepted in 2010, and brought $2.1 billion of earned premiums that year. About $2 billion of annual premiums were expected to continue for decades. Accounting charges related to these contracts would mean significant reported losses, but the long-duration float made the economics of the business highly favorable. Berkshire moved the life and annuity business from finance and financial products to BHRG as Jain expanded activities in this area. It reported a pre-tax underwriting loss of $197 million, compared to a $99 million loss the prior year. General Re. General Re reported another year of underwriting gains, proving it had taken Buffett's four-part test to heart. That included the all-important last test of being willing to walk away if pricing wasn't adequate to cover risks, which happened in 2010. Earned premiums fell 2% to $5.7 billion, and pre-tax underwriting profits declined 5% to $452 million. Its property casualty line was hurt by several of the same natural disaster catastrophes that impacted BHRG. These cost $339 million and caused 2010 underwriting business to slip $96 million into the red. But favorable loss development of $332 million from business in prior years and $53 million in gains from the casualty segment brought it back into the black. Favorable mortality trends led General Re's life health business to a $163 million underwriting profit, down 8% from the year before, but continuing a long string of gains in that area. Berkshire Hathaway Primary Group. The primary group was constrained by weak pricing but still managed to report a combined ratio of 84.2%, a profit of $268 million on earned premiums of $1.7 billion. Manufacturing, service, and retailing. The MSR businesses bounced back to report a profit of $2.5 billion and an after-tax return on tangible equity of 17.3%, up from 7.9% the prior year. Pre-tax return on tangible capital expanded from 9.7% in 2009 to 19.5% in 2010. But weakness remained in areas, particularly in those businesses tied to construction. The largest single reporting unit was Marmon. The mini conglomerate, remember Marmon was a group of 130 independently operated businesses across 11 sectors, increased pre-tax earnings 19% to $813 million. Except for distribution services, each of its 11 lines of business reported higher earnings in 2010, which reflected improvements in the general economy over 2009. The big news with McLean was its entrance into the wine and spirits distribution business with its purchase of Empire Distributors and Horizon Wine and Spirits. This helped push revenues up 5% to $33 billion. Its pre-tax earnings remained tiny in proportion to revenues, but grew 7% to $369 million. With the addition of Marmon, Shaw lost its status as a single reporting unit and was included with Berkshire's various other manufacturing businesses. The fortunes of most businesses in this category improved, including those tied to building products. From the low of 2009, revenues of these businesses rebounded sharply. Forest River up 57%, Iskar Metalworking Companies up 41%, CTB up 20%, and Johns Manville up 12%. Overall, the other manufacturing businesses increased revenues 11% to $17.7 billion, and pre-tax earnings nearly doubled to $1.9 billion. Looking closer, things were better, but not good. Pre-tax earnings from Johns Manville, Mytech, Shaw, and Acme Brick remained 72% below the $1.3 billion earned in 2006. Each also made acquisitions during 2010. The other service businesses increased revenues 12% to $7.4 billion, and pre-tax earnings rebounded from a loss of $91 million in 2009 to a profit of $984 million in 2010. Businesses in this category, including Business Wire, Pampered Chef, Dairy Queen, the Buffalo News, and TTI. Strong worldwide demand for TTI's products and NetJet's return to profitability were responsible for restoring the group to profitability. The largest business within other service businesses was NetJets. NetJets struggled during the previous year with too many planes. It was forced to downsize and write off almost $700 million of its jet fleet. Buffett placed NetJets under the direction of David Sokol, who built and operated Mid-American Energy. Sokol received praise for turning a $711 million pre-tax loss the prior year into a $207 million profit in 2010. Berkshire's subsidiaries enjoyed the advantage of operating autonomously, but the autonomy came with rules. Buffett said NetJets had unfairly used its ownership by Berkshire to obtain a lower cost of debt. To correct for this, Berkshire charged a $38 million guarantee fee, like the spread it charged Clayton Homes for the use of Berkshire's credit. NetJet's profit was after paying this fee. Berkshire's retailing operations were comprised of its 4 home furnishings businesses, 3 jewelry businesses, and See's Candies. Though revenues increased just 2% to $2.9 billion, continued cost containment efforts helped collective pre-tax earnings jump 22% to $197 million compared to the prior year. Finance and financial products. Extra and Court right-sized their businesses to account for revenues that remained unchanged from the prior year at $661 million. Earnings rebounded strongly compared to 2009, but remained below that of prior years. Pre-tax earnings of Extra increased 105% to $35 million as its utilization ratios climbed. Court swung from a pre-tax loss of $3 million to a profit of $18 million. Clayton Homes remained small but mighty. It could boast producing 47% of the industry's total manufactured homes during 2010, but context matters. This was on an industry base of just 50,046 homes compared to a peak of 372,843 in 1998. Clayton's market share then was 8%. Buffett expressed continued frustration at government policies that favored site-built homes over those of manufactured home builders like Clayton. It was harder and more expensive to get a mortgage on a manufactured home. Buffett was proud of Clayton, which was prudent in its lending. Taking a stab at the recent housing crisis, Buffett told shareholders, "If we were stupid in our lending at Clayton Homes, we were going to pay the price." Clayton retained most of its loans and was therefore incented to make good ones. Even though Clayton lent to people with questionable credit scores, its net loan losses remained remarkably stable and never rose above 2% in the prior 5 years. Its mortgage portfolio at year-end 2010 totaled $11.5 billion. Investments. Perhaps the biggest news relating to Berkshire's investment wasn't an investment, it was a person. In 2010, Berkshire hired Todd Combs to manage a portion of Berkshire's $62 billion equity portfolio. Combs came to Berkshire after working as an analyst and then running his own hedge fund, Castle Point Capital. Hiring Combs was the first step toward a succession plan that would see Buffett's job split into 3 parts: non-executive chairman, CEO, and 1 or more investment managers. Berkshire was on the lookout for 1 or 2 more individuals to join Combs. This was even more important after the retirement of Lou Simpson, the investment manager at Geico, whom Buffett kept on post-acquisition and praised as one of the investment greats. Berkshire's equity portfolio changed little in 2010. The biggest change was an investment in Munich Re, a German reinsurer. Berkshire reported a cost basis of $2.9 billion at year-end. In 2010, the country and the world were climbing out of the depths of the recession. An unfortunate consequence of this was the probable redemption of many of the large and highly profitable investments Berkshire had made during the prior 2 years. Its customized investments in Swiss Re, Goldman Sachs, General Electric, and Wrigley would soon be redeemed by those companies as redemption periods approached and credit markets provided more favorable terms. Goldman Sachs had already stated its intention to do so. The only thing holding it back was the Federal Reserve, which was expected to relax capital restrictions implemented during the recession. Even after accounting for large redemption premiums, these companies would have to pay to break their financing arrangements with Berkshire. The conglomerate would be worse off. Interest rates had declined into the low single digits. Finding replacements for securities earning upwards of 12% would not be easy and would cut into investment income. Financial Crisis Inquiry Commission Interview. In May 2010, members of the newly formed Financial Crisis Inquiry Commission interviewed Warren Buffett in the hopes that the Oracle of Omaha might add some clarity to what caused the Great Recession and how to prevent something similar in the future. Within the transcript, which was 23 pages long, single-spaced, lay several pieces of timeless investing wisdom. Home prices as a function of replacement value. While it appeared that buying a home was a good investment because it grew in value over time, in reality the dollar was depreciating. Over time, houses reflected replacement value. When home prices began rising, others jumped on board. This eventually caused investors and others to assume home prices could only go up or at worst never decline on a national scale. When a correlated decline in home prices did happen nationally, many homeowners were left with houses they couldn't afford, and investors were left with loans that would never be repaid. Farmland. Another real estate-related example. Buffett personally purchased a farm from the FDIC in 1986 because a bank had overlent to many similar borrowers and subsequently went under because of poor underwriting standards. Buffett's analysis was as piercingly insightful as it was simple. The bank lent a farmer $2,000 per acre to buy a farm producing a normalized $60 per acre when interest rates were 10%. How could disaster not occur when the asset produced a loan yield of 3%? Buffett purchased the farm from the bank for $600 an acre, a 10% yield on cost. As of 2020, he still owns it almost 35 years later. Hedging at Burlington, Northern Santa Fe. Buffett told the commission that if he were running BNSF, he would not hedge fuel costs, a major input cost at the railroad. Why? Because over time the pluses and minuses cancel out, and what's left? The frictional cost of the hedging program. Buffett knew why managements use hedging. It allowed for smooth earnings, which Wall Street rewarded. No substitute for U.S. Treasuries. At Berkshire, there were no substitutes for treasuries. Even if a little more yield could be had investing surplus cash in commercial paper, Berkshire would not do it. Why? Because I, Buffett, don't know what can happen tomorrow. Tomorrow for Berkshire, like that of the United States and the world, held much promise. 2011. In 2011, Berkshire broke its 2-year losing streak against the S&P 500, outpacing the benchmark by 2.5%. Its overall gain of 4.6% caused its compounded annual gain since 1965 to fall below 20% to 19.8%. While this made it middle ground year, Buffett felt good about Berkshire's progress. Insurance delivered the all-important negative cost of float, and float grew yet again. The year saw improvements in Berkshire's various non-insurance operating businesses, though those tied to construction still lagged. Berkshire made 3 large investments in 2011, buying Bank of America preferred stock, investing in International Business Machines, IBM, and acquiring Lubrizol Corporation. The Lubrizol acquisition brought a rare scandal involving a longtime Berkshire lieutenant. Berkshire's stock price continued to flounder, and Buffett again included several not-so-subtle hints at Berkshire's value in his chairman's letter. He also presented a novel solution, at least for Berkshire. Berkshire announced it would repurchase its shares up to 110% of book value. Just the year before, Buffett had told shareholders not a dime of cash has left Berkshire for dividends or share repurchases during the past 40 years. That changed in September 2011 when Berkshire repurchased $67 million of its own stock over a 2-day period. Why? Buffett said he favored share repurchases under 2 conditions. A company has ample funds, which for Berkshire at the time was cash equivalent holdings above $20 billion, and the stock is selling at a discount to the company's intrinsic business value when calculated conservatively. Under these circumstances, share repurchases increase per share intrinsic value. The $67 million was the amount purchased before the price advanced beyond the 110% limit. The purpose of Buffett's commentary and the share repurchase announcement was not to have Berkshire shares trade at high price. Over the years, Buffett had at times signaled to the market that Berkshire stock was fully priced. Instead, Buffett and Munger wished to have Berkshire's share price trade near its intrinsic value. Not too high, not too low, so shareholders' financial results would strongly match that of Berkshire's underlying business results. Lubrizol Corporation. Berkshire acquired Lubrizol on September 16, 2011. The company was based in Cleveland, Ohio, and was founded in 1928. Lubrizol was a specialty chemical company that provided additives and advanced materials to industries, including transportation, industrial, and consumer markets. Buffett may not have fully understood what the company did, but he loved its superior economics. Between 2004 and 2011, pre-tax profits increased almost tenfold to slightly over $1 billion. It struck me as a business I didn't know anything about initially. You're talking about petroleum additives. I never would understand the chemistry of it, but that's not necessarily vital. Lubrizol had survived a long period of industry consolidation to become the leader in a relatively small market. Lubrizol's financial results reflected this. Its return on capital were consistently above 20% and shot up to over 45% in 2010, the year before Berkshire acquired it. Its financial statements show that major non-production costs remained in check, while the top line continued to grow in the double digits. See Table 7.20. Additionally, the company's connection with customers, including that it often partnered with them to create additives when new engines were developed, gave it a sustainable competitive advantage. Buffett's beloved moat. Lubrizol also provided a product that was very cheap compared to the exponential impact it had on performance of an end product. Lubrizol's price reflected its excellence. Berkshire paid $8.7 billion for the company. Considering the debt assumed in the acquisition, the purchase price reflected a multiple of 4 times the underlying capital in the business. Such a price seemed to lend confidence to the company's level and sustainability of recent profits. Buffett made it clear how the acquisition should be judged. You have to judge us based on close to a $9 billion investment. You have to judge CEO James Hambrick in running the business based on the much lower capital that he has employed. It also costed a leading lieutenant, who many suppose was a leading candidate to someday succeed Buffett as Berkshire CEO. The full story is long and nuanced, but amounted to this. David Sokol, who first came to Berkshire with the Mid-American acquisition, had recently been put in charge of NetJets, purchased stock in Lubrizol just before recommending Berkshire buy it. Sokol's actions suggested a significant lapse of judgment rather than an attempt to make short-term profit. But the hit to Berkshire's reputation cost Sokol his job. He resigned. Buffett had a rule of thumb that employees would be willing to have their actions appear on the front page of the paper. This was not the kind of attention Sokol wanted. Just a year before, Buffett had included a copy of biennial letter sent to Berkshire's managers at the end of 2010 annual report. The 2-page letter emphasized the priority of each Berkshire employee. The priority is that all of us continue to zealously guard reputation. We can't be perfect, but we can try to be. As I've said in these memos for more than 25 years, we can't afford to lose money, even a lot of money, but we can't afford to lose reputation, even a shred of reputation. Insurance. Berkshire's insurance group delivered once again. Earned premiums grew 4% to $32 billion. Float grew 7% to $70.6 billion and came with underwriting profits. Profits declined from $2 billion in 2010 to just $248 million in 2011, but the result was even more impressive amid a backdrop of continued weak pricing industry-wide and several large catastrophes. Remember, even break-even insurance results produce a significant economic benefit because of its float. All of Berkshire's insurance units cited a constraint in volume due to pricing. Berkshire Hathaway Reinsurance Group. Most of the newsworthy events took place at Berkshire Hathaway Reinsurance Group. 3 of its 4 lines of business reported losses, all for different reasons, putting BHRG in the red for 2011 to the tune of $714 million on earned premiums, which remained flat at $9.1 billion. Catastrophe and individual risk pricing remained soft. A few new contracts and higher pricing on renewals led to earned premium growth of 21% to $751 million. Major earthquakes in Japan and New Zealand caused losses of $800 million, which led to a pre-tax underwriting loss of $321 million compared to a profit of $260 million a year before. Such a swing in profits was not atypical, as a year with major catastrophes worldwide was expected from time to time. Earned premiums and other multi-line grew 22% to $4.2 billion, largely due to the 20% quota share agreement with Swiss Re. The same 2 earthquakes that impacted catastrophe and individual risk, in addition to floods in Thailand, caused another $933 million of catastrophe losses. After $455 million of profits on other contracts and foreign currency gains of $140 million, other multi-line reported an underwriting loss of $338 million compared to a profit of $203 million a year before. The life and annuity line booked a $642 million charge relating to its contract with Swiss Re Life and Health to fix incorrect assumptions relating to mortality rates at the inception of the contract. Pre-tax losses in the segment ballooned from $197 million a year before to $700 million in 2011. Earned premiums declined 9% to $2.2 billion, with most from the Swiss Re contract, as well as from the acquisition of Sun Life Insurance Company of Canada from its parent company. Retroactive insurance was BHRG's only line in the black in 2011, reporting a $645 million underwriting profit compared to a loss of $90 million a year before. Premiums earned of $2 billion, down 23%, came mostly from a $1.7 billion retroactive contract with a subsidiary of American International Group, AIG. Since it was a retroactive contract, there was no immediate profit or loss associated with it. The primary reason for the large profit was an $865 million reduction in its estimated liability associated with the 2009 Swiss Re contract. This was a separate contract from the one above and covered Swiss Re's non-life insurance losses prior to 2009. General Re. General Re managed to earn a profit in both its major reporting lines despite similar catastrophe losses as BHRG and the weak pricing environment. It reported a pre-tax underwriting gain of $144 million compared to $452 million a year before. Earned premiums grew 2% to $5.8 billion. The property casualty line eked out a $7 million profit, even with $861 million of catastrophe losses. Profits of $741 million on other property casualty contracts and $127 million from casualty workers' compensation resulted in the small profit. Earned premiums were flat at $2.9 billion. Gen Re's Life Health Unit increased earned premiums 6% to $2.9 billion on strength in international markets. It benefited from favorable mortality in its life business and reported another profitable year with a gain of $137 million compared to a gain of $163 million the year before. Geico. Geico's profitability waned but remained impressive. Both policies in force and premiums grew as the company captured a 9.3% market share, up from 8.8% in 2010. Geico's combined ratio crept up 4.1 percentage points, but remained at a very satisfactory 96.3%. The main culprits were higher injury and physical damage severities. A $143 million increase in catastrophe losses to $252 million also caused the loss ratio to increase. Berkshire Hathaway Primary Group. The primary group turned in a 14% underwriting gain, earning $242 million on premiums of $1.7 billion, compared to a profit of $268 million on similar premium volume the year before. MedPro and Implied Underwriters both reported favorable loss experience that bolstered results for the group. Berkshire's home state insurers reported another year of losses, but no reasons were given. At the end of 2011, MedPro acquired Princeton Insurance, a New Jersey-based professional liability insurer. Princeton had annual written premiums of $140 million, surplus of $400 million, and brought $600 million of float. The price was not disclosed. Manufacturing, service, and retailing. Results in the MSR group reflected America's slow crawl out of the recession. The overall result, adjusting for Lubrizol, was a clear rebound in pre-tax earnings and an increase in return on tangible capital from 19.5% to 24.2%. The after-tax return on tangible equity improved from 17.3% to 22.9%. Even considering the full purchase price of these businesses, i.e. including goodwill, after-tax return on equity improved 1 percentage point to 8.9%. But those results also included the 4 housing-related companies which remained in distress state. See Table 7.22. Marmon continued to impress with revenue increases of 16% to $6.9 billion and pre-tax earnings rising 22% to $992 million. Marmon's CEO, Frank Tack, continued to expand the 140-business conglomerate with bolt-on acquisitions, including a recent partnership in an Indian crane company. Just one of Marmon's 11 sectors reported lower revenues and earnings. Reduced purchases by its largest customer led to weakness in the retail store fixture sector. When Berkshire purchased 60% of Marmon in 2008, it also agreed to acquire the remainder of the company over time with the price tied to a multiple of earnings. This multiple was not made public, but Berkshire's subsequent transaction shed light on it. Berkshire spent $1.5 billion to buy 16.6% of Marmon in early 2011, implying a valuation of $9 billion for all of Marmon. That suggests a pre-tax multiple of 11 times 2010 earnings, or an earnings yield of about 9%. Berkshire's growth gradually squeezed many large businesses into its other categories. Even Shaw, a business with annual revenues of $5 billion, had succumbed to that financial fate in 2010. Smaller businesses shared this fate in earlier years or immediately went below the surface unless Buffett chose to highlight them. One in particular was CTB, the agricultural equipment company managed by Vic Mancinelli. Since Berkshire's 2002 purchase for $139 million, the company had sent Berkshire $180 million, earned $124 million pre-tax in 2011 alone, and had $109 million cash on the books. It was quite a record. As good as CTB's accumulative record was, it did not come close to that of See's. Berkshire's purchased See's in 1972 for $25 million. See's had earned a total of $1.65 billion pre-tax, including $83 million in 2011 alone. No wonder Buffett referred to the managers of Berkshire's various operating subsidiaries as members of the all-star team. Jordan Hansel took over as head of NetJets after David Sokol resigned. The business had another good year with pre-tax earnings up 10% to $227 million. Nebraska Furniture Mart had good news, and it wasn't just for record-setting earnings, coming in at 10 times the amount it earned when Berkshire purchased it in 1983. The big news was its newly acquired 433-acre plot of land north of Dallas. The company planned to construct another megastore that was expected to rival that of its Omaha, Nebraska and Kansas City, Missouri stores. Each of those stores had revenues of over $400 million in 2011 and ranked among the largest, if not the largest, furniture retailers in the United States. Nebraska Furniture Mart's expansion coincided with its familial expansion, now with a fourth generation involved in the business. Regulated capital-intensive businesses. Berkshire's share of net earnings from Mid-American, which included interest on debt owed to Berkshire, grew 6% to $1.2 billion. Mid-American's EBIT grew at the same rate to $2 billion. Utilities may be boring by design, but the earnings were not. Northern Power Grid, the United Kingdom-based distribution unit, grew earnings before interest and taxes by 41%. Part of the increase was a result of real improvements in the business, but a weaker dollar also made its earnings look comparatively bigger. Berkshire's ownership of Mid-American provided a tax advantage over other utilities. It could fully utilize tax credits because income tax was paid at the holding company level, and Berkshire had a large base of taxable income. Other utilities often had little or no taxable income because tax rules already allowed them to accelerate depreciation on investments. Mid-American was therefore incentivized to invest in renewable energy projects. At the end of 2011, Mid-American committed to 2 solar projects, one in California, one in Arizona, and had committed to $6 billion to wind generation. That would make the utility the largest wind generator among regulated utilities nationwide. Results for BNSF reflected the general improvement in the American economy. Unit volume increased 7% in both consumer and industrial product categories, offset by a 4% decline in coal. Agricultural volumes were flat. The resulting 3% increase in volume and 12% increase in revenues per unit combined to grow revenues 16% to $19.5 billion. Pre-tax earnings jumped 19% to $4.7 billion as operating expenses remained in check. This was even more impressive considering efficiencies lost due to severe weather, including over key coal routes that caused flooding. BNSF's operating performance was better than at first glance. Usually, once a subsidiary is acquired by another, much detail is lost. This was the case with many of Berkshire's acquisitions, but not the utilities. BNSF and Mid-American had to report to the Securities and Exchange Commission because they are regulated utilities with public debt. Remember the discussion of deferred taxes from 2010? BNSF's 10K filing for 2011 revealed that it incurred a $1.8 billion tax on $4.7 billion of pre-tax income. Of that amount, just $260 million was due currently, meaning a full $1.5 billion was deferred and remained in BNSF's checkbook. Huge outlays for capital expenditures, including $3.3 billion or over twice depreciation charges in 2011, would create favorable economic outcomes for years. Finance and financial products. The performance in this segment was buoyed by a return to profitability of Court and Extra. Berkshire's 2 leasing companies grew earnings almost threefold to $155 million. This reflected the significant operating leverage, fixed costs as a percentage of total costs, the companies had as part of their business models. It took just 12% revenue growth to drive the largest increase in profits. Clayton struggled in 2011. The culprits were a combination of lagging home sales, causing units sold to decline 14%, a consumer shift toward more of Clayton's lower-priced units, and the government subsidiary of mortgages on traditional stick-built homes. On top of that, a federal tax credit program expired the previous year. Clayton's 12.5% decline in pre-tax earnings to $154 million did not look so bad considering these challenges. Buffett said he expected Clayton's earnings to improve once the country's excess housing inventory was worked off, but he also said the intrinsic value of Clayton, Extra, and Court were not significantly different than their current book value, providing another hint at their intrinsic value. These were good businesses, but there was no hidden value in them like Geico or Sears. Investments. Buffett characterized the changes to Berkshire's investments in equities as few but important. The first was a purchase of 63.9 million shares of International Business Machines, IBM, that cost $10.9 billion. This was the largest outlay for a single security Berkshire had ever made. It represented a 5.5% ownership interest in IBM and almost 7% of Berkshire's average equity capital. Buffett said it took him only 50 years of reading IBM's annual reports to gain enough comfort to buy its stock. What did he see in IBM? Here are 3 things. 1. A long history. IBM had reinvented itself many times over the years. Its strong track record, including results through 2010 that seemed to back the assertion it had a strong competitive position, was reason to believe its recent good performance would continue. 2. Low capital requirements. IBM was not capital intensive and its capital efficiency was improving. 3. Shareholder-friendly management. The company returned over $56 billion to shareholders in dividends and net share buybacks over the previous 5 years, including $14.8 billion in 2010 alone. Bank of America was another major equity investment in 2011. A $5 billion preferred stock investment carried a 6% dividend rate and warrants to purchase 700 million shares of Bank of America stock at $7.14 per share. Buffett initiated the investment thinking Bank of America and Berkshire could benefit. Berkshire would lend the Buffett seal of approval to a bank Buffett saw as very good, but which Wall Street found unattractive due to prior troubles. Buffett conveyed some insight into how he generated investment ideas. He said he dreamed up the Bank of America investment while in the bathtub. Better yet, when he went to communicate his idea to Bank of America CEO Brian Moynihan, he first tried reaching him through the call center. Buffett's assistant ultimately contacted the right parties at Bank of America to get Moynihan on the phone. Berkshire also added $1 billion to its stake in Wells Fargo. This brought its investment to 7.6% of the West Coast Bank. Buffett was candid about some negative developments at Berkshire during the year. One was the $2 billion investment in Energy Future Holdings, an electric utility based in Texas. That was a mistake. A big mistake. Why? Because the company's future was tied to natural gas prices, which tanked after Berkshire purchased it. The investment was written down to $878 million at year-end. Another negative was the return of capital from Swiss Re, Goldman Sachs, and General Electric, 3 of the unique negotiated investments Berkshire made during the tough years of the Great Recession. Each company paid Berkshire a premium for calling them away early, but the income they generated would be hard to replace in the prevailing low interest rate environment. The 10-year Treasury note dipped below 2% at the end of 2011. In 2011, Berkshire hired Ted Weschler to join Todd Combs in managing a portion of Berkshire's investment portfolio. Like Combs, Weschler ran his own hedge fund, Peninsula Capital Advisors, before joining Berkshire. To incentivize the managers and foster collaboration, Buffett compensated each manager with a base salary and a performance fee benchmarked to the S&P 500, with 80% tied to individual performance and 20% to the other man. Berkshire made another investment in 2011 that largely went under the radar. In June, Berkshire acquired the remaining 20% of Wesco Financial Corporation it did not already own. It paid $543 million, including $298 million cash and the remainder in Berkshire shares. Munger remarked that he felt Wesco had finally arrived at its port. 3 investment choices. A section of Buffett's 2011 chairman's letter contained an investing lesson. In it, Buffett sought to convince readers that ownership of productive assets was the only sure way to prosper over the long run. He lumped the investing universe into 3 categories, and his main takeaways were as follows. 1. Currency-based investments. These included cash, money market funds, bonds, and mortgages. The key takeaway here was the ravaging effect of inflation. Nations had a clear bias toward inflation, and this meant the purchasing power of any investment in this category would likely go down over time. Berkshire would only make such investments if there were prospects for large gains. Berkshire's large holding in U.S. Treasuries would remain, no matter how low the interest rate, as a near guarantee of liquidity for when cash was needed. 2. Commodities. This category included anything that did not produce, the most well-known example being gold. The logic was compelling. If you own 1 ounce of gold for an eternity, you will still own 1 ounce of gold at its end. Gold and other commodities were usually held by those fearful of runaway inflation, or because they thought others would buy it from them at a higher price. A visualization really drove home the point. All the gold in the world could be melted together into a 68-foot square cube worth $9.6 trillion that would never grow. Instead, at the current price of gold, one could buy all the farmland in the United States, 400 million acres, 16 ExxonMobil-sized companies, and have $1 trillion left over. 3. Productive assets. This category included businesses, farms, and real estate. Continuing the example from above, a century in the future, the gold would still be sitting there while the ExxonMobil-sized companies and farmland would continue producing. Such productivity would remain no matter what the currency or how much it was depreciated. Buffett's logic led him to one conclusion. Over the long run, this category of assets was by far the safest. He called them commercial cows and said they would live for centuries and give ever greater quantities of milk to boot. Their value would be determined not by the medium of exchange, but rather by their capacity to deliver milk. Once again, Buffett displayed his penchant for teaching and logic. He wanted shareholders to know he was comfortable with uncertainty and that investments made based on sound economic reasoning may not be foolproof, but were most likely to be profitable. Those who preferred a short game and more certain outcomes were likely to disagree, but Berkshire Hathaway was living proof that Buffett's logic was very profitable. 2012. When the partnership I ran took control of Berkshire in 1965, I could never have dreamed that a year in which we had a gain of $24.1 billion would be subpar, but subpar it was. This was Buffett's way of explaining why the enormous gain in book value, 14.4%, was not as good as it seemed. Why? Because it fell behind the S&P 500 for the 9th time in 48 years, 1.6 points in 2012. Berkshire's performance over longer periods held, however. It outperformed the S&P 43 consecutive times when measured in 5-year stretches. We do better when the wind is in our face, he said. The statement reflected Berkshire's ability to invest large sums when the stock market is weak and willingness to write large volumes of insurance during times of acute stress. Buffett also lamented that he had come up short yet again in finding a major acquisition. But it wasn't all bad news. Each of the major operating segments reported higher earnings despite some mixed results within each category. That included the insurance group, which produced underwriting gains in each insurance unit. While Buffett may have failed to land an elephant-sized acquisition, Berkshire did make numerous investments in 2012. 1. $2.3 billion. 26 companies acquired via bolt-on acquisitions that were folded into existing operations. 2. $1.4 billion, an additional 10% of Marmon. 3. $4.6 billion, capital expenditures in excess of depreciation, mostly concentrated within the capital-hungry railroad and utility operations. 4. $1.3 billion, repurchases of Berkshire shares. 5. $712 million, net increase in equities, including $2.6 billion additional investment in IBM and Wells Fargo. Berkshire shares remained undervalued despite meaningful business progress. During 2012, shares traded between $113,855 to $136,345, compared to an estimated intrinsic value that approached $195,000. Berkshire took advantage of the opportunity to buy back 9,200 Class A shares, spending $1.3 billion or $131,000 per share. Buffett provided no ambiguity on his conviction that Berkshire shares were undervalued. It's hard to go wrong when you're buying dollar bills for 80 cents or less. Berkshire's share repurchases in 2011 and 2012 were also a subtle admission it had excess capital. The repurchases were only incidental to this fact, although its inability to put large amounts of capital to work could have weighed on the share price. Berkshire would have not repurchased shares if they weren't meaningfully undervalued. Dividends, at least for the moment, remained off the table as a means for returning capital to shareholders. Buffett took 3 pages of his chairman's letter to explain why. 1. Berkshire's price-to-book value in the market allowed more than $1 of value to be created for every dollar retained. Paying out retained earnings and dividends meant a loss of value. Shareholders could choose their own dividend policy by selling shares. Not only would they receive more because of the premium-to-book value above, but Berkshire would not impose one dividend policy on all shareholders. Some shareholders were in accumulation mode and didn't want a dividend, while others might wish to sell shares equal to the entirety of earnings each year or more. 3. Dividends are taxed in their entirety, while the capital gains tax only applied to the gain over one's cost basis. Shareholders wishing to retain capital in Berkshire would have to pay tax on the dividend and invest it back in at a premium to the underlying book value. Buffett used the example of his regular donations of Berkshire shares to illustrate how a sell-off approach made more sense. Since 2006, he had donated an average of 4.25% of his shares to philanthropy. His ownership in Berkshire since that time had fallen from 712 million shares, B equivalent, to 529 million shares, down 26%. Yet his investment in Berkshire in dollar terms had risen from $28.2 billion to $40.2 billion, up 43%. That was because the retained earnings in Berkshire more than offset the annual selling of shares. Buffett was clear that Berkshire would always consider a dividend when it made sense, but for the time being, shareholders were left with a viable yet non-intuitive way to receive capital from their investment in Berkshire. Buffett also used the example of purchasing BNSF, what he called a whale, which would benefit shareholders for years to come and was only possible because Berkshire did not pay dividends and had cash on hand. Insurance. Our insurance operations shot the lights out last year, Buffett said, using a familiar phrase to describe 2012. The insurance group delivered its 10th consecutive year of underwriting profit. Over that time, Berkshire's insurers delivered a total of $18.6 billion of pre-tax underwriting profit, which came on top of billions of dollars of incremental float. Not all 4 major units had a positive underwriting result each year, but in 2012 they did, with pre-tax earnings totaling $1.6 billion. They also proved Buffett wrong. He had written in his previous chairman's letter that float was not likely to grow very much from its base of $70.5 billion, yet float grew 3.6% to $73 billion. These results were even more impressive considering significant losses from Hurricane Sandy, pre-tax costs of $1.1 billion, and other natural disasters, and continuing soft reinsurance pricing. The insurance group was built to withstand anything and ended the year with a statutory surplus of $106 billion. Geico. Geico led the pack. Its $680 million underwriting profit and combined ratio of 95.9% was even better than at first glance. Geico faced $490 million of catastrophe losses from Hurricane Sandy alone, which inflicted 3 times the loss Hurricane Katrina had in 2005 because of its large market share in the New York area. Geico's results were also penalized by an accounting change. Effective 2012, U.S. accounting rules eliminated the inclusion of most advertising costs and deferred premium acquisition costs. For 2012, that rule added $410 million of expenses compared to the prior method. The 2 factors above weren't enough to counter earned premium growth of 9% and growth in policies in force of 6.5%. Had the accounting change not been made, Geico's combined ratio would have been 93.5%, even with the losses from Sandy. The losses from Sandy also offset lower claim frequencies, including a 10% drop in comprehensive coverage frequencies. General Re. General Re increased earned premiums 1% to $5.9 billion, which were negatively affected by currency effects. Its pre-tax underwriting gain grew from $144 million in 2011 to $355 million in 2012. Property casualty earned premiums were flat at $2.9 billion. Underwriting profits bounced back to a pre-tax gain of $399 million from a near break-even $7 million gain the prior year. Property businesses reported a profit of $352 million, despite $266 million of catastrophe losses tied primarily to Hurricane Sandy, an earthquake in Italy, and tornadoes in the Midwest. Casualty workers' compensation reported gains of $47 million. General Re's life health line reported its first loss since 2002, with a loss of $44 million from changes in reserves on prior business line and worsening results in Australian business line. Premiums grew 3% to $3 billion. Berkshire's culture of conservatism is illustrated by its reserve adequacy compared to other insurers. At year-end 2012, General Re's recorded liability for mass tort claims, those relating to mass claims for asbestos and hazardous waste claims, totaled $1.2 billion. Over the previous 3 years, its payouts averaged $80 million. That meant General Re had reserved over 15 years of estimated payouts. This ratio is called the survival ratio, how long the reserves will survive the current payout. The industry survival ratio, by contrast, was just 8.8 years. Berkshire Hathaway Reinsurance Group. Results at Berkshire Hathaway Reinsurance Group reflected some of the same changes as its reinsurer sister company. Ajit Jain's group found ways to increase business even with self-imposed constraints on volume due to weak pricing. It bounced back from an overall loss of $714 million in 2011 to a $304 million profit in 2012 on premiums that grew 6% to $9.7 billion. Catastrophe and individual risk returned from an underwriting loss of $321 million to earn $400 million on earned premiums that grew 9% to $816 million. That was after $96 million of losses from Hurricane Sandy. Premiums in the retroactive line fell sharply from $2 billion in 2011 to $717 million in 2012, mostly due to the large contract with AIG the prior year. Volume in 2012 came from several smaller contracts. A $201 million loss in that segment was mainly due to deferred charge amortization stemming from previous contracts. Other multi-line property casualty improved from a $338 million loss to a $295 million gain, even after $268 million in catastrophe losses from Hurricane Sandy. Premiums grew 26% to $5.3 billion. This year would mark the last of the 4-year 20% quota share arrangement with Swiss Re, which was responsible for $3.4 billion of premium volume in 2012. New contracts increased BHRG's life health earned premiums 31% to $2.8 billion. Its underwriting loss improved from a loss of $700 million in 2011 to $190 million in 2012. Losses from life insurance amounted to $12 million, an improvement from the $582 million loss in 2011, which was from the large reserve adjustment that year. Annuity losses were $178 million, and largely due to accounting charges. Berkshire Hathaway Primary Group. For once, the excitement in the primary group was due to more than financial results. Though those were again very good, the segment now included a full year of business from Princeton Insurance, the professional liability insurer Berkshire acquired at the end of 2011. In the fourth quarter, the primary group also welcomed Guard Insurance Group, a provider of commercial property and casualty insurance coverage to small and mid-sized businesses. Guard was based in Wilkes-Barre, Pennsylvania, and had premium volume of $300 million. Purchase price was $221 million, about its book value at that time. With the two newcomers in place, premiums in this segment grew 29% to $2.3 billion, and profits grew 18% to $286 million, 87% combined ratio. Manufacturing, service, and retailing. The MSR Group continued to make progress. Including a full year of results from Lubrizol, pre-tax earnings increased 22% to $6.1 billion and represented a return on average tangible capital of 25.3%, up from 24.2%. After-tax earnings increased at the same rate to $3.7 billion and represented a 21.4% return on average tangible equity, down from 22.9%, an impressive result considering the business employed on average just 15% of debt compared to equity capital. There were pockets of difficulty, but overall the MSR businesses rebounded from the recession. Marmon increased revenues 3.6% to $7.2 billion and pre-tax earnings 14.6% to $1.1 billion. A quarter of the increase in profits came from increased operating margins and the rest from bolt-on acquisitions. Marmon, like Berkshire's insurers, focused on profitability first and foremost and had an eye on expanding into specialized niche markets that allowed a high operating margin and good returns on capital. Marmon's growth caused the purchase price for the remainder of the company to go up. Berkshire acquired another 10% of Marmon from the Berskhire family during the fourth quarter of 2012. This brought its ownership to 90%. Berkshire paid $1.4 billion, but Buffett said the purchase price implied a valuation of $12.6 billion. Buffett's figure is consistent with the 11 times multiple Berkshire paid in 2011 for an additional 16.6% of the company. McLean, Berkshire's distribution business, made a large acquisition of its own in 2012 that increased revenues and earnings. On August 24, 2012, it acquired Meadowbrook Meat Company Incorporated of Rocky Mount, North Carolina. The purchase price was not disclosed. Meadowbrook Meat Company provided food distribution to national restaurant chains and had annual revenues of $6 billion. Including the results from the acquisition, McLean's revenues grew 12.5% to $37.4 billion, and pre-tax earnings increased 9% to $403 million. Berkshire's other manufacturing businesses rebounded moderately, but there were pockets of weakness. Revenues increased 26% to $26.8 billion, and pre-tax earnings increased 38% to $3.3 billion. Excluding Lubrizol, revenues and earnings both increased 6%. Forest River, the recreational vehicle manufacturer, increased revenues 27% on higher volumes and pricing. That was an indication the U.S. consumer was in better shape. Building products revenues increased just 4%, continuing their slow ascent from the depths of the recession. Shaw benefited from higher sale prices and stable input prices. Weak commercial and industrial business hurt results at Scott Fetzer, ISCAR, and CTB, with slowing economies overseas impacting the latter two particularly. Buffett took the rare action of replacing a manager of Benjamin Moore, one of Berkshire's autonomously operated subsidiaries, in the building product segment. The CEO of Benjamin Moore made strategic moves that threatened the company's independent network of dealers. This included the deal to have its paint sold in a major home improvement store. That was contrary to the promise Buffett made when Berkshire acquired the company in 2000 to soothe fears that Berkshire would shift away from its longtime distribution system of independent dealers. The incident proved there were limits to the autonomy Buffett would afford his managers and showed how closely he guarded Berkshire's and his own reputation. Revenues in the other services segment grew 10% to $8.2 billion, mainly due to the inclusion of bolt-on acquisitions at TTI and the BH Media Group, which is discussed below. Pre-tax earnings fell 1% to $966 million despite the acquisitions from weak demand and intense competition at TTI. NetJets and Flight Safety, the two aircraft-related businesses, performed on par with the prior year. Retailing was up slightly in 2012, with revenues and pre-tax earnings growing 4% to $3.7 billion and 2% to $306 million, respectively. Results were bolstered by the acquisition of Oriental Trading Company on November 7, 2012, for $500 million. The retailer sells party supplies, school supplies, toys, and novelty gifts. Buffett's discussion of the MSR businesses in his chairman's letter highlighted a flaw he saw in Generally Accepted Accounting Principles, or GAAP. He thought amortization charges were an area that analysts should pay close attention to, since there were some important divergences from underlying economics. GAAP previously required the amortization of goodwill, which Buffett disagreed with, but amortization still applied to some items from business acquisitions. One such item was amortization expense related to customer relationships, which was not a real expense. Other intangibles were very real. Buffett used the example of software that would become obsolete over time as a real amortization expense. He said he included just 20% of the year's GAAP amortization expense in the table presented in the chairman's letter that laid out results for the MSR businesses. The full amount was included with the GAAP-compliant results presented in the financial statements. Buffett's goal was to provide shareholders with the clearest view of how their businesses were performing and that meant thinking hard about how to translate the language of accounting into economic reality. Regulated capital-intensive businesses. As large and important as they were, representing 24% of Berkshire's total assets and 37% of pre-tax operating income in 2012, Mid-American and BNSF's results do not require much discussion from year to year. That's as it should be. Both were purchased to provide limited but stable earnings year in and year out. Still, some commentary is appropriate. BNSF increased revenues 7% to $20.8 billion and pre-tax earnings 13% to $5.4 billion. Increased pricing, up 4%, and volume, up 2%, resulted in the top-line growth, and operating leverage swelled the bottom line. The modest unit growth masked a 13% increase in industrial products volume from petroleum and construction products and a 6% decline in coal shipments. Consumer products unit volume increased 4%, and agricultural products declined 3%. BNSF spent $3.5 billion on capital expenditures during the year. The sum was more than double its $1.6 billion depreciation expense, and proof that BNSF and Berkshire saw opportunity ahead. Berkshire's share of Mid-American's after-tax earnings grew 10% to $1.3 billion. The company continued to take advantage of tax incentives and invest in renewable projects, making an analysis of after-tax earnings more useful than a strict EBIT analysis. EBIT declined 1% to $1.6 billion. Mid-American generated 6% of the wind power in the U.S. and would have 14% of all solar production when several projects were completed. In all, Mid-America's renewable portfolio cost $13 billion. The company spent $3.4 billion on capital expenditures during 2012, compared to depreciation of just $1.4 billion. That was another reminder of something Buffett often alluded to. Money will always flow toward opportunity, and there is an abundance of that in America. Mid-America's home services business increased pre-tax earnings 110% to $82 million. While small, it is noteworthy for a view into the housing industry. Home services participated in $42 billion of home sales in 2012, up 33%. The company also purchased 2/3 of a Prudential franchise operation that would further increase business. Home Services planned to rebrand itself Berkshire Hathaway Home Services, taking advantage of the Berkshire brand. Finance and financial products. Pre-tax earnings in the finance and financial products segment jumped 10% to $848 million. Earnings were buoyed by Clayton Homes, which increased its pre-tax earnings 66% to $255 million. That was despite the continued headwind from subsidies given to traditional home manufacturers. During 2012, Clayton sold 14% more units, but at a lower average selling price, which increased overall revenues 9%. Earnings ballooned for 3 reasons. Increased unit volume, allowing for manufacturing efficiencies. Lower insurance claims and lower credit losses bolstered the bottom line. Lower interest rates on borrowings more than offset the lower earnings from its loan portfolio. Combined pre-tax earnings at Berkshire's 2 leasing companies fell 5% to $148 million. This result followed an almost tripling of earnings the prior year. The decline in 2012 was from additional depreciation expense at Extra and due to lower foreign exchange gains. The additional depreciation stemmed from investments Extra was making in its business to take advantage of future opportunities. Like its larger sister companies, Mid-American and BNSF, Extra spent twice its annual depreciation expense, or $256 million, on capital expenditures during the year. Some business leaders use the uncertain economic landscape to justify holding back on investing. Buffett said Berkshire didn't hold back. While competitors fret about today's uncertainties, Extra is prepping for tomorrow. Pre-tax earnings in the other category were greater than Clayton's. This collection of assets generated solid profits every year. In 2012, these amounted to $445 million, down 4% from the year before. They included Berkshire, Berkshire's 50% commercial mortgage servicing partnership with Leucadia National Corporation, and a portfolio of bond and stock investments Buffett managed himself. Also included were charges to Clayton for use of Berkshire's credit and the guarantee fee paid by NetJets. Investments. There was modest activity in the investment portfolio during 2012. Berkshire pared down its stake in ConocoPhillips, an oil producer, by $800 million, while increasing its investment in IBM by $824 million, Wells Fargo by $1.8 billion, and Walmart by $944 million. One new name on the list, DirecTV, wasn't purchased by Buffett. Either Todd Combs or Ted Weschler made the $1.1 billion investment. Buffett wouldn't say. Each man managed around $5 billion for Berkshire by year-end. Newspapers. Berkshire's purchase of 28 daily newspapers for $344 million, around but not entirely in 2012, caused some to scratch their heads. But the purchases, which included Buffett's hometown newspaper, the Omaha World Herald, provided lessons on investing and a history of the media industry. Buffett summed it up this way. News, to put it simply, is what people don't know that they want to know. The longer historical version included how newspapers used to be powerhouses before the television and internet ages. What people then didn't know was a lot, and newspapers were the only source for sports, stock prices, and local and national news. This primacy attracted advertisers, and newspaper owners made a lot of money, including Berkshire with the Buffalo News. Slowly but surely, television and the internet came along and provided a faster and cheaper way to deliver news. With each passing year, more and more people dropped their subscription. The downward spiral of fewer readers led to fewer advertisers, leading to lower profits, and so on. Buffett thought just a few newspapers would ultimately survive and would need to adapt to the online world. Big national newspapers such as the Wall Street Journal, the New York Times, and the Washington Post would all do well. So would the smaller local papers that provided information readers couldn't get anywhere else. They would also struggle, but newspapers in the tightly knit communities had the best chance. Buffett readily admitted nostalgia played a part in the purchase. After all, he loved reading newspapers and had even delivered two as a boy. But as a businessman, the financials mattered too. Newspapers were shrinking. Buffett said their earnings were certain to decline. So why would he buy them? At a low enough price? The economics made sense. Chapter 14, 2013 to 2014. 2013. By almost all accounts, 2013 was a very good year for Berkshire. The one glaring exception was a 14.2% underperformance to its self-elected benchmark, the S&P 500, which rose 32.4%. Buffett had anticipated Berkshire's relative underperformance in periods of strong gains by the S&P 500 and had written the prior year that Berkshire's unbroken history of beating the S&P 500 over 5-year periods could end if the market rose strongly in 2013. His confidence lay with Berkshire Hathaway's underlying businesses, which made significant and meaningful progress during the year. Continuing our methodology of estimating Berkshire's intrinsic value from earlier, Berkshire's progress was a meaningful 13% increase. Shares rose by over a third, which put the valuation beyond the 1.20 times threshold Berkshire established for repurchases. Berkshire fired on all cylinders during 2013. Its many operating businesses increased their earnings and competitive positions. Berkshire also put tens of billions of capital to work in new acquisitions. $12.25 billion for a major interest in ketchup maker H.J. Heinz, $5.6 billion for NV Energy, a large West Coast utility company, $3.5 billion for the remaining ownership interest in Marmon and Iskar, $3.1 billion for 25 bolt-on acquisitions by existing subsidiaries. In addition, Berkshire spent $11.1 billion on capital expenditures, which was $5.7 billion more than its depreciation. It also spent $4.7 billion net on equity securities. H.J. Heinz Company. On June 7, 2013, Heinz was acquired by a partnership formed between Berkshire Hathaway and 3G Capital. Buffett loved flagship brands with high, stable market shares and high returns on capital. Under this new nameplate, 3G Capital from Brazil oversaw operations, and Berkshire was the financing partner. Heinz was well known for its signature brand of tomato ketchup and had a family of other brands including sauces, soups, beans, pasta, infant foods, and Ore-Ida potato products. The company also produced licensed brands such as Weight Watchers and TGI Fridays snacks. Its business was broken down by segment. See Figure 7.4. The company was headquartered in Pittsburgh, Pennsylvania, but had worldwide operations. Geographically, about a quarter of revenues from North America, a quarter from Europe, 20% for Asia Pacific, and a remaining split between a U.S. food service business and the rest of the world. The strength of its brands was evidenced by its pre-tax return on tangible capital, see Table 7.27. Between 2009 and 2013, the company's average return on tangible capital was a mouth-watering 56%. Its flagship brand of Heinz ketchup commanded a 60% market share in the United States and even higher overseas. That the runner-up, Hunt's, accounted for just 20% was evidence of the company's dominance. Most people cannot even name a third ketchup brand. 3G Capital was a force in the investment world. The investment fund was led by Jorge Paulo Lemann, whom Buffett knew during their time serving on the Gillette board together. Prior to the Heinz deal, 3G Capital had taken Burger King private. It also created one of the world's largest beer brewers when a company it controlled, InBev, acquired the Anheuser-Busch Company. The partners of 3G Capital, which included Lemann, Alex Baring, and Bernardo Hees, were known as excellent business operators. Their key operating philosophy was zero-based budgeting, a technique that requires all expenses to be justified each period. Their past successes using that methodology and the steep price that Berkshire and 3G paid for Heinz suggested they would look to improve margins at Heinz. The total purchase price for Heinz, including debt assumed in the acquisition, was $29.1 billion. That represented a whopping 7.7 times the company's underlying tangible capital and what appeared to be low initial return in the mid-single digits. The margin of safety in the deal stemmed from the company's strong historical returns on capital. Future growth could bring the initial return up, as would any improvement in margins the team at 3G Capital could squeeze out. But the price was steep. Buffett admitted they stretched a little because of the qualities of Heinz and what they saw in the 3G Capital management team. Berkshire and 3G Capital each invested $4.25 billion, with each receiving half of the company's common equity. Berkshire also invested $8 billion in a 9% preferred stock issue. The remainder of the purchase price came from traditional bank debt. That one entity, Berkshire, would provide both equity and debt financing was somewhat unusual. It allowed Berkshire to put more money to work at a lower relative risk than if the non-equity financing was borrowed. We have a less leveraged position in the capital structure than they have. They wanted more leverage, and we provided the leverage on what I regard as fair terms and what they regard as fair terms. The structure of the deal reflected the governing partnership, which allowed Berkshire to put capital to work with a team of managers already in place. We, Berkshire, have more money than operating ability at the parent company level, and they have lots of operating ability and wanted to maximize their return on $4 billion. Insurance. Berkshire's insurance group delivered big in 2013. Each operating unit produced an underwriting profit, the 11th year in a row, which resulted in a 4.1% negative cost of float. Better still, year-end float grew 6% to $77 billion. Buffett reminded shareholders that both gifts, negative cost of float and higher float, were not a given. He cautioned that future gains in float would be hard to come by and that Berkshire's float might shrink. Unlike debt, which could be called away requiring large cash resources, float could not place a large demand on liquidity. He said any future decline in float might only be around 3%. That comment shed some light on why Buffett was reluctant to include underwriting gains in the calculation of Berkshire's earning power and therefore intrinsic value calculations. If in future years Berkshire's float did shrink, underwriting gains would be offset by the outflow of capital from the decline in float. The resulting economics would still be very favorable because the cumulative underwriting profit would replace the float, leaving the same amount of capital available for Berkshire to use. Including underwriting profits and earnings would therefore be inappropriate. Geico. Front and center in insurance was Geico. When discussing float, Buffett was quick to point out that Geico's float would almost certainly grow. Why such certainty? Because Geico's business model as a low-cost provider created a moat. It could save customers real money, and that meant growth could be expected. In 2013, Geico had a market share of 10.2% and passed Allstate to become the second largest auto insurer in the United States after State Farm's 18.5% share. Premiums earned swelled 11% to $18.6 billion, and it wrote to a 93.9% combined ratio. Berkshire Hathaway Reinsurance Group. From a standing start in 1985, Ajit Jain created BHRG, which as of 2013 had float of $37 billion and cumulative underwriting profits. During the year, Jain went a step further by forming Berkshire Hathaway Specialty Insurance, a company that would provide direct commercial insurance. Jain placed Peter Eastwood in charge of the new company, one of several executives that sought out a place at Berkshire from competitors. The new entity would be part of the primary group. The insurance landscape continued to be tough from a pricing perspective, which constrained volume. Still, the division overall outperformed itself over the previous year. Total premiums earned at BHRG fell 9% to $8.8 billion, but profits rebounded strongly, up 325% to $1.3 billion. Results were expected to be volatile, and in 2013, a lack of major catastrophes led to the second year of profits within the catastrophe and individual risk segment, up 45% to $581 million on earned premiums that fell 2% to $801 million. Catastrophe losses totaled just $20 million from floods in Europe compared to losses of $96 million in 2012 and $800 million in 2011. Retroactive premiums fell for the third year in a row, from $2 billion in 2011 to $717 million in 2012 to $328 million in 2013. A small number of contracts were responsible for current year volume, and deferred charge amortization caused the line to report a loss of $321 million from a loss of $201 million the year before. Gross unpaid losses from retroactive insurance contracts, totaling $17.7 billion, demonstrate the huge amount of float from these activities. Offsetting unpaid losses were unamortized deferred charges amounting to $4.25 billion at year-end, an amount that was slowly working its way into loss expenses over time and impacting reported results. Volume and other multi-line fell 18% to $4.3 billion, largely from expiration of the Swiss Re 20% quota share agreement at the end of 2012. Residual premiums of $1.5 billion were earned in 2013 from that contract, far below the $3.4 billion earned in 2012. As with catastrophe and individual risk segment, other multi-line incurred low levels of catastrophe losses. Losses in 2013 amounted to just $16 million from floods and a hailstorm in Europe, compared to $268 million the year before from Hurricane Sandy. As a result, pre-tax underwriting profits swelled 122% to $655 million. BHRG's life and annuity business was impacted by three large contracts. Earned premiums jumped 17% to $3.3 billion due to two new pieces of business. The increase in life and annuity premiums would have been greater if not for a contract amendment with Swiss Re Life and Health America Incorporated that reversed earned premiums of $1.3 billion but produced a one-time pre-tax gain of $255 million. Underwriting results rebounded from a loss of $190 million to a profit of $379 million in 2013. General Re. It can be remembered that soon after we purchased General Re, the company was beset by problems that caused commentators, and me as well briefly, to believe I had made a huge mistake. That day is long gone. General Re is now a gem. Buffett's praise for General Re and Tad Montrose reflected the company's 8th consecutive year of underwriting profits, which fell 20% to $283 million on earned premiums, up 2% to $6 billion. Property casualty earned premiums increased 3.5% to $3 billion, but would have been flat without positive currency effects. While pre-tax underwriting profits fell 63% to $140 million, the result was after $400 million of catastrophe losses from a hailstorm and floods in Europe. Property lines recorded $375 million of favorable loss adjustments on prior year business and $178 million in gains on current year business. Casualty workers' compensation reported a loss of $5 million, almost overcoming $141 million of accounting charges. Gen Re's life health business bounced back from a $44 million loss in 2012 to report a $135 million profit in 2013. The improvement was a result of lower than expected mortality and the absence of a large charge taken the prior year. Berkshire Hathaway Primary Group. Premiums earned at Berkshire Hathaway Primary Group jumped 48% to $3.3 billion. The increase was largely due to the inclusion of Guard and Princeton for the full year and from the new commercial specialty insurance business. Total underwriting profit grew 35% to $385 million, a strong 85% combined ratio. Favorable claims experience and the addition of newcomers drove the increase in profit. Manufacturing, service, and retailing. Pre-tax earnings from Berkshire's MSR businesses increased 10% to $6.7 billion, but the rate of return on tangible capital fell from 25.3% to 21.5%, and after-tax return on tangible equity fell from 21.4% to just 16.7%. At least part of the reason had to do with excess cash building up on the books. For the first time, the net debt position of the MSR group was negative, meaning cash on the books exceeded total debt. Over the previous 5 years, the MSR group had gone from a net debt position of $5.1 billion to a net cash position of $605 million. Cash was piling up faster than it could profitably be used, this despite additional bolt-on acquisitions and spending on capital expenditures in excess of depreciation. Marmon further organized its businesses. Previously, it had classified its 160 businesses across 11 sectors. Those sectors remained but were grouped into 3 separate categories. See Table 7.31. Results across Marmon's mini businesses were mixed. Overall, the unit grew pre-tax earnings 3.4% to $1 billion, even as revenues fell slightly to $7 billion. Its pre-tax margin grew again from 15.9% in 2012 to 16.9% in 2013. Results from Marmon's business displayed the same bob-around pattern Buffett described years earlier, with various industry and business-specific changes impacting results from year to year. All the while, it continued looking for ways to improve margins and deploy capital into new niches, including through bolt-on acquisitions. It was a successful strategy. During 2013, Berkshire acquired the remaining portion of Marmon it did not own. Berkshire paid $1.47 billion for 9.7% of the company. That implied a valuation of $15.2 billion for Marmon and represented a multiple of 12.9 times earnings. Berkshire increased its ownership in Berskhire during 2013. The Wertheimer family exercised a put option it held and elected to sell the remaining 20% of the business the family had retained since the sale in 2006. Berkshire paid $2.05 billion, which valued the entire company at $10.25 billion. That meant the company was worth twice as much as when Berkshire first purchased it in mid-2006. Its earnings were flat compared to 2012. The other manufacturing segment, which included results from Berskhire, reflected strength from consumers. Revenues increased 8.7% to $29.1 billion, and earnings increased by the same rate to $3.6 billion. Forest River had another strong year and experienced 24% higher revenues and 32% higher profits, highlighting its manufacturing efficiencies on higher volumes. The building products businesses increased revenues 8% and pre-tax earnings 13%, and the apparel businesses increased revenues 3.5% and pre-tax earnings 25%. Lubrizol earnings were unchanged from the prior year. Bolt-on acquisitions also contributed to results in this segment. Earnings from other service businesses increased 10% to $9 billion and included strong showings from TTI, up 11%, and NetJets, up 7.5%. The newspapers under the heading BH Media saw 66% higher revenues, but only because of acquisitions. Pre-tax earnings for the segment increased 13% to $1.1 billion and included TTI, up 10%, Flight Safety, up 11%, and NetJets, up 7%. In the retailing segment, a full year of results from Oriental Trading Company led to a 15% increase in revenues to $4.3 billion and a 23% increase in pre-tax earnings to $376 million. The combined effect of an increase in earnings from the home furnishings and jewelry businesses and lower earnings from See's and Pampered Chef was neutral on the segment's earnings. McLean's revenues increased 23% to $45.9 billion, and pre-tax earnings increased 21% to $486 million. Revenues and earnings growth from the Meadowbrook Meat Company, which it acquired in 2012, double-digit organic growth in existing business, and a pre-tax gain of $24 million from the sale of a logistics business in Brazil. Regulated capital-intensive businesses. The big news in utilities was the acquisition of NV Energy. NV Energy was an energy holding company that served 1.2 million electric customers and 200,000 natural gas customers in Nevada through two main operating segments, Nevada Power Company and Sierra Pacific Power Company. Mid-American paid $5.6 billion for the company. The deal closed on December 19, 2013, and as a result had little effect on Berkshire's 2013 results. Price tag Berkshire paid suggests it was a fair deal for both sides. Mid-American would gain a platform to invest in the West, a growing area where Buffett got a foothold with the purchase of BNSF 3 years earlier. NV Energy would be able to invest in more renewable energy projects, such as solar generation, now that it was part of Mid-American, and those projects would serve to lower the company's taxable income through accelerated depreciation and deferred taxes, as well as direct tax credits for the renewable projects. Mid-American's existing operations performed well during 2013. Its EBIT grew 7% to $2.1 billion, and Berkshire's share of net income grew 11% to $1.5 billion. Broken down further, the news was mixed. Pacific Corp drove a large part of the gain. It received regulatory approval in 2012 to raise rates, but a costly fire offset the higher revenues. With no adverse event in 2013, Pacific Corp's EBIT swelled 33% to $982 million. Home Services increased its earnings by 70% to $169 million from a combination of the additional brokerages it had acquired and higher volumes of sales on higher sales prices. Northern Power Grid EBIT fell 16% to $362 million due to lower revenues and the strength of the U.S. dollar against the UK pound. BNSF Railroad continued to do well for Berkshire. In 2013, it recorded yet another year of increase in revenues and earnings. Revenues grew 5.7% to $22 billion, and pre-tax earnings grew 10% to $5.9 billion. BNSF moved 4.5% more units and received higher prices on those units. 3 of its 4 major segments increased volumes in 2013. Industrial products volume grew 11%, driven by strength in petroleum products. Consumer products grew 6%, and coal was up 3%. The only exception was agricultural products, which declined 4% amid lower U.S. exports. Finance and financial products. The largest business in this segment, Clayton Homes, increased pre-tax earnings 63% to $416 million. Increased unit volumes led to higher manufacturing efficiencies and allowed an outsized increase in pre-tax earnings on just 6% higher revenues. During and after the recession, its manufacturing volumes dropped precipitously. That caused the high fixed costs associated with manufacturing to put a drag on earnings. Without the lending business, Clayton's earnings might well have been negative during those years. Clayton produced 29,547 homes in 2013, which represented 4.7% of all single-family homes in the United States, and made it the country's largest builder, even including site-built homes. Pre-tax earnings from Court and Extra increased 11% to $165 million. Together with $404 million of other income, the finance and financial products segment increased pre-tax earnings 16% to $985 million. Investments. Berkshire's major investment moves in 2013 amounted to hitting a repeat button. Berkshire added another $1 billion to its Wells Fargo stake, ending the year with 9.2% of the company, worth $22 billion. It also added modestly to its IBM position, increasing it from 6% to 6.3% of the company, worth $12.8 billion at year-end. In a surprise purchase, Berkshire disclosed it had amassed close to a 1% stake in ExxonMobil, worth $4.2 billion at year-end. Commentators speculated the company's low price-earnings ratio and the company's history of returning capital to shareholders attracted Buffett. A lack of commentary by Buffett, both in the chairman's letter and at the annual meeting, suggested the purpose was not overly important. That lack of importance would soon be confirmed. It would be sold the next year. Buffett provided 2 very interesting and timeless investing lessons in 2013, both related to non-intuitive transfers of value that tripped up managers and investors alike. One was his logic for thinking through issuing options, which came as a result of a management compensation plan put forth by Coca-Cola. A second was his thinking on pensions, which included a memo he had written to Washington Post Company CEO Katharine Graham in 1975. The 19-page memo Buffett wrote to Graham in 1975 was included as an appendix to the 2013 Berkshire Hathaway annual report, and it's worth reading. In his 2013 chairman's letter, Buffett called pensions and other related promises made today with tomorrow's checkbook a gigantic financial tapeworm. His thoughts hadn't changed much since writing that letter. The problem was that many people in companies and governments across the country vastly underestimated the value transferred by making promises to pay sums in the future. As an example, Buffett said that a promise to pay him $500 a month for life was really a transfer in value of $65,000, and if an earthquake risk materialized, such as a combination of high salary inflation coupled with muted investment returns, the present value of such a promise could skyrocket. Companies set aside assets to pay for these future promises, which were usually managed by an outside investment manager. As the liabilities mounted, so too did the requirement to contribute assets to a fund to cover them. These contributions directly impacted the profitability of companies since they were included as an expense. Over time, the value of pension assets sometimes eclipsed the net worth of the companies that sponsored them. Both used U.S. Steel Company as an example in his 1975 memo. As of 1972, U.S. Steel had a net worth of $3.6 billion, and its pension fund assets amounted to $2.2 billion. The pension fund of U.S. Steel was basically a separate operating division. Despite these large promises, some managers neglected their pension assets, even though the investment returns would drive future pension costs and therefore a company's future profitability. To Buffett, a company had to be viewed in its entirety, and that included its sometimes significant pension assets liabilities. The risks around pensions and post-retirement benefits are so large that they are the only other item, besides large capital expenditures or acquisitions, that Buffett requires his company's managers check with him first before committing. There is one last item related to pensions which is important to understand. Investments in a pension fund can reasonably be expected to earn a return. Consequently, future returns are projected alongside assumptions of future liabilities. It is a human bias for a management team to make optimistic assumptions about future returns, since it lowers the amount a company must contribute in the present. Management's assumptions about future returns are disclosed in financial reports. Some companies, even in times of low interest rates, such as during the mid-2010s, assume double-digit returns. Buffett has commented on how these assumptions are too high. Berkshire's own pension assumptions in 2013 included an expected long-term rate of return on plan assets of 6.7%. By contrast, the public pension fund median assumed rate of return was 7.75%. The percent difference may seem small, but the difference represents billions of dollars. Berkshire's lower assumptions were another indicator of its conservatism. In 2013, Coca-Cola's management team put forth a management compensation plan that by many accounts was excessive. The plan called for the issuance of 500 million shares over 4 years, which on the surface amounted to possible dilution for existing shareholders of 16.8%. Coke's plan led one investor to publicly call out the management team for transferring billions in value from shareholders to management. The spat was covered by the business press. Berkshire Hathaway owned 9.1% of Coke that was worth $16.5 billion. What did Buffett think? That was the very first question posed by Carol Loomis at the 2014 annual meeting. Buffett was not supportive of the plan but felt others' fears of outsized dilution were overblown. He explained his thinking. Even if all the shares were issued at the current price, dilution would be far less than suggested. Coca-Cola would receive proceeds from those exercising the options and a tax benefit from the transfer of value. Both would serve to reduce dilution if shares were repurchased. The figure Buffett calculated was 2.5%, a lot lower than 16.8%. I don't like dilution, and I don't like 2.5% dilution, but it's a far cry from numbers that were getting tossed around. In the end, Berkshire voted to abstain on the management plan. It had conversations with Muhtar Kent, Coke CEO. Those were enough to cause Coke to scale back the plan and extend it over 10 years instead of 4. Other news. Berkshire added a new director in 2013. Merrill Whitmer was the first new addition to the Berkshire Hathaway Board of Directors since Stephen Burke in 2009. Whitmer, 51 years old, was a managing partner and investment manager at Eagle Capital Partners, LP. The addition of Whitmer expanded the board from 12 to 13 members. On the proxy ballot that year, for vote in early 2014, was a suggestion that Berkshire pay a dividend. Shareholders overwhelmingly voted not to have Berkshire pay a dividend. The support was there even after removing Buffett shares from the count. It was a vote of confidence for Berkshire's capital allocators and the strategy of retaining all earnings. 2014. The numbers for 2014 were reason enough to celebrate. Shares advanced 27% against the S&P 500's gain of 13.7%. Berkshire's book value per share increased 8.3%. The year also brought an important milestone for Berkshire Hathaway. It marked 50 years since Warren Buffett took control of the company and built it into one of the world's largest and most admired corporations. Buffett marked the anniversary with a new measurement in the performance table presented at the beginning of the annual report each year. Shareholders were used to seeing the historical change in book value per share and the total return of the S&P 500, Berkshire's selected benchmark. Now presented alongside those figures was the historical record of changes in Berkshire's share price. Buffett's reasoning was that Berkshire's shift toward owning businesses in their entirety made book value an inferior gauge of performance, as many companies were worth far more than carrying value. In early years, Berkshire's assets were mostly in securities, where book value and intrinsic value was closely aligned. Now assets were concentrated in operating companies, and there was a wide gap. One might have been suspicious of why the preferred metric was being changed in a year that showed Berkshire in a favorable light. Buffett noted the limitation of market prices over the short run, but said that over decades the market correctly tracked Berkshire's intrinsic value. Revisiting our rough estimate of Berkshire's intrinsic values, we can observe that the market was roughly right during 2014. Berkshire's intrinsic value appears to have increased more than book value, but less than the strong advance of its shares. The 13% increase in estimated value nearly matched the S&P 500 that year and is consistent with Buffett's observation that Berkshire would struggle to beat the market in up years. How Berkshire achieved its gain in intrinsic value is the story of 2014. The year was mostly a good one for Berkshire. Its operating subsidiaries increased earnings and found ways to expand both organically and through bolt-on acquisitions. Buffett loved bolt-on acquisitions because they meant no more work for us, yet more earnings. Insurance delivered yet another year of underwriting gains and more float. Berkshire also found other profitable outlets for its growing cash pile during the year. One was a multi-billion-dollar acquisition in Canada that expanded Berkshire's utility operations. Another deal with 3G Capital presented itself during the year, as did opportunities to acquire both operating businesses and some of Berkshire's own stock via tax-savvy moves. The major blemish was an operating disruption at BNSF that Buffett appeared to bemoan for its impact on customers and reputation than Berkshire's bottom line. Insurance. The insurance group delivered its 12th consecutive year of profits with a $2.7 billion pre-tax underwriting gain on earned premiums of $41.3 billion. That represented a negative cost of float of 3.3%. Float grew again in 2014, ending the year up 8.6% to $83.9 billion. All of Berkshire's insurance units benefited from a year of no catastrophe losses. Berkshire Hathaway Reinsurance Group. Berkshire Hathaway Reinsurance Group, led by Ajit Jain, contributed the bulk of the increase in float during the year. Float at BHRG grew 14% to $42.5 billion and now represented over half of Berkshire's total float. Earned premiums grew 15% to $10.1 billion, and pre-tax underwriting gains amounted to $606 million, a decline from $1.3 billion the prior year. In 2014, BHRG consolidated its other multi-line property casualty reporting segment with the catastrophe and individual risk segment. On a comparative basis, earned premiums in property casualty fell 21% to $4.1 billion, but pre-tax underwriting gains swelled 36% to $1.7 billion. The Swiss Re 20% quota share agreement expired at the end of 2012, but contained policies in runoff that contributed $1.5 billion to earned premiums in 2013 and $200 million in 2014. The Swiss Re contract also contributed $283 million to underwriting gains in 2014 from reduced loss estimates. A lack of catastrophe events led to a $700 million gain in property business, and foreign currency exchange gains added $315 million to the bottom line. Retroactive reinsurance earned premiums grew from $328 million to $3.4 billion, primarily from a $3 billion contract with Liberty Mutual Insurance Company. The retroactive policy insured Liberty Mutual against adverse development of its asbestos and environmental book prior to 2005 and workers' compensation claims prior to 2014. Berkshire's exposure was capped at $6.5 billion after a $12.5 billion retention. The loss amount the primary or ceding insurer must incur first. Pre-tax underwriting losses from retroactive reinsurance swelled 182% to $905 million due to increases in deferred charge amortization and an $825 million unfavorable adjustment to prior year loss estimates. Total unamortized deferred charges grew 81% to $7.7 billion at year-end 2014. This amount would continue to be amortized into underwriting expense and be a drag on future earnings. Gross unpaid losses grew 37% to $24.3 billion. The life annuity business swung from a gain of $379 million in 2013 to a loss of $173 million in 2014. Earned premiums fell 19% to $2.7 billion. General Re. General Re reported another year of profits with its underwriting gain falling 2% to $277 million. Earned premiums grew 4.7% to $6.3 billion. The property casualty segment increased earned premiums 3% to $3.1 billion, and its underwriting gain grew 15% to $170 million. Gains of $466 million from property business reflected no significant catastrophe losses. Casualty workers' compensation reported a loss of $296 million, which included $123 million favorable loss development and recurring accounting charges amounting to $138 million in 2014. General Re's life health business continued its steady stream of profits with a $107 million gain. The gain in 2014 was down 21% from the prior year, in large part because of increased reserves directly associated with lower interest rates. Earned premiums grew 6% to $3.2 billion. Geico. Geico turned in another strong year with $1.2 billion underwriting profit and a combined ratio of $94.3 billion. Its premiums crossed the $20 billion mark, up 10%. That result solidified its standing as the second largest auto insurer in the United States, with a 10.8% market share, up from 10.2% in 2013. Berkshire Hathaway Primary Group. Premiums from the primary group rose 33% to $4.4 billion from organic growth and the addition of the new commercial unit formed by Ajit Jain. Pre-tax earnings from these insurers grew 62% to $626 million. As small as they were individually or collectively in relation to Berkshire's other insurance operations, the primary group deserve its annual praise from Buffett. Their consistent profitability and float at year-end amounting to $8.6 billion contributed meaningfully to Berkshire's intrinsic value. Manufacturing, service, and retailing. Marmon, one of the newest and biggest members of the MSR Group, was partly reorganized for reporting purposes in 2014. Buffett moved Marmon's leasing operations into finance and financial products now that it was entirely owned by Berkshire. Results for the prior 2 years were restated for a clean comparison. Table 7.36 contains the new presentation and the figures as originally presented. Using the 2014 presentation, pre-tax earnings increased 10% to $6.8 billion for the MSR Group. Net earnings, after tax and non-controlling interests, grew 15% to $4.5 billion. While increases are always better than decreases, it's important to remember these business units were continually making bolt-on acquisitions and employing capital that in some cases came from headquarters. A better way to keep check on their progress was return on tangible equity, which in 2014 came in at 18.7%. Marmon's manufacturing operations were now included together with Berkshire's other manufacturing businesses. As a result, some details of its operations were lost compared to when it was a standalone reporting segment. Berkshire divulged some details in the notes to its financial statements, reporting revenues increased 15% to $6 billion and pre-tax earnings 19% to $708 million. These increases were largely due to the inclusion of IMI plc, a British beverage dispensing equipment manufacturer Marmon acquired for $1.1 billion on January 1, 2014. Marmon's existing businesses increased revenues and found cost savings in certain lines of business that contributed to higher earnings. Berkshire began including a new table in the notes to the financial segments that made viewing the manufacturing businesses easier. See Table 7.37. The table further classified the manufacturing businesses along three lines: industrial and end-user products, building products, and apparel. Berkshire included Marmon's manufacturing businesses, discussed above, in the industrial and end-user products category. As a whole, they increased revenues 10% to $22.3 billion, while pre-tax earnings increased 14% to $3.5 billion. Bolt-on acquisitions led to most of the 10% increase in pre-tax earnings of Lubrizol. Higher unit sales at Forest River led to its 21% increase in pre-tax earnings. Higher revenues, a higher gross margin, and lower cost increased Iskar's earnings 18%. CTB was also included in this category, but Berkshire made no mention of its results. Pre-tax earnings in the building products category increased 6% to $896 million on revenues that grew 5% to $10.1 billion. Johns Manville, Acme, and Mytech improved their top lines. Mytech also benefited from bolt-on acquisitions. Shaw closed its rug division in 2014. Improvements in its hard flooring unit kept revenues flat, but raw materials costs depressed earnings. Every other business in this category increased earnings, including Benjamin Moore. Pre-tax earnings in apparel jumped 44% to $455 million, on revenues up 1% to $4.3 billion. Details on earnings were scarce. All that Berkshire disclosed is that some of the 6 businesses were restructured. Lower manufacturing and pension costs also helped earnings growth. Included in this segment were Fruit of the Loom, including Russell and Vanity Fair brands, and formerly large parts of Berkshire's operations, such as H.H. Brown Shoe. Revenues in the service business category increased 10% to $9.9 billion, led by TTI, NetJets, and Flight Safety. TTI grew from higher unit sales as well as bolt-on acquisitions. NetJets and Flight Safety both benefited from higher utilization rates, including higher sales of aircraft at NetJets. NetJets and TTI led the group to 10% higher pre-tax earnings, totaling $1.2 billion. Other businesses in this category included Business Wire, Dairy Queen, the Buffalo News, and the BH Media Group that included the Omaha World Herald, 28 other daily newspapers and publications, and new in 2014, a TV station, discussed below. The retailing businesses included Berkshire's 4 furniture retailers, Nebraska Furniture Mart, R.C. Willey, Star, and Jordan's. Its 3 jewelers, Borsheim's, Hellsberg, and Benbridge. See's, Pampered Chef, and Oriental Trading Company. Nebraska Furniture Mart's pending megastore outside of Dallas, Texas, weighed on the results from this group. Overall, revenues declined 3% to $4.4 billion, and pre-tax earnings declined 9% to $344 million. McLean was the only business to receive its own reporting line. Its $46.6 billion revenues required that because of reporting rules. Its revenues increased 1.5% from the year before, from higher food service and beverage revenues, but pre-tax earnings declined 10% to $435 million. The decline was 6%, including the $24 million pre-tax gain on the sale, its Brazil-based logistics business in 2013. A decline in earnings from a food service business overshadowed higher earnings from grocery and beverage. Berkshire acquired 2 MSR businesses during 2014 in a relatively unusual way. The first was a division of Phillips 66 that was renamed Lubrizol Specialty Products Incorporated. Its main product line allowed oil to flow faster in pipelines and was a perfect fit for Lubrizol. The second such acquisition was WPLG, a Miami, Florida television station affiliated with the ABC network. It was placed in the BH Media Group alongside the newspaper properties. These two acquisitions were unusual in that Berkshire bought them in exchange for stock it already owned in Phillips 66 and Graham Holding Company, owner of the TV station and the renamed entity that held the Washington Post. This allowed Berkshire a way to sell its investments in Phillips 66 and Graham Holding Company tax-free. These types of transactions are called cash-rich split-offs and entail using a provision in the tax code allowing no capital gains to be incurred for tax purposes. This was perhaps most important with Graham Holding Company. Berkshire's cost basis, which originated in the 1970s, was just $11 million. Those shares were now worth $1.1 billion, which meant Berkshire would incur a large tax bill if it sold the investment outright. Instead, Berkshire traded its shares for the Miami TV station, cash, and Berkshire Hathaway shares that Graham Holding Company owned. Berkshire effectively repurchased 2,107 Class A and 1,278 Class B shares via this transaction. The value of the Berkshire shares alone amounted to roughly what it would have paid on the gain, assuming the typical all-in corporate tax rate of 38%. Berkshire realized a total capital gain for GAAP purposes of $2.1 billion related to these two transactions. In November 2014, Berkshire agreed to another cash-rich split-off. It would acquire Duracell, the battery maker, from Procter & Gamble in a similar transaction in 2015. Regulated capital-intensive businesses. On April 30, 2014, Mid-America Energy Holdings Company, the holding company that owned all of Berkshire's utility operations, changed its name to Berkshire Hathaway Energy Company. The home services business had changed its name to Berkshire Hathaway Home Services in 2012. Its corporate parent now followed suit, leveraging the Berkshire Hathaway name, which was becoming a brand synonymous with good business and personal values. Aside from the new branding, the highlight of the year at the utility business was the acquisition of AltaLink from SNC-Lavalin Group on December 1, 2014. The company was based in Alberta, Canada. AltaLink's business was very simple. Unlike its new sister companies of Berkshire Hathaway Energy, it only handled the distribution of electricity. It boasted 12,000 kilometers of transmission lines serving 85% of the population of the province of Alberta. Berkshire Hathaway Energy acquired AltaLink for $2.7 billion. The transaction was funded with loans from Berkshire's insurance subsidiaries and debt of $1.5 billion. Berkshire Hathaway Energy's consolidated EBIT increased from $2.1 billion to $3.1 billion. A large part of the increase was directly a result of the NV Energy acquisition in 2013, which added $549 million in EBIT in 2014. Another large contribution was Northern Power Grid. The UK-based utility saw EBIT jump 46%, which was from a combination of rate increases and favorable foreign currency exchange. Additionally, EBIT increased from new solar and wind assets placed in service during the year. Berkshire's share of net earnings grew from $1.5 billion to $1.9 billion. The major blemish of 2014 came from BNSF. Buffett called the railroad Berkshire's most important non-insurance subsidiary. It was clear from the tone in his chairman's letter that he was not happy about the reputational hit the company took from service disruptions. During the year, BNSF disappointed many of its customers. These shippers depend on us, and service failures can badly hurt their businesses. There were several causes for the disruption. They included strong demand from agricultural shippers and demand for oil shipment from the Bakken region in combination with adverse weather in the first part of the year. BNSF's extensive work to increase system capacity also played a part, though to a lesser degree. Buffett gave BNSF management marching orders to repair its reputation. The weather, which was particularly severe last year, will always cause railroads a variety of operating problems. Our responsibility is to do whatever it takes to restore our service to industry-leading levels. Buffett was clearly disappointed in BNSF's financial performance, which lagged its major rival. The Union Pacific Railroad, BNSF's main competitor in the West, though far underspending BNSF in new capital projects, gained market share and earned more money than Berkshire's railroad. Pre-tax earnings from BNSF grew 4% to $6.2 billion because of a 1.8% increase in volumes and higher pricing. Union Pacific reported its fourth quarter earnings release that pre-tax earnings grew 18% to $8.3 billion on 7% greater volume. These missteps in 2014 notwithstanding, Buffett remained optimistic. BNSF planned to spend $6 billion, or 26% of revenues, on capital expenditures in 2015, a figure far higher than Union Pacific's 17%. These huge investments were expected to lead to a system with greater capacity, much better service, and improved profits. Finance and financial products. Pre-tax earnings in the financial and financial products segment swelled 18% to $1.8 billion. That increase included Marmon's earnings from its leasing operations, which were presented on a restated basis looking back to 2012. Every business in this sector except Court improved during 2014. No reason were given for its decline from the prior year. Clayton grew its pre-tax earnings 34% on just a 3% increase in revenues. Such outsized improvements in earnings compared to revenues reflected an increase in manufacturing efficiencies. Clayton produced 45% of the manufactured home volume in the United States during 2014, up from 14% in 2003 when Berkshire purchased the company. Clayton's mortgage portfolio ended 2014 on par with the prior year at $13 billion. Marmon's leasing operations were extensive and spanned 105,000 rail cars. Its annual volume was 6,000 units. Berkshire's book value of $5 billion for Marmon's rail fleet was understated because it manufactured all its own cars and did not register a profit when transferring the units to the leasing operation. A consequence of this was lower annual depreciation expense over the 30-year life of each unit. The nature of the transportation leasing businesses, such as Marmon's and Extra, was one of the high fixed costs. The most significant was depreciation. Higher usage and higher rates had a disproportionate effect on the bottom line of these companies. This was the case with two businesses during 2014. Their earnings also increased due to the high units in service. Investments. When Berkshire listed its 15 largest equity positions in 2014, one did not make the list. Berkshire had warrants to buy 700 million shares of Bank of America, which could be exercised by Berkshire any time prior to expiration in September 2021. The warrants were worth $12.5 billion at year-end 2014. If the warrants were converted to shares, Bank of America would have been the fourth largest investment. Because they weren't, the company didn't even make the list. This was another prime example of economics versus accounting, where accounting skewed the actual economics. The top investments on the list were familiar and successful, so much so that Buffett called them the Big Four: American Express, Coca-Cola, Wells Fargo, and IBM. Buffett used simple math and an example to show the value of the Big Four in non-controlling ownership stakes. Each increase of 0.10% in Berkshire's ownership raised Berkshire's portion of annual earnings by $50 million. It's better to have a partial interest in the Hope Diamond than to own all of a rhinestone. Buffett also admitted a mistake he made in taking too long to sell Tesco shares. The UK-based grocer ran into problems that turned into a management change, shrinking profits, and accounting mishaps. The real problem wasn't Berkshire's $444 million after-tax loss on its $2.3 billion investment. Buffett said he lost faith in Tesco's management, and that led him to sell some shares, but not all. His mistake was acting slowly. Another position is worth noting. At year-end, Berkshire owned 8.6% of DaVita Healthcare Partners Incorporated, a kidney dialysis company. Berkshire did not disclose who of the three investment partners, Buffett, Todd Combs, or Todd Weschler, made each investment, but DaVita was a company long owned by Weschler through his hedge fund. Another opportunity presented itself to work with 3G Capital, the investment firm that partnered with Berkshire to buy Heinz in 2013. This time, 3G Capital was looking for a financing partner to assist with its acquisition of Restaurant Brands International Incorporated, RBI. RBI owned the Canadian-based fast food chain Tim Hortons and the well-known U.S.-based food chain Burger King. Berkshire invested $3 billion in a 9% cumulative compounding perpetual preferred stock. A unique provision required RBI to pay Berkshire an additional amount, if necessary, to produce an after-tax yield as if the dividends were paid by a U.S. company. That provision provided protection against changes in tax rates and significant appreciation of the U.S. dollar, making the Canadian dollar payments worth less upon conversion. Buffett remained bullish on America, but after half a century building Berkshire Hathaway into the strongest and most respected companies in the world, protection against risk remained at the forefront. Decade in review. The fifth decade of Berkshire Hathaway under Warren Buffett's control might be considered its penultimate. It was the last decade in which earnings could profitably be retained in their entirety, and it proved that size was in fact an anchor to future performance. Its earnings and increase in net worth over the 2005 to 2014 period was enormous. Earnings from operations topped $107 billion, and net worth rose to almost $250 billion. The rate of increase in shareholders' equity, however, dropped sharply from 22% to just 11%. Net shares issued in acquisitions drove the rate of book value growth per share to 10.1%. Significantly, this was still 2 percentage points better than the S&P 500. What Berkshire Hathaway gave up in ability to generate outsized returns, it gained in financial strength, which was tested during the worst economic downturn since the Great Depression. Berkshire was a financial fortress as it closed the books on a half-century. The decade that ended in 2014 saw a marked shift toward ownership of operating subsidiaries. Earnings from operations jumped to 70% of the total increase in shareholders' equity for the period. That level of contribution hadn't happened since the very first decade of Buffett's control. The sum of all acquisitions, net of cash acquired, amounted to $59 billion. Berkshire acquired literally hundreds of businesses during this time, including the smaller bolt-on acquisitions made by subsidiaries. But it was big acquisitions that really moved the needle, and they were collectively known as the Powerhouse Five. $6.05 billion, Berskhire, the Israel-based manufacturer of cutting tools, was Berkshire's first major international acquisition. Berkshire acquired it in two stages, 80% in 2006 and another $2.05 billion in 2013. This valued the whole company at over $10 billion. Equity value, we don't know what debt, if any, was on the books. $9 billion. Marmon, a conglomerate with 130 businesses across 11 sectors. Like Berskhire, Marmon was acquired in stages. The first 60% in 2008 for $4.5 billion, and the remainder for another $4.5 billion between 2011 and 2013. $33.5 billion. Burlington Northern Santa Fe, BNSF, joined Berkshire in 2010. So too did some of BNSF's shareholders that elected to receive Berkshire shares in the process. Considering debt and the value of the shares Berkshire owned before it bought the rest of the railroad, the deal was worth $44.5 billion. $8.7 billion. Lubrizol joined Berkshire's ranks in 2011. $13.4 billion. Mid-American, whose name was changed to Berkshire Hathaway Energy in 2014, acquired Pacific Core in 2005 for $5.1 billion, with Berkshire contributing $3.4 billion of additional capital to fund the purchase. It also acquired NV Energy for $5.6 billion in 2013 and AltaLink for $2.7 billion in 2014. Of the Powerhouse Five, only Berkshire Hathaway Energy in its smaller form as Mid-American was around in 2005. That year it earned $393 million pre-tax. In 2014, the Powerhouse Five collectively earned $12.4 billion pre-tax. For perspective, Berkshire's many other non-insurance businesses in the aggregate earned $5.1 billion pre-tax. Over the decade, the Powerhouse Five had a cumulative $12 billion gain in earnings that came with only minor dilution. That satisfies our goal of not simply increasing earnings, but making sure we also increase per-share results. The Powerhouse Five, though, were not the only big investments of the decade. The third largest investment of the decade was the $12.25 billion deal where Berkshire and 3G Capital acquired Heinz. In that deal, Berkshire contributed 50% of the equity for $4.25 billion and partially financed the deal with $8 billion of preferred stock. It was a unique structure where Berkshire provided financing and 3G oversaw operations. Berkshire also invested a massive $73 billion in property, plant, and equipment. About half represented replacement of existing fixed assets and half represented growth capital. The big spenders were the railroad and utility operations, which could soak up huge amounts of capital, but at a lower regulated rate of return. Berkshire's insurance operations expanded mostly organically between 2005 and 2014. The insurance group earned an underwriting profit every year, bringing the total over the 12 years of consecutive underwriting profit to $24 billion pre-tax. Each year also included net favorable loss development, a trend that proved Berkshire's conservatism in estimation and accounting. Insurance results were bolstered by several smaller acquisitions: MedPro, Princeton Insurance Company, Applied Underwriters, and Guard, and from new entities formed in-house: Berkshire Hathaway Assurance Corporation, to take advantage of mutual bond insurance, and Berkshire Hathaway Specialty Insurance to take advantage of an opportunity in the primary commercial market. Over the decade, GEICO moved into the number 2 spot as the second largest auto insurer in the United States behind State Farm. Average float grew 80% to $81 billion, providing even more capital for Buffett and Munger to deploy. Earned premiums grew 95% from 2004 to $41 billion in 2014. A big contributor to both premium and float growth was Berkshire Hathaway's reinsurance group, led by Ajit Jain. Jain's group contained over half of Berkshire's total float at year-end and contributed 72% of the increase in float generated by Berkshire over the decade. See Table 7.40. BHRG wrote some of the largest reinsurance contracts in history. $7.1 billion. A retroactive reinsurance contract with Equitas in 2007, which provided retroactive coverage to thousands of Lloyd's of London underwriters. $1.7 billion. Adverse loss development contract with Swiss Re in 2009. $2.25 billion with CNA Financial Corporation for reinsurance in 2010 to assume asbestos and environmental pollution liabilities. $1.7 billion with AIG in 2011 to reinsure asbestos liabilities. Other contracts written by BHRG and General Re included quota share arrangements and large catastrophe risks. Buffett frequently praised General Re during this decade for sticking to the 4 insurance commandments and focusing exclusively on underwriting profitability. The most severe economic recession since the Great Depression of the 1930s arrived in 2008. It caused financial markets to fall and credit markets to freeze. Berkshire's financial strength allowed it to go on the offensive and provide capital to the market during this period. Berkshire put to work tens of billions of dollars in a series of privately negotiated transactions. These included $14.5 billion over 2 weeks in 2008 to Goldman Sachs, $5 billion, Wrigley's, $6.5 billion, and General Electric, $3 billion. $5.7 billion in 2009 to Swiss Re, $2.7 billion, and Dow Chemical Company, $3 billion. $5 billion in 2011 to Bank of America. The recession proved Berkshire's model of operating with multiple layers of protection was not unduly conservative, but instead allowed it to go on the offensive when others were scrambling for liquidity. This translated into double-digit interest rates and often warrants to acquire shares at a bargain price. Berkshire's equity investment portfolio grew substantially during the decade. It was funded by the gusher of cash coming into Omaha from the operating subsidiaries and the billions in additional float from the insurance companies. Buffett's Big Four earned their moniker. The most meaningful change during this period was the addition of IBM, which was a new investment costing $12 billion. Over 10 years, Berkshire put another $11 billion into his favorite bank, Wells Fargo. Its investment in American Express and Coca-Cola remained virtually untouched, but appreciation contributed billions to Berkshire's increase in net worth over the period. Concentration remained a hallmark, though the top 4 positions edged down from 65% of the portfolio in 2004 to 59% in 2014. 3 of the 4 remained in the top position at both points of measurement. The IBM investment was first made in 2011. Too numerous to mention are the other investments purchased and sold over the course of the decade as opportunities arose. Buffett quickly admitted his mistakes, such as Energy Future Holdings and Tesco, both of which caused Berkshire permanent capital losses. In 2014, Berkshire changed its yardstick from measuring progress based on change in book value to change in market value. It was done because the discrepancy between Berkshire's book value and its intrinsic value became too great. Buffett stressed that it was market value over time that was the best judge, not any given year. Part of the reason for the change was the shift toward owning more operating businesses whose values were not regularly updated like the market price of securities. This change was critical as Berkshire's contribution towards change in equity due to net income from operations almost tripled from 26% in 1995-2004 to 70% in 2005-2014. In some cases, such as with Marmon and Iskar, huge write-offs, including $3.3 billion, were required for accounting purposes when Berkshire purchased the remaining ownership interest from the selling families. Buffett provided many clues to Berkshire's true value during this decade. He even provided two quantitative measures, per-share investments and per-share operating earnings, to nudge shareholders in the right direction. Communications were designed to help shareholders understand Berkshire's true intrinsic value. Both Buffett and Munger desired to see Berkshire shares sell as close to intrinsic value as possible so that business results would translate very closely to shareholder returns. Berkshire implemented a share repurchase program in 2011 and modified it in 2012 to allow the company to purchase shares up to 1.20 times book value. Berkshire's shareholders' equity grew at a rate of 10.8% per year over the course of the decade. A negative 0.7% net effect from share repurchases in 2011 and 2012, and the cash-rich split-offs in 2014, combined with shares issued, primarily for the BNSF acquisition, to bring the rate of per-share book value growth down to 10.1%. Berkshire's share price advanced at a still slower rate of 9.9% because of the small decline in average price-book ratio the market placed on the shares. Berkshire's share price still outperformed the 7.7% average annual advance of the S&P 500, a solid 2.2% edge, but far below its historical average. For context, the 10-year Treasury note declined from 4.2% at the end of 2004 to 2.2% at the end of 2014. Berkshire's market capitalization rose from an average of $131 billion at year-end 2004 to over $350 billion in 2014. Berkshire found itself up 10 spots to the fourth on the Fortune 500. At year-end 2014, Warren Buffett and Charlie Munger oversaw the financial equivalent of the Rock of Gibraltar. Just as its size, diversity, and liquidity provided strength second only to sovereign nations, it also meant almost no chance of achieving returns like in prior decades. The fifth decade under Warren Buffett's control would be the last decade of full steam ahead growth. Berkshire ended 2014 with $63 billion in cash and equivalents, even after the multi-billion-dollar capital allocation decisions made during the decade. The share repurchases in 2011 and 2012 provided inklings of the shift toward returning capital to shareholders that was to accelerate during the next decade. Berkshire Hathaway's place in the pantheon of business was secure after 50 years of careful building. The sixth decade would surely bring more opportunity for Berkshire, as well as its challenges. Warren Buffett and Charlie Munger would lead Berkshire Hathaway into a decade that would undoubtedly prove the company they built was ready for them to step down. But much more lay ahead, and the two men showed no signs of slowing down. Lessons 2004-2014. 1. Large opportunities can present themselves very quickly. It pays to be ready. Berkshire Hathaway was able to put billions of dollars of capital to work during the Great Recession of 2008-2009 because its balance sheet was very strong. During boom times, it is tempting to push the envelope by borrowing too much or by reducing redundancies and introducing fragility into the organization. As Buffett says, you never know who's swimming naked until the tide goes out. 2. Credit is like oxygen. When either is abundant, its presence goes unnoticed. When either is missing, that's all that is noticed. A company can substantially hurt itself or even go out of business under the right condition if it faces a significant liquidity need at the wrong time. Berkshire's cash was placed in U.S. Treasuries, which are the safest form of liquidity under almost any circumstance. It also kept its need for liquidity low by borrowing long-term. Its float, while representing significant liabilities, was structured so it can never be a large drain on cash. 3. Businesses do not need to be sold during times of distress. Berkshire never thought of selling its wholly owned businesses during the recession. That owner mentality also extended to many of its long-term equity investments. Business owners, whether in whole or part, don't panic and sell or seek to time the market. They instead look to the long-term, cash-generating ability of the assets. 4. Share prices frequently diverge from intrinsic value. Berkshire's communications to shareholders often contained explicit hints to the company's value, yet at times it sold for below what it was worth. Berkshire created value for continuing shareholders by repurchasing its shares at a price below intrinsic value. Companies that buy back shares above intrinsic value, no matter the purpose, destroy value for continuing shareholders. 5. Capital-intensive businesses can be satisfactory investments under the right conditions. Berkshire's growing size forced it to find outlets for mountains of cash. It found such an outlet in regulated businesses, including traditional electric and gas operations and the railroad industry. The key attribute for both was the ability to earn a protected but limited return on equity capital. 6. High rates of return eventually forged their own anchor. Berkshire's growth in book value per share increased at its highest ever dollar amount, while increasing at the lowest ever rate in its modern history. Larger and larger sums shrink the investable universe and make it harder to earn above-average returns over time. But as Berkshire demonstrated through its 50-year modern history, a long run is possible. The first 50 years, 1965 to 2014. It is not necessary to do extraordinary things to get extraordinary results. Warren Buffett. Extraordinary is the only word that singularly captures the arc of Berkshire Hathaway's 50-year transformation under Warren Buffett's control. The company that existed at the end of 2014 looked nothing like it did 50 years earlier, despite bearing the same name. The struggling textile company that once formed the foundation of Berkshire Hathaway had cracked, leading to major structural issues that once rebuilt became a well-respected conglomerate. Its extraordinary transformation took place using what in hindsight were very ordinary and timeless basic principles of business. Applied step by step, year by year, and decade by decade, the ordinary was molded into the extraordinary. Berkshire's transformation can easily be attributed to the one man who was the constant during this time. Yet Buffett is only part of the story, albeit a big part. The other man is Charlie Munger, whom Buffett credited as the architect of Berkshire Hathaway for his influence turning Berkshire's focus toward buying good businesses to hold for the long term. The blueprint he gave me was very simple. Forget what you know about buying fair businesses at wonderful prices. Instead, buy wonderful businesses at fair prices. These businesses were deceptively simple. Yes, they were in understandable industries such as insurance, retail, manufacturing, newspapers, and financing. But many shared a trait that most businesses only wish for, an economic moat or a sustainable competitive advantage. Berkshire's protective umbrella and autonomous operating philosophy were a system that maximized human potential and allowed businesses to flourish. Berkshire Hathaway's story also includes hundreds of owners and families that built up many of the companies Berkshire came to own after shifting focus away from textiles. It includes the hundreds of thousands of employees that worked along with them, and it includes the hundreds of thousands of shareholders who made a long-term commitment to the company. Berkshire, then, is an amalgamation of these parts, all working together over a very long period. In 1965, when Buffett took over, Berkshire Hathaway did not make the Fortune 500 list. In 2014, it was number 4 behind Walmart, ExxonMobil, and Chevron, and ahead of Apple. We can see the evolution of the company by examining its history in the broad decades-long periods outlined in this book. 1965 to 1974. After taking control of Berkshire in May 1965, Buffett quickly learned how difficult it was to operate a commodity business in a declining industry. Buffett's raw material was a dying textile company with $22 million in net worth, no durable competitive advantage, and a high capital cost. He quickly set to work redeploying as much of the available capital as possible into other businesses. 2 seminal acquisitions occurred during this decade that shaped the future trajectory of Berkshire Hathaway. One was the acquisition of National Indemnity, which became the platform for future expansion into insurance. Buffett quickly grasped the value of low-cost liabilities in the form of float to fuel expansion in other areas. The beginnings of Berkshire's insurance activities provided valuable lessons on the importance of focusing on underwriting profitability above all else. The second influential acquisition was See's Candies. See's provided lessons on the value in buying great businesses for keeps. It set the bar very high for future acquisitions and was a marked contrast to its sister textile companies. Buffett made other important capital allocation decisions during this time. Berkshire purchased a newspaper, a bank, and made investments in marketable securities. One of the most marketable securities was blue-chip stamps. Deploying the float in the shrinking trading stamps business, Buffett and Munger used blue-chip stamps as a platform to acquire C's and eventually other good businesses before the core trading stamp business withered to almost nothing. By the end of the decade, textiles had shrunk from the entirety of Berkshire Hathaway's business to about 30% of consolidated revenues and just 5% of total assets. The decline came from a combination of shrinking textile operations and expanding into new business lines. Textiles remained much longer than they probably would have had Buffett not chosen Berkshire as his investment vehicle. 1975 to 1984. The decade that ended in 1984 was marked by continued expansion of insurance operations and the acquisition of other non-insurance operating businesses. Written insurance premiums swelled 129% from $61 million in 1974 to $140 million in 1984, as Berkshire expanded operations organically and by forming numerous insurance companies. Its entry into reinsurance meant not only more float, but also longer-lived float. The big news of the decade was the acquisition of 36% of Geico. Berkshire's share of Geico's premium volume amounted to $336 million, which dwarfed its homegrown operations. The decade also witnessed the mergers of diversified retailing and blue-chip stamps into Berkshire. With blue-chip stamps came Wesco, yet another platform for expansion, this time into banking and insurance. Through blue-chip stamps, Berkshire acquired other non-insurance operations, including the Buffalo News and Precision Steel. The non-insurance companies acquired during this decade illustrated Buffett's appreciation of locally dominant businesses. While the Buffalo News experienced some initial threats, Buffett and Munger saw that one newspaper towns would create a protective moat, allowing for superior returns on capital. Buffalo was a two-paper town at the time of the acquisition, but became a one-paper town within 5 years, with the Buffalo News the last one standing. Buffett also correctly identified Nebraska Furniture Mart as a dominant local business whose competitive advantage was created and reinforced by low margins coupled with huge volumes. Berkshire's investment activities during this period showed the value of taking partial ownership interest in wonderful companies. Gains from the investment portfolio were responsible for 58% of the increase in Berkshire's net worth during this decade, compared to just 11% of the prior decade. The investment portfolio reflected lessons learned elsewhere. Berkshire's success owning the Washington Post stock and the Buffalo News led it to invest in other media company stocks, including American Broadcasting Companies Incorporated, Capital Cities, and Time Incorporated. Other stocks acquired during this time were mostly in simple, understandable businesses whose share prices had declined out of line with their underlying intrinsic values. Like a threadbare shirt, the last bit of Berkshire Hathaway's original business held on through this decade. By the end of 1984, though, the writing was on the wall for textiles. Almost immediately after acquiring Wambeck Mills, it was recognized as a mistake. The additional textile mill was eventually shuttered and faded along with the remainder of Berkshire's original textile operations. Textiles were no longer a profitable business. 1985 to 1994. The decade that ended in 1994 marked when Berkshire hit its stride. During this decade, Berkshire perfected its understanding of insurance. It lost money in all but 2 of these years, 1993 to 1994, and used those lessons to ingrain in the entire organization a philosophy of underwriting profitability first and foremost. Berkshire moved confidently into reinsurance and generated huge amounts of float to invest in marketable securities. Its strong balance sheet provided a double benefit. One was little restriction on where it could invest its float. Another was the ability to advertise its financial strength to attract additional reinsurance business. The major capital allocation decisions made during this decade were not complicated. Some of the businesses, such as Scott Fetzer and Fetchheimer, were easy to understand but had been shunned by others. Berkshire provided a permanent home for these and many other simple businesses, and importantly allowed managers to operate with autonomy almost unheard of in corporate America. Buffett could do this because of a basic tenet he followed: to go into business only with people whom I like, trust, and admire. The marketable securities portfolio was responsible for 68% of the increase in Berkshire's net worth during this period. Here, too, the investments were not complicated and easy to fully understand in hindsight. Berkshire's experience with See's Candies led it to acquire a large stake in the Coca-Cola Company. Other investments during the decade included banks and consumer goods companies. Some of the investments, such as the Washington Post, ABC, which had merged with Capital Cities, and Geico, remained undisturbed and were viewed as near-permanent investments. Buffett's commentary to shareholders highlighted the large look-through earnings the portfolio represented to Berkshire and, by extension, its shareholders. The decade was not without its mistakes. Buffett later pointed to the acquisition of Dexter Shoe as the worst in Berkshire history because of the shares issued to acquire a business whose value quickly evaporated. Two of Berkshire's investments in convertible preferred stocks also caused trouble. U.S. Air almost caused a loss, and its Solomon Preferred caused a major distraction for Berkshire when Buffett temporarily took the helm of the investment bank to save it, something he had never done before. This short stint proved the advantages of allowing subsidiaries much autonomy. Berkshire Hathaway ended 1994 free of the financial and managerial drag of the dying textile business, having shuttered the last of the operations in 1986. 1995 to 2004. The 1995-2004 decade represented a rounding out and expansion of Berkshire's core operations. It also set the stage for the next phase of Berkshire's existence. During this decade, Berkshire purchased the remaining half of Geico it did not already own. It also acquired General Re by issuing shares. These insurance acquisitions were the final two pieces of Berkshire's insurance empire, which now included a major auto insurer, two reinsurance operations, and a host of smaller primary insurers that filled various niches of the insurance world. The acquisitions and organic growth swelled average float nearly 15-fold to $45 billion. Berkshire acquired dozens of simple and essential non-insurance businesses during this decade. Many were shunned over emerging tech companies during the dot-com boom of the early 2000s. The numerous larger acquisitions in the non-insurance category were bolstered by many more bolt-on acquisitions. These fell under the direction of existing management and caused little to no additional work at headquarters. The acquisition of Mid-American set the stage for Berkshire's future. In the utility, Berkshire obtained an outlet for its growing streams of cash. Future returns would be lower in more capital-intensive businesses like utilities, but the certainty attached to those capital outlays and ability to invest large sums of incremental capital made it an attractive platform. Berkshire's large base of taxable income elsewhere within the conglomerate provided an added advantage to its utility operations not available to its standalone peers. Berkshire ended the decade with $40 billion in cash and not enough attractive outlets to invest in despite the frenzy of acquisition activity. The idle cash was a symptom of Berkshire's growing size and the shrinking universe of investment opportunities available to move the needle. 2005 to 2014. The decade that ended in 2014 may well have been the last where Berkshire was able to retain most of its earnings. Its rate of growth in book value per share slowed dramatically as cash accumulated without enough investment opportunities. Berkshire implemented a buyback policy and bought back its own shares on two occasions, totaling $1.7 billion. The acquisitions made during this decade were numerous. It ended the decade with the Powerhouse Five, consisting of Berskhire, Marmon, BNSF, Lubrizol, and Berkshire Hathaway Energy, formerly Mid-American. Only the last was around in 2005. These businesses were easy to understand and provided a product or service sure to be needed long into the future. Two of them, BNSF and Lubrizol, were large public companies before joining Berkshire. With BNSF, Berkshire gained another utility-like operation that could take massive amounts of capital investment. These and numerous other acquisitions, including many bolt-on acquisitions, resulted in 70% of the change in net worth coming from operations, up from 26% the previous decade. Berkshire's size and cash reserves had its advantages. During the Great Recession of the mid-2000s, it made very attractive fixed maturity investments at a time of very low interest rates when other businesses were short on cash. Berkshire also secured significant equity stakes along with them. Berkshire's unparalleled balance sheet strength created reinsurance opportunities other companies couldn't offer, including a single premium totaling $7.1 billion. Concentrated investments. Examining the broad arch, we can see that this half-century of Berkshire Hathaway's history consisted of a series of large, concentrated capital allocation decisions mixed with many smaller ones. See Table 8.6. At the end of the decade, Berkshire's equity investments were highly concentrated with the Big Four, American Express, Coca-Cola, IBM, and Wells Fargo, accounting for 59% of the portfolio. Berkshire's acquisitions were similarly concentrated. The largest acquisition in each decade represented no less than 15% of equity capital at the time of acquisition. Berkshire's capital allocation strategy was one of patient opportunism. It made or held large partial interest in companies via the stock market and acquired successively larger companies as each decade went on. Rocket fuel, insurance float. Insurance float was perhaps the single most important factor driving Berkshire's growth over the first 50 years. Float produced both capital to deploy advantageously and substantial underwriting profits. Berkshire was in the insurance business 48 of the first 50 years of its modern existence. Discounting the partial first year in 1967, there was a negative cost of average float for 27 years. In just 8 of those years was Berkshire's cost of funds higher than that of the long-term U.S. government bond. As time went on, Berkshire perfected its underwriting. This double benefit, increasing float and a loss experience that improved over time, resulted in substantial profits. Most of Berkshire's cumulative underwriting profits came in the last decade. See Table 8.7. A self-forged anchor. Berkshire Hathaway was the victim of its own success. As the conglomerate grew larger and larger by retaining earnings, the universe of investment opportunities shrank dramatically. Compounding the problem was a market for businesses, either in part via the stock market or in whole, that became more efficient as the years went by. In Berkshire's early years, good companies were available for bargain prices. It bought the Illinois National Bank and Trust Company and the Buffalo News at book value, and the discarded Scott Fetzer and Fetchheimer at premiums that still produced going-in pre-tax returns in the mid-20% range. During the decade ended in 2014, it purchased a variety of businesses, some with underlying returns on capital well into the double digits. But the prices paid for these acquisitions cut the going-in returns down to the low double digits or even single-digit range. By charting a sample of Berkshire's acquisitions by purchase multiples and going-in returns, we can see both the value of different companies and a hint of the market situation when they were purchased. See Figure 8.2. Generally, the better the business was, the higher its price, as represented by purchase multiple paid compared to the company's underlying value. The return on capital of the underlying businesses, the company-level return, ranges widely. The 3 major outliers are See's, Scott Fetzer, and Fetchheimer. See's was one of the Berkshire's earliest purchases and was made when markets were not as efficient. The low Scott Fetzer and Fetchheimer purchase multiples reflected that Berkshire could act as a safe port amid the leveraged buyout storm of the mid-1980s. By contrast, Lubrizol and Heinz were excellent companies earning great returns on capital, but the price Berkshire paid reflected the market's correct appraisal of that fact. We can see the outperformance of Berkshire's book value and market values compared to the total return of the S&P 500 decline over its 50-year history. See Figure 8.3. Its advantage in compounding book value per share peaked at 20% in the early 1980s and steadily declined to the single-digit percentage point range at the end of 2014. Buffett was direct in his 2014 special letter discussing Berkshire's past, present, and future. The bad news is that Berkshire's long-term gains, measured by percentages, not by dollars, cannot be dramatic and will not come close to those achieved in the past 50 years. The numbers have become too big. I think Berkshire will outperform the average American company, but our advantage, if any, won't be great. Broad lessons. Examining Berkshire's 50-year history through 2014, several major lessons stand out. Circle of competence. Buffett and Munger, for the most part, stayed within their circle of competence. Building Berkshire used common sense and a focused strategy of choosing long-term businesses and investments with good economics that they understood well. Business focus. A central guiding principle was to focus on the underlying business. It did not matter whether the actual investment was a whole company, part of a company via stocks, or lending to a business via fixed income investments. A focus on the long-term economic characteristics of businesses was paramount to Berkshire's success. This included seeking businesses with strong economic moats. Financial and operational conservatism. Berkshire benefited to an enormous degree from the float in insurance and to a lesser extent the trading stamp business at Blue Chips before it faded. Some debt was used when it was available on attractive terms, and later the utility businesses used debt as appropriate. Berkshire did not seek to increase returns by employing leverage. Its conservatism also extended to accounting. Countering the tendency toward optimism and under-reserving, its loss reserving consistently overestimated insurance losses, which led to many years of favorable loss development. Berkshire took calculated risk with its capital and never suffered a large loss in relation to equity. It moved forward quicker by avoiding significant backward steps and common pitfalls. Opportunism. Building Berkshire was an exercise in patience combined with opportunism and a reminder that opportunity cost matters. There was no grand strategy. Rather, Berkshire stood ready to make decisions as they arose. Each new investment was measured against what was already available. This included if and when to issue or repurchase its own shares. Related, Buffett maintained an entrepreneurial spirit that encouraged those within Berkshire to continually push the boundaries. Some of these entrepreneurial ventures failed, such as some of their early home state operations, Geico's credit card, and multiple attempts to expand seas beyond the West Coast. Concentrated investments. As we discussed above, Berkshire combined its patience and its financial resources to make large investments when they became available. On more than one occasion, Buffett and Munger made investments that would not have been made if their objective was to avoid any risk. Conglomerate structure. The conglomerate structure conferred many advantages to Berkshire. The two biggest were the ability to move capital seamlessly between operating segments and take advantage of tax benefits not available to others. Berkshire's purchase of several public companies meant those companies no longer had to spend time attracting capital for worthwhile projects or otherwise appease a sometimes short-sighted investor base. Buying for keeps also meant Berkshire could afford a permanent home for businesses built by individuals or families whose primary motivation was not to maximize the sale price. Berkshire's conglomerate structure will be discussed in more detail in Part 10. Autonomy. Related to the conglomerate structure, the extreme autonomy given to operating managers meant the company could scale almost without limit and not become unwieldy. Autonomy had the added benefit of providing managers with a sense of ownership that motivated them outside of any monetary benefits. Berkshire maximized business potential by maximizing human potential. The transformation Berkshire underwent during the 1965-2014 period was nothing short of breathtaking. Chapter 15, 2015 to 2017. Introduction. Berkshire Hathaway entered its sixth decade of transformation in uncharted territory. It wasn't just that one man held the reins for so long, though that is noteworthy. A conglomerate of Berkshire's size simply hadn't existed before. How would the playbook change as capital began to accumulate faster than it could profitably be allocated? Since this book is finalized in 2020, we must wait to see the longer story unfold. The first 5 years of the 2015-2024 decade looked much like the decade that preceded it. In short, Berkshire continued to make the most intelligent decisions at any time. The conglomerate generated huge amounts of capital between 2015 and 2019, thanks to retained earnings and the effects of compounding. Berkshire continued to benefit from a playbook that included options to allocate capital into wholly owned businesses or stocks. It found some smart uses of capital in the face of sky-high business valuations and an ever-advancing stock market fueled by continued low interest rates. One major acquisition materialized, as did a host of smaller bolt-on acquisitions that soaked up some capital. So too did Berkshire's partnership with 3G Capital, which allowed it to add another household name to the roster of businesses it owned or controlled. Berkshire's future in a post-Buffett world became clearer during this time. It restructured management and promoted 2 longtime lieutenants to vice chairman. However, the question of who would succeed Buffett as CEO remained. The gusher of cash found a partial relief valve in an expanded share repurchase program. Berkshire modified the criteria and returned a modicum of capital to shareholders in the form of buybacks. Would Berkshire have opportunity to return more cash through buybacks? Would it institute a dividend? These questions remained as cash built to a record $128 billion at year-end 2019, despite best efforts to use it. One fact remained very clear. Warren Buffett and Charlie Munger weren't done shaping Berkshire Hathaway. 2015. Berkshire's gain in net worth during 2015 amounted to $15.4 billion, an increase of 6.4%. This was significantly ahead of the 1.4% gain recorded for the S&P 500, but in 2014, Buffett had switched his preferred yardstick to Berkshire's change in market value per share, which fell 12.5%. These were two competing data points. Which to believe? Buffett was confident the market value metric would prevail over time. He knew Berkshire's share price, like that of the market in general, would rise and fall, but eventually settle close to intrinsic value. A single year was not enough data to draw any definitive conclusion. Buffett preferred to look at Berkshire's progress building normalized earnings power, earnings excluding any gains or losses from marketable securities or derivatives, to evaluate a single year, and he thought Berkshire had a good year on that front. The Powerhouse Five, the largest non-insurance businesses, comprised of Berkshire Hathaway Energy, BNSF, Berskhire, Lubrizol, and Marmon, reported record earnings. That included the turnaround by BNSF, which earned Buffett's praise in 2015 after disappointing the prior year. The dozens of other non-insurance businesses increased their earnings too. Insurance turned in its 13th consecutive year of underwriting profits and again increased float. Large capital expenditures and many bolt-on acquisitions increased the earnings power of Berkshire's existing businesses. The partnership with 3G Capital expanded again when Heinz merged with Kraft to create a consumer brand giant. Additional capital was put to work in equity securities. In Buffett's chairman's letter, he provided an update on the two quantitative factors he thought useful for estimating Berkshire's intrinsic value. For the first time, he included underwriting profit in the per-share operating earnings figure. His reasoning was the underwriting business had changed substantially, earnings were more stable than a decade or two ago, and were less heavily influenced by catastrophe coverage. Still, Buffett was quick to point out that an underwriting loss remained possible as the supercat business hadn't gone away. It just diminished in relation to other business. Insurance. The insurance group delivered a $1.8 billion pre-tax underwriting gain in 2015, in addition to increasing year-end float by 4.5% to $87.7 billion. Each major insurance segment was profitable, though not without their unique challenges. Geico. Geico reported mixed results. In the plus column, a combination of rate increases and policyholder growth expanded earning premiums 10.8% to $22.7 billion. Its market share grew from 10.8% to 11.4%. Underwriting expenses, at 15.9% of premiums, had a fourth consecutive year of improvement. That's where the good news ended. Losses ballooned by 4.4 percentage points to 82.1% of premiums. The cause was an increase in both frequency and severity of claims. Such an increase could only be attributed to more drivers using smartphones. The higher loss experience caused Geico's underwriting profit to decline 60% to $460 million, a 98% combined ratio. It would have to increase premium rates even more to counter the higher loss experience and return to historical rates of profitability. General Re. General Re also faced headwinds in 2015. High industry capacity, depressing pricing, and reduced Gen Re's appetite for new business. But Gen Re remained profitable, a reflection of its culture of aiming for underwriting profits irrespective of volume. Its overall pre-tax underwriting gain fell 52% to $132 million on earned premiums that declined 5% to $6 billion. Gen Re was the only insurance unit to experience a decline in float during the year, which fell 3.7% to $18.6 billion. Earned premiums in property casualty were $2.8 billion, a decline of 10%, 2% adjusted for currency. Pre-tax underwriting profits fell 26% to $150 million. An explosion in Tianjin, China, costing $50 million, was the only major catastrophe loss, but higher loss ratios elsewhere weighed on profitability. Property gains totaled $289 million and benefited from favorable loss development. Casualty losses of $139 million included charges for discount accretion on workers' compensation liabilities and deferred charge amortization on retroactive reinsurance contracts, a drag that would continue largely independent of year-to-year charges and premium volume. Consistent current year losses on casualty business largely stemmed from Gen Re's conservative underwriting. In each year since 2009, the casualty lines reported favorable development of prior year business. Gen Re's troubled history was close enough in the past to remind it that continued discipline was required for good results in reinsurance. The life health lines reported losses of $18 million compared to a $73 million gain the year before. Earned premiums were flat at $3.2 billion, but would have increased 8% if not for currency headwinds. New business came from markets in Canada and Asia. Weakness in its North American long-term care business and in individual life caused profitability to decline. Berkshire Hathaway Reinsurance Group. BHRG also faced headwinds from depressed pricing. It too remained profitable, though its pre-tax underwriting gain fell 31% to $421 million on earned premiums that declined 29% to $7.2 billion. Ajit Jain earned his usual praise from Buffett in the chairman's letter. It's easy to see why. Even in the face of industry headwinds, Jain's group increased float 4% to $44 billion. Earned premiums and property casualty increased 8% to $4.4 billion, but profits fell by 33% to $994 million, a stellar result by any measure. A new 10-year, 20% quota share contract with Insurance Australia Group that started on July 1st more than offset declines in earned premiums from property catastrophe, property quota share, and London markets. The only notable catastrophe loss was an $86 million loss from the same explosion in China that hurt Gen Re's results. The retroactive reinsurance segment all but disappeared. Premiums written and earned amounted to just $5 million in 2015, down 99.9% from the $3.4 billion the year before. Such a decline reflected Berkshire's willingness to walk away when business was not available at appropriate prices. Shutting off the spigot revealed the impact of the deferred charges Buffett frequently pointed to as a drag on reported earnings. The retroactive segment reported a loss of $469 million, with all but $60 million stemming from deferred charge amortization. Earned premiums from life health increased 4% to $2.8 billion. A loss of $54 million was an improvement from a $173 million loss the year before. In 2015, Berkshire broke down the life health segment into 3 additional categories. Each category was tied to time value of money concepts and produced accounting charges that hid the valuable economics of its float. The categories were: 1. Periodic payment annuity. Berkshire received upfront premiums and made payments stretching over decades. This type of business records no gain or loss up front. Instead, charges are recognized over time like the deferred charge amortization on retroactive reinsurance business. In this case, they arise because liabilities are discounted up front to account for the time value of money, and the charges, called discount accretion, are taken into earnings. 2. Life insurance. Berkshire took the risk from the direct writers of life insurance. 3. Variable annuity. This business guaranteed closed blocks of variable annuity business written by direct writers. Berkshire Hathaway Primary Group. The primary group grew earned premiums 23% to $5.4 billion and pre-tax underwriting profit by 32% to $824 million, an 84.7% combined ratio. Major contributors were the new Berkshire Hathaway Specialty Group, NICO Primary, the Home State Companies, and Guard. BH Specialty Group grew premium volume to $1 billion, an incredible achievement considering the unit was formed in 2013. Regulated, capital-intensive businesses. In 2015, BNSF regained its good graces with Buffett by improving its service levels. Just as Buffett predicted the previous year, the railroad's financial performance followed suit. Pre-tax profits grew 10% to a record $6.7 billion. Bolstering growth were massive capital expenditures of $5.7 billion, almost 3 times depreciation charges. This was as it should be. Berkshire's railroad carried 17% of all intercity freight in the U.S. during the year. BNSF's 5.5% decline in revenues to $22 billion illustrates the importance of understanding the underlying business model of a company and paying attention to the right variables. One of the largest expenses of any railroad is fuel, and most pass these costs through to shippers. A 41% decline in fuel costs during the year was the major reason why BNSF's revenues declined during 2015. Its freight volume was flat at 10.3 million units, which shows the railroad regaining control of expenses. Berkshire Hathaway Energy, BHE, increased EBIT 6.8% to $3.4 billion. Berkshire's share of net earnings grew 13% to $2.1 billion. A large part of that increase came from the addition of AltaLink, the Alberta, Canada-based electric distribution business acquired in late 2014. BHE's existing business continued to generate the stability inherent in their business models. Two items of note affected the financials. One was a strong increase in the value of the U.S. dollar. This had the effect of reducing reported revenues and earnings from UK-based Northern Power Grid. The other item affecting the financials was a decline in energy costs. Like BNSF, BHE passed along these savings to customers. This was to be expected from a heavily regulated business. Manufacturing, service, and retailing. Berkshire again revised its presentation of the MSR business. Nothing changed operationally. The businesses were split into two broad categories, manufacturing businesses and service and retailing businesses. Both were further delineated into three main segments. See Table 9.7. McLean was reported separately because its revenues were large compared to Berkshire's total. Earnings for the group totaled $36.1 billion, down 2%. Comparative results, undisclosed, were poorer considering Berkshire made acquisitions in the segment during the year. With so many businesses to report, the categories were logical, but some analysts pined for additional data. Results from large companies like Shaw, Lubrizol, IMC, as the parent company of Berskhire, and Marmon were aggregated and discussions squeezed into just a few paragraphs, along with many other businesses, instead of being individually reported. Some had previously been public companies that produced annual reports hundreds of pages long. Much of that data was now gone as part of Berkshire's reporting. Many of the businesses were similar enough that the consolidated data was still valuable. The report did identify specific businesses where the impact was meaningful, but Berkshire's growth diminished the importance of the individual businesses compared to the whole. Industrial products, revenues of $16.8 billion, down 5%. A big part of the 5% decline in pre-tax to $3 billion earnings from industrial products came from a stronger U.S. dollar. IMC was likely responsible for most of the impact as it was the largest business in the segment and located overseas. A slowdown in demand began over the second half of the year and was expected to continue into 2016. Building products, revenues of $10.3 billion, up 1.9%. This was the only manufacturing segment to increase earnings. The large 30% jump in earnings to $1.2 billion on just 2% increase in revenues was a result of higher unit volume, lower raw materials costs and energy savings, offset by the strong U.S. dollar, and restructuring costs. Bolt-on acquisitions increased earnings as well. The large increase in earnings illustrated by the pricing power of those businesses. The segment included Shaw, Johns Manville, Acme Building Brands, Benjamin Moore, and Mytech. These businesses did not face regulation and were not required, like Berkshire Hathaway Energy and BNSF, to pass along savings to customers. Crucially, their competitive positions did not require it either. Some unregulated businesses nonetheless face competition so intense they must pass on savings to customers to retain business. Consumer products, revenues of $9.1 billion, flat. Earnings from consumer products fell 3% to $732 million because of a loss at Fruit of the Loom related to selling an unprofitable unit, and declines in footwear. Earnings at Forest River increased on higher unit sales and increased prices. Service, revenues of $10.2 billion, up 3.5%. This was the only service and retailing segment to see a decline in earnings, which fell 4% to $1.2 billion. NetJets expanded operations but faced lower margins and higher costs, including a one-time lump sum payment related to a collective bargaining agreement that weighed on the results of the entire segment. Newspaper revenues, and presumably profits, declined. Offsetting this was the addition of WPLG, the Miami, Florida television station Berkshire acquired in 2014, and the addition of Charter Brokerage. Retailing, revenues of $13.3 billion, up 214%. This segment welcomed two new businesses in 2015, which increased pre-tax earnings by 64% to $564 million. The first was the Van Tool Group, a group of 81 automotive dealerships located in 10, mostly western U.S., states. The acquisitions also included Van Tool's two related insurance businesses, 2 auto auctions, and a distributor of automotive fluid maintenance products. Buffett met Larry Van Tool years before, and the Van Tools decided Berkshire would be a good permanent home for their business. Upon joining Berkshire, Van Tool was renamed Berkshire Hathaway Automotive. The business was built by Larry Van Tool and his father, Cecil, over 62 years. A key insight the Van Tools had, and Buffett shared, was creating a sense of ownership with each local manager. We will continue to operate with extreme, indeed almost unheard of decentralization at Berkshire, he explained to shareholders. This allowed them to successfully grow the business to the 5th largest auto group in the U.S. A limited amount of data was available on the Van Tool acquisition. Buffett put the company's annual sales volume at $9 billion. Industry commentators thought pre-tax earnings might be between $350 and $471 million. The purchase price of $4.1 billion included $1.3 billion in cash and investments. Adjusting for cash, it appears Berkshire paid between 6 and 8 times pre-tax earnings. This apparent bargain price looks less rich considering that light vehicles, sales of cars, vans, SUVs, and smaller pickup trucks, were at or near recent highs of about $17 million annually. The second acquisition of 2015 in this segment was Detlev Lewis Motorrad. The company was one of the largest retailers of motorcycle accessories in Germany. The acquisition was too small to be detailed in the Berkshire annual report. Some sources put its annual revenues at around 270 million euros, about $300 million, and the purchase price at about 400 million euros, about $444 million. The deal was notable in another way. Buffett tapped Ted Weschler to negotiate the deal and then made him chairman to oversee the investment. Earnings from Berkshire Hathaway Automotive and Detlev Lewis Motorrad were the primary reason for the 64% increase in retailing earnings in 2015. Furniture retailing revenues increased 24% from the new Nebraska Furniture Mart store in Texas and increases from R.C. Willey and Jordan's. McLean, revenues of $48.2 billion, up 3%. Berkshire's only standalone business other than BNSF, McLean, increased volumes in food service, up 6%, beverage, up 8%, and grocery, up 2%. This was another business able to directly benefit, at least in the short run, from the decline in fuel costs. Pre-tax earnings grew 15% to $502 million. A $19 million gain, or about 4 percentage points, came from a one-time gain from the sale of an undisclosed subsidiary. Finance and financial products. Pre-tax earnings in finance and financial products jumped 13% to $2.1 billion. The major driver of the increase was a 27% increase to $706 million in earnings from Clayton. Clayton increased unit sales and benefited from lower interest costs and lower delinquencies foreclosures. Marmon's tank leasing business, UTLX, and Extra's trailer leasing business were lumped into transportation equipment leasing. Pre-tax earnings of these businesses increased 10% to $909 million. Part of that increase was a $1 billion purchase of 25,085 tank cars from General Electric, bringing its total to 133,280. UTLX also acquired several businesses during the year to continue building out its full-service maintenance operation. Berkshire couldn't come close to the financing advantages of banks to conduct pure leasing operations. Both the tank leasing business and Extra's trailer leasing business had important service components that added value above and beyond a simple financing arrangement. Everything else from Court to Berkadia and fees charged to Clayton and NetJets for use of Berkshire's credit fell to the other category. Earnings in that category increased 4% to $471 million. Investments. Berkshire's investment portfolio saw few changes in 2015. A net $1.5 billion was invested in equities funded by a few sales. The most notable sales were Berkshire's positions in Swiss Re and Munich Re, two European-based reinsurers. The position in Munich was valued at $4 billion at year-end 2014. Swiss Re was too small to be specifically identified. Buffett elaborated on his reasoning for selling the investments at the 2016 annual meeting. He said it came down to two factors, and neither was related to management, which he continued to admire. One, an influx of capital that flooded the reinsurance industry and pressured premium rates. This was likely to continue for some time. Two, low interest rates made insurance float much less valuable. That was more important for European-based insurers since interest rates were low or even negative. Berkshire would be hurt by the competition in low rates, but it had more options to invest its float, including the acquisition of non-insurance subsidiaries. The largest additions to the investment portfolio were not new companies, but bigger investments in existing companies, in this case, two of the Big Four investees. Berkshire increased its investment in Wells Fargo by an additional $859 million and IBM by $634 million. Berkshire's interest in the other two Big Four investees also increased as American Express and Coca-Cola repurchased shares during the year. Buffett estimated that a 1 percentage point increase in any of those companies increased Berkshire's portion of their annual earnings by $500 million. He was enthusiastic about their management and long-term potential and reminded shareholders why he didn't mind owning non-controlling interest in other companies. Having stocks as an outlet for capital allocation provided two other advantages. One was the ability to put capital to work when it represented the best opportunity available. The other was the reverse, as having a huge portfolio of marketable securities gives us a stockpile of funds that can be tapped when an elephant-sized acquisition is offered to us. Kraft Heinz. Berkshire again found opportunity with 3G Capital. This time it was the purchase of Kraft Foods Group Incorporated. Like Heinz, Kraft was a well-known consumer packaged food and beverage company that owned many iconic food brands. In addition to its signature Kraft branded lines, the company owned Oscar Mayer, Philadelphia Cream Cheese, Velveeta, Jell-O, Cool Whip, Kool-Aid, and Maxwell House Coffee, among many others. Kraft's business was broken down by segment, see Figure 9.1. The Kraft that merged with Heinz had a history with Berkshire Hathaway. Berkshire owned General Foods, Kraft's predecessor company, in the 1980s before it was taken over in a leveraged buyout. General Foods was later combined with Kraft Incorporated and in 2012 was split off from its renamed parent, Mondelez. Mondelez focused on international food and snack brands, while Kraft contained the mostly U.S.-based food and beverage brands. The qualities that attracted Berkshire and 3G Capital to Heinz also attracted it to Kraft. Kraft's brands were iconic and had a long history of consumer purchasing habits. The quality of the brands resulted in significant amounts of goodwill and intangible assets on the balance sheet. Operating them required far less tangible capital, as evidenced by the strong historical pre-tax returns on capital. See Table 9.8. The purchase price for Kraft reflected the quality of its underlying businesses and the expectation that the management team at 3G Capital could implement their cost-cutting playbook. To do that, the existing Heinz shareholders, 3G Capital and Berkshire Hathaway, had to retain control of the post-merger company. The merger was structured such that 3G Capital and Berkshire would end up with 51% of Kraft Heinz, the new post-merger company. Existing Kraft shareholders would receive 49% of the company and a one-time $10 billion dividend funded by an additional equity contribution by 3G Capital and Berkshire. Because Berkshire owned slightly more of Heinz prior to the merger, it ended up with a 26.8% stake in Kraft Heinz. The Kraft Heinz merger was not without its accounting complications. The transaction included the issuance of shares, which reduced Berkshire's ownership from 52.5% to 26.8%. The equity method, the accounting applicable to Berkshire's ownership interest, accounts for that reduction in ownership as a sale. This holds true even though no cash changed hands. If Heinz had issued new shares in exchange for cash, it would have had the same economic effect as Berkshire selling some of its shares. In this case, Berkshire was selling a part of its ownership in Heinz, not for cash, but in exchange for part of Kraft. As a result of the accounting requirement, Berkshire was required to book a $6.8 billion non-cash gain. Because it was only for accounting purposes, there were no tax implications. Productivity and prosperity. Productivity is the amount of output per hour of labor input. Buffett devoted a section of the 2015 Chairman's Letter to productivity, connecting it to both Berkshire's and America's prosperity. The topic was timely and probably prompted by Heinz and Kraft, whose new management at 3G Capital were known for ruthlessly improving productivity, most often by reducing headcounts. Buffett thought the connection between productivity and prosperity was not entirely clear to some, so he provided examples. Farming. The most dramatic example was America's shift away from farming during the 20th century. In 1900, 40% of the country was employed growing America's food. As of 2015, just 2% of the population worked on farms. Productivity allowed this to happen, beginning with the invention and perfection of the tractor and extending to better farming techniques and seed quality. Railroading. After World War II, there were 1.35 million workers employed in the railroad industry, and they moved 655 billion revenue ton miles. Fast forward to 2014, and Class 1 railroads moved 1.85 trillion ton miles with just 187,000 workers. The result was a 55% decline in the inflation-adjusted cost of moving a ton-mile of freight. Safety improved dramatically, too. Using BNSF as an example, Buffett said injuries fell 50% from 1996. Utilities. Berkshire Hathaway's Energies, BHE, Iowa utility in 1999 employed 3,700 people and produced 19 million megawatt hours of electricity. Fast forward to 2015, and it generated 29 million megawatt hours while employing just 3,500 people. Such improvements in productivity allowed BHE to keep rates the same for 16 years. Like BNSF, safety improved too. The examples above prove that increased productivity resulted in real gains to civilization and allowed more to be employed in other industries. But they came with short-term costs, most notably the workers who lost their jobs. Buffett was aware of these costs and had experienced some up close. When Berkshire shuttered its mills in the mid-1980s and at Dexter Shoe years later, it employed older workers with non-transferable skills. Buffett thought the solution was social safety nets that cushioned the blow to the unfortunate workers while leaving productivity to continue working its magic for the benefit of society at large. Both Buffett and Munger were clearly on the side of making operations at Kraft Heinz more efficient. They detested sloppy operations and were ever on the lookout for inefficiencies at Berkshire, noting that once costs crept in, they tended to proliferate. A large and highly profitable conglomerate required continual diligence to protect itself from such tendencies. 2016. Berkshire's gain in net worth in 2016 was 10.7%. Its market value rose 23.4% against a gain in the S&P 500 of 12%. Business results in 2016, and perhaps the strong rise in share price, reflected another good year. The acquisition of Precision Castparts Corporation sopped up some of Berkshire's excess cash. More importantly, it added to the conglomerate's normalized earnings power. Buffett presented a history of Berkshire's progress adding to its earnings power in a table in the chairman's letter. See Figure 9.2. The data show operating earnings grew irregularly but clearly upward over time as Berkshire retained earnings and added earning power. Buffett chose to start his analysis above in 1999 because it was the year after Berkshire acquired General Re by issuing shares. Issuance of additional shares since that time grew the share count by a modest 8.3%. Over that time, Berkshire's operating earnings grew steadily, with a few down years along the way. The only loss year during that time was 2001. After-tax operating earnings totaled $159 billion over the 17-year period. Capital gains were a different story. Those were erratic. Berkshire made no effort to manage the timing or magnitude of capital gains and de-emphasized their importance to any single year. Over time, net capital gains, totaling $39 billion since 1999, were an important source of funding to acquire additional operating businesses, he said. Buffett's goal for Berkshire was to increase operating earnings over time without increasing shares, which would translate into satisfactory increases in per-share value over time. After-tax operating earnings grew from $670 million in 1999 to $17.6 billion in 2016, a compounded annual rate of return of 20%. By this measure, the goal had been met. Precision Castparts Corporation. On January 29, 2016, Berkshire acquired Precision Castparts Corporation, PCC, for $32.6 billion in cash. PCC was based in Portland, Oregon, and made complex metal components and fasteners, primarily for the aerospace and oil and gas industries. Buffett did not hesitate to credit Tom Combs with the idea. The PCC acquisition would not have happened without the input and assistance of our own Todd Combs, who brought the company to my attention a few years ago and went on to educate me both about the business and Mark Donegan, its CEO. Many of its products were critical to the proper functioning of aircraft jet engines, airframes, and industrial turbines, among others. Aerospace represented a significant majority, 70% in 2015, of PCC's business. PCC was one of just a few suppliers able to manufacture products of the size and quality needed for aircraft engine manufacturers and other customers. This technological know-how gave PCC a competitive advantage that was evident in the multi-year contracts it had with major customers. With lives and reputations at stake, PCC's customers thought twice before taking the low bid. PCC's business results reflected its deserved success winning customers. Between 2011 and 2015, PCC increased revenues 61% to $10 billion. See Table 9.9. Its margins were remarkably stable and translated into a pre-tax return on tangible capital in the mid-40% range. Buffett had high praise for Donegan. Mark's accomplishments remind me of the magic regularly performed by Jacob Harpaz at IMC, our remarkable Israeli manufacturer of cutting tools. The two men transform very ordinary raw materials into extraordinary products that are used by major manufacturers worldwide. Each is the Da Vinci of his craft. Buffett's enthusiasm for PCC and Donegan was reflected in the acquisition price. Berkshire paid 6.7 times PCC's underlying capital, which gave it a pre-tax going-in return below 7%. He readily admitted that the low interest rate environment played a part in the price Berkshire paid for PCC. Some wondered how Buffett could agree to spend such large sums of money so quickly. Andrew Ross Sorkin, a journalist invited to ask questions at the annual meeting, summed up the question as follows. Other successful acquisitive companies use teams of internal people, outside bankers, consultants, and lawyers to do due diligence, often over many months to assess deals. Speed may be a competitive advantage. You've done some amazing deals, but does your diligence process also put us at greater risk? While the PCC deal was not as rapid as others in Berkshire's past, Buffett had a couple of years to study it, Berkshire's omission of the multitudes of personnel to assist in the transaction was much different than almost any other acquisition in the business world. Buffett's answer was instructive. It's interesting. We've made plenty of mistakes in acquisitions. The mistakes are always about making an improper assessment of the economic conditions and the future of the industry or the company. They're not a bad lease. They're not a specific labor contract. They're not a questionable patent. They're not the things that are on the checklist, for every acquisition by every major corporation in America. Those are not the things that count. What counts is whether you're wrong about whether you really got a fix on the basic economics and how the industry is likely to develop, or whether Amazon is likely to kill them, in a few years, or that sort of thing. We have not found a due diligence list that gets at what we think are the real risks when we buy a business. Buffett was telling shareholders he had a different system for assessing acquisitions. It might not have fit into the conventions of Wall Street, but the success of Berkshire was proof it worked well. PCC contributed about $1.5 billion to Berkshire's normalized earning power, yet the size of Berkshire Hathaway's existing operations meant it would be included alongside other manufacturing companies in Berkshire's results and not as a standalone business. The conglomerate had swallowed up another Fortune 500 company. Duracell. Berkshire completed another cash-rich split-off, like the ones in 2014. This time it exchanged shares of Procter & Gamble for Duracell, the well-known maker of alkaline batteries. Buffett had been on the board of Gillette when it purchased Duracell in 1996. The exchange was valued at $4.2 billion, including $1.8 billion in cash, and closed on February 29, 2016. The transaction resulted in a non-cash gain of $1.1 billion and likely saved Berkshire about $400 million in taxes. Although Duracell had a long history of operations and commanded a quarter of the market, the company came to Berkshire needing improvements. In 2016, Duracell incurred $109 million in one-time restructuring and integration costs. Manufacturing, service, and retailing. Earnings from the MSR segment increased in 2016 due to the addition of PCC. The rest of Berkshire's businesses in both major categories, manufacturing and service and retailing, were flat. Results varied widely depending upon industry and sensitivity to both the U.S. dollar and oil and gas prices. The group nonetheless earned an impressive 24% on average tangible equity of $24 billion. Industrial products. Revenues of $24.7 billion, up 47%. With the addition of precision cast parts, pre-tax earnings of industrial products grew 41% to $4.2 billion. Adjusting for PCC, revenues declined 5% as demand fell and competition pressured prices. Earnings of this segment would have fallen too without PCC, but the magnitude wasn't disclosed. This segment was hit hardest by a decline in the price of oil. Lubrizol, a specialty chemical company, was probably hit the hardest. It took a $365 million hit to its earnings to dispose of an unnamed underperforming business. IMC was one of the only businesses in this category to report a small earnings increase, unspecified. Building products. Revenues of $10.8 billion, up 4.4%. The decline in oil prices combined with increased demand for their products benefited the building products businesses modestly. Revenues and earnings increased, and both Shaw and Mytek completed bolt-on acquisitions during the year. Pre-tax earnings grew 1% to $1.2 billion. Consumer products. Revenues of $11 billion, up 22%. These businesses shined in 2016. Pre-tax earnings grew 13% to $824 million, despite a loss from Duracell as a result of its restructuring costs. Revenues at Forest River, the recreational vehicle manufacturer, increased 12%, and earnings grew even more, up 28%. Lower one-time costs compared to 2015 led to a 22% increase in apparel earnings. Footwear earnings declined by an unspecified amount. Service businesses. Revenues of $10.4 billion, up 1.8%. Earnings were flat at $1.2 billion. TTI, the electronics component distributor, grew revenue 7%, but changes in the sales mix and competitive pressures resulted in no change to earnings. This was a good reminder that what mattered was the bottom line profit. Earnings at NetJets increased 19%, but the comparison year had higher subcontracting expenses and asset impairments. Newspapers reported lower earnings, but no figures were provided. None of the other businesses in this category were discussed, including Flight Safety, Dairy Queen, and Business Wire. Retailing. Revenues of $15.1 billion, up 14%. Pre-tax earnings increased 17% to $659 million and included a full year of results from Berkshire Hathaway Automotive and Lewis, the German motorcycle accessory retailer. Earnings from those businesses and increased earnings at other unspecified retailers in this segment contributed to higher overall earnings. Both Nebraska Furniture Mart and Jordan's Furniture opened new stores during 2015 that contributed to results in 2016. Home furnishing revenues increased 8%. McLean. Revenues of $48.1 billion, down 0.3%. McLean had the rare off year. Revenues were almost flat, but its earnings fell by 14% to $431 million. The cause was an increase in labor costs and a comparative year that included a $19 million gain from the sale of a subsidiary. Insurance. The insurance group delivered its 14th consecutive year of underwriting profits. It was also the 5th straight year where each of the 4 major segments reported profits. Berkshire's insurers reported a consolidated pre-tax underwriting gain of $2.1 billion and grew year-end float by 4.4% to $91.6 billion. See Table 9.11. Buffett put forth Berkshire's not-so-secret reasons for its success, writing that a sound insurance operation needs to adhere to 4 principles. It must, 1. Understand all exposures that might cause a policy to incur losses. 2. Conservatively assess the likelihood an exposure causes a loss and the cost of it. 3. Set a premium that delivers a profit, on average, after prospective loss costs and operating expenses. 4. Be willing to walk away from business that is not profitable. Many insurers passed the first 3 tests and flunked the 4th, he said, but Berkshire was different. Berkshire often left the table with money in its pocket, in search of a better deal. Its 2 reinsurers knew this playbook well and continued to swim well against a strong tide. New capital entering the industry continued to pressure rates. Buffett went so far as to say he thought the next 10 years could be difficult and almost certainly not as good as the previous decade. Notwithstanding the headwinds, both General Re and Berkshire Hathaway Reinsurance Group, BHRG, reported underwriting profits for the year. Geico. High expenses continued to weigh on Geico's results, but its 98.2% combined ratio and $462 million profit were only poor in comparisons to its past profitability. Losses from hailstorms and flooding kept the loss ratio elevated even after the company instituted price increases. Those price increases and additional policies in force led to a 12% increase in earned premiums to $25.5 billion. Growth was good when Geico was underwriting profitably. More appropriately, priced policies in force would lead to more profits and more float, a simple recipe for success. Incentives were a key reason Geico's market share continued to grow year after year, ending 2016 at 12%, up from 11.4%. Geico's incentive compensation system is beautifully simple. It consists of two primary variables. The first is growth in policies in force. The second is the profitability of seasoned business. Everyone at Geico from the front lines up to the CEO depended on those two variables. The more senior you are, the larger incentive compensation is in relation to your base pay. This accomplished Buffett's goal of having Geico deliver both more business and profitable business. It totally aligns the goals of the organization in terms of compensation with the goals of the owner, he told shareholders at the 2016 annual meeting. Didn't other insurers use this simple and almost obvious two-pronged approach? Not necessarily. And why not reward employees for Geico's bottom line? The answer lay in the way the incentive structure shaped behavior. Buffett knew focusing on Geico's bottom line could have adverse effects. If employees were rewarded based on profits, an easy place to scale back would be in its huge advertising budget. Such short-term thinking would hamper new business growth. On numerous occasions in the past, Geico maintained large advertising expenditures when others were cutting back. This was again the case during the latter part of 2016. The focus on the profitability of seasoned business, returning customers, accomplished two things. For one, it properly incentivized underwriting for profitability, not just growth, a bedrock principle of all Berkshire's insurers. Second, those advertising expenditures cost a lot in relation to the premiums they generated. First-year customers are typically not profitable, but it really pays to have them stick around. Geico first implemented this incentive structure in 1995. 2 decades later, it was still proving its effectiveness. General Re pulled back writing policies due to weak pricing and let earned premiums fall 6% to $5.6 billion. Pre-tax underwriting profits, however, grew 44% to $190 million as a rebound in life health offset a decline in profits in property casualty. Property casualty earned premiums fell 8% to $2.6 billion. Profits of $211 million on property business came after no significant catastrophe losses, but declined from the prior year because of lower favorable loss development. Casualty workers' compensation reported a $94 million loss, which came from the same pattern of current year losses from conservative reserving, favorable loss development on prior year business, and accounting charges related to discount accretion and deferred charge amortization. Gen Re's life health line swung from an $18 million loss in 2015 to a $73 million profit in 2016 due to gains in international business, lower claims severity in North America, and reserving changes. In 2016, Gen Re announced Tad Montross would be retiring at the end of the year after 39 years at the company. Both Buffett and Ajit Jain, who would be elevated to oversee Gen Re in addition to BHRG, praised Montross for turning Gen Re around. Montross will be replaced by another longtime Gen Re insider, Kara Rigel. Berkshire Hathaway Reinsurance Group. BHRG earned premiums grew 18% to $8.5 billion, and pre-tax underwriting profits nearly doubled, up 95%, to $822 million. Lower gains in property casualty, lower losses in retroactive reinsurance, and a return to profitability in life and annuity were responsible for the increases in profit. The property casualty segment increased earned premiums 5% to $4.6 billion. The 10-year 20% quota share contract with Insurance Australia Group that began on July 1, 2015, represented 37% of earned premiums in this line. A catastrophe-free year led to another strong year of profits of $767 million, but lower than the prior year because of lower reductions in prior year loss reserves, i.e., lower favorable loss development adjustments. The retroactive reinsurance line sprang back to life after essentially taking a year off in 2015. Premiums were just $5 million. Almost all the $1.3 billion in premiums earned in 2016 in retroactive insurance came from 3 policies, including $670 million from a contract with Hartford Fire Insurance Company. That policy covered adverse development on asbestos and pollution claim losses, aggregate limit of $1.5 billion. The segment reported a $49 million loss, which had been worse had the U.S. dollar not appreciated and caused a $392 million currency gain from reevaluation of liabilities in other currencies. BHRG's life and annuity business reported an underwriting profit of $104 million on $2.6 billion of premium volume. That line was further delineated into three types of business based on implicit or explicit time value of money concepts, as described more fully earlier in the discussion on 2015. Berkshire Hathaway Primary Group. Primary Group earned premiums 16% to $6.3 billion, but underwriting profits fell 20% to $657 million. The combined ratio deteriorated from 84.7% to 89.5%. Causes of the lower profitability were declines in the level of favorable loss development and higher losses on current year business. The footnotes warned readers not to assume favorable loss development going forward. The primary insurers wrote a lot of business with long claim tails, such as healthcare malpractice and workers' compensation business that could develop unfavorable in future years. Regulated, capital-intensive businesses. BNSF fixed its internal service issues in 2015, only to be hit by external factors that negatively impacted results in 2016. A combination of carload volume declines and a reduction in shipping revenues, largely driven by lower fuel costs, resulted in a 10% decline in BNSF's overall revenues to $19.8 billion. Pre-tax earnings fell 16% to $5.7 billion. Carload volume declined 5% as demand for industrial products fell and coal volume contracted sharply, down 21%. Agricultural volume increased 6% and consumer products increased 1%. Coal volumes decreased in part due to a long-term shift away from using it as a fuel for electrical generation. Low natural gas prices made coal relatively more expensive, leading utilities to stop using it or just use existing stockpiles. The decline in industrial products reduced revenues from that segment by 14% and reflected weakness in oil and gas industries. Its volume wasn't disclosed. Berkshire Hathaway Energy EBIT grew 2.6% to $3.4 billion, while Berkshire's share of net earnings grew 7% to $2.3 billion. The flat result in EBIT masked a wide range of earnings at its many operating subsidiaries. Higher rates and volume combined with lower input costs to increase Mid-American Energy Company's pre-tax earnings by 34% to $392 million. Part of the reason for the strong increase lay with an improved rate increase phased in over 3 years that Mid-American received in 2014. The increase compensated the company for additional wind assets put in place that cut into returns on equity. The last time it increased rates was almost 20 years prior. On the negative side of the ledger, pre-tax earnings at Northern Power Grid fell 20% to $367 million. About half of the decline came from the appreciation of the U.S. dollar against the U.K. pound. The remainder of the decline came from lower distribution revenues and higher depreciation and impairment charges. Earnings fluctuated to a much smaller degree at BHE's other operating subsidiaries. Some benefited from lower input costs, while others passed along most of the savings to customers. Fluctuation in temperatures also played a part in any year by impacting the demand for energy. Finance and financial products. Pre-tax earnings in the finance and financial products business grew 2.1% to $2.1 billion. Clayton's revenues grew 30% to $4.2 billion due to strong demand for homes and an expansion into site-built homes. Clayton purchased its first site-built home builder in 2015, adding 2 more in 2016, and expected to acquire more in the future. Clayton's large mortgage portfolio overshadowed the manufacturing portion of its business, which resulted in its earnings growing just 5% to $744 million. The transportation equipment leasing businesses, Marmon's Containers, Cranes and Railcars, and Extra, increased pre-tax earnings 5.5% to $959 million. Revenue growth of a similar magnitude and lower depreciation charges were responsible for the increase in earnings. A 9% decline in other earnings within finance and financial products offset the increases at Clayton in transportation equipment leasing. Beginning in 2016, Berkshire began charging Marmon's rail and tank car unit for capital like it did for Clayton's mortgage portfolio. Curiously, NetJets wasn't included in that list, which appeared to indicate it paid off its debt or did not seek to benefit from Berkshire's strong credit rating. Investments. Berkshire sold a net $12 billion of equity portfolio in 2016. DaVita fell off the table, presented in the chairman's letter, but remained unchanged. USG Corporation, a drywall manufacturer, also went untouched, but an increase in its market value caused it to make the cutoff. Some notable sales were AT&T, Deere & Company, the maker of John Deere equipment, and Walmart, which was mostly sold. $96 million or 2.5% of the original investment remained at year-end. Berkshire's Procter & Gamble shares were exchanged for Duracell. The additions to the portfolio were notable and garnered much press. The biggest addition was Apple, the maker of iPhones, computers, and other technologies. Over the year, Berkshire amassed a $6.7 billion stake valued at $7.1 billion. The purchase was not by Buffett, but by one or both of Ted Combe and/or Ted Weschler, Berkshire's two investment managers. Each managed over $10 billion at year-end 2016. Buffett gave them wide discretion over the money they managed and only learned about their moves in reviewing month-end reports. The other big move was a series of investments in the airline industry. Berkshire initiated positions in American, Delta, Southwest, and United, together worth $8.9 billion at year-end. Why was Berkshire interested in airlines, especially after almost losing its entire investment in U.S. Air decades earlier and bemoaning the terrible industry economics many times afterwards? The worst sort of business is one that grows rapidly, requires significant capital to engender the growth, and then earns little or no money. Think airlines. Over the ensuing decades, industry consolidation created stable market shares and less intense pricing competition. Spreading the investment over the four largest U.S. carriers was a bet on the industry rather than one airline. Buffett also liked the airlines were buying back a lot of their own shares. Two of Berkshire's biggest investments weren't in the table at all, as they were not simple common stock purchases. Its $5 billion investment in Bank of America preferred stock was worth $10.5 billion due to an option to purchase common shares. The other was Kraft Heinz, which was purchased with 3G Capital and had to be accounted for on equity basis despite Berkshire owning publicly traded common stock. The accounting for Kraft Heinz proved that the value of private businesses could diverge quite drastically from their underlying value. The common stock cost $9.8 billion and was on the books for $15.3 billion. Yet its market value was over $28 billion. Extend the situation at Kraft Heinz to many of Berkshire's other businesses, and one can see why Buffett considered book value an understated estimate of intrinsic value. An ongoing scandal at Wells Fargo shed light on Berkshire's risk management practices. The Wells Fargo scandal involved the bank's incentive structure that rewarded cross-selling accounts. The system backfired when it led to improper account openings. Wells Fargo was Berkshire's largest marketable security holding at year-end, and Carol Loomis used it as a subject of her first question for Buffett at the 2017 annual meeting. Loomis: how do you satisfy yourself that Berkshire isn't subject to the same risk with its highly decentralized structure and the very substantial autonomy given to senior leadership of the operating companies? Buffett's response boiled down to a couple of factors. One was Berkshire's culture. We count very heavily on principles of behavior rather than on loads of rules. Buffett reinforced that behavior whenever he could. This included a biannual letter to Berkshire's managers instructing them never to go near the gray area, and by airing a key part of Buffett's congressional testimony related to the 1980 Solomon scandal every year at the annual meeting. Buffett also said Berkshire was not completely hands-off. It had an internal auditing system that included ways to submit anonymous tips to headquarters in Omaha, a system that brought in over 4,000 tips annually. Some tips amounted to merely griping, but others led to real change. Munger went so far as to say he believed Berkshire would be blindsided by something someday. Munger thought Berkshire would gain more by over-trusting, even if it meant they would miss something big now and again, which would garner an outsized share of press. The Wells Fargo scandal offered two lessons for managers. 1. Incentives work and must be crafted carefully to avoid unintended consequences. Even well-intentioned plans can backfire and cause misery. 2. It's important to act quickly when problems surface. The Solomon and Wells Fargo scandals prove that things only get worse, not better, by delaying. More of Berkshire's many investments made during the recession began winding down in 2016. In September, Wrigley redeemed its preferred stock for $4.6 billion, a hefty sum compared to the $2.1 billion investment and the preferred dividends received since 2008. In December, Dow elected to convert its $3 billion, 8.5% preferred stock investment, into 72.6 million shares, which Berkshire immediately sold. In addition to these redemptions, Kraft Heinz repaid its $8 billion, 9% preferred stock for $8.3 billion. The pre-tax capital gains from these investments amounted to more than $4.2 billion. The total cash received was much higher and left Berkshire with more cash to add to its growing pile, now at $86 billion at year-end 2016. 2017. Berkshire's book value share increased 23% during 2017. That result was 1.2 percentage points better than the S&P 500. Berkshire's $65.3 billion gain in net worth was extraordinary for a conglomerate of its size. Had Berkshire capital allocators finally found the secret to growing a company with a $250 billion net worth by almost a quarter in 12 months? Sadly, no. It came from a tax code change. In December 2017, Congress passed the Tax Cuts and Jobs Act of 2017. That legislation reduced the corporate tax rate from 35% to 21%, among other things, and diminished Berkshire's deferred tax liabilities by $29.1 billion. The lower tax rate meant Berkshire shareholders were entitled to keep more of the conglomerate's profits, and those were growing. Berkshire's operations contributed the other $36.2 billion, or 12.8% of the prior year's net worth. On balance, the year was a good one for Berkshire. Aided by the largest retroactive reinsurance deal in history, the insurance group increased float to record levels. On the negative side of the ledger, several catastrophe losses broke the 14-year streak of overall underwriting profitability. Most of Berkshire's many non-insurance subsidiaries did well during the year, although a few struggled with specific issues. A low interest rate environment made it difficult to compete for acquisitions and swelled Berkshire's cash hoard to $116 billion. Berkshire found modest success during the year on the acquisition front. It spent $2.7 billion on bolt-on acquisitions and made one notable partial acquisition. Pilot Flying J. On October 3, 2017, Berkshire acquired a 38.6% interest in Pilot Travel Centers, LLC, based in Knoxville, Tennessee. The company operated 750 travel centers across the U.S. and Canada, making it the largest in North America with $20 billion in annual revenues. Better known as Pilot Flying J, from the name of its travel centers, the company resulted from 2010 merger of Pilot Travel Centers and Flying J and was led by Jimmy Haslam III, whose father founded a predecessor company in 1958. Berkshire's initial purchase price went undisclosed, but sources later put the figure at $2.8 billion. That implied a valuation of about $7.25 billion for the company. Insurance. Berkshire's 14-year streak of overall underwriting profits ended in 2017. 6 catastrophes, including 3 hurricanes in the United States and Puerto Rico, caused major losses. The insurance group recorded a pre-tax underwriting loss of $3.2 billion on $60.6 billion of earned premiums, up 32%, which caused it to give back some of the $28 billion in pre-tax profit accumulated over the long winning streak. In that light, the loss wasn't so bad, nor was the 3.1% cost of float on $103 billion of average float. Buffett repeatedly told shareholders to expect a loss at some point. This was a fact of life for a big insurer. He estimated Berkshire's share of industry losses to be about 3% and placed a worst-case mega catastrophe, at $400 billion. Such an event would cost Berkshire $12 billion, a sum easily covered by Berkshire's non-insurance businesses, but one that would probably bankrupt other insurers. Berkshire Hathaway Reinsurance Group. Beginning in 2017, General Re's results were consolidated with BHRG. The reporting was now delineated between 4 major lines of business: property casualty, retroactive reinsurance, life health, and periodic payment annuity, with some detail on activities from General Re, separated for comparative purposes. A high-level analysis showed that NICO Group, BHRG's original operations, eclipsed General Re in property casualty by about half. Gen Re's life health business remained about double that of Berkshire Hathaway Life Insurance Company of Nebraska, BHLN Group, BHRG's original operations. Led by Ajit Jain, Berkshire Hathaway Reinsurance Group underwrote the largest retroactive insurance deal in history. For $10.2 billion premium, Berkshire agreed to pay up to $20 billion to cover losses AIG incurred prior to 2016. The deal was attractive to both sides. It drastically lowered the risk that AIG would find itself with inadequate reserves and allowed Berkshire to put its superior financial strength to work. The AIG deal caused earned premiums for the retroactive reinsurance segment to grow from $1.3 billion in 2016 to $10.8 billion in 2017 and was responsible for BHRG overall earned premiums growing 70% to $24 billion. BHRG as a whole reported a pre-tax underwriting loss of $3.6 billion compared to a $1 billion gain the year before. Remember that a retroactive reinsurance contract does not impact profitability on day one. Instead, future expected losses in excess of the premium received are booked as a deferred charge asset that is amortized into losses over the life of the contract. That amounted to $6.2 billion for the AIG contract alone. In theory, this asset represented what Berkshire would earn on the premium it received up front. The variables that would determine Berkshire's ultimate economic results were the timing and amount of future payments. More broadly, its ability to invest the float would also play a part. Even before year-end 2017, estimates were being revised. In the fourth quarter of 2017, Berkshire increased its estimate of ultimate claim liabilities on the AIG contract by $1.8 billion. It also increased the deferred charge asset by $1.7 billion because most of those losses would occur in the future. That left $100 million the net hit to profits in 2017. The ultimate judge of its profitability would be seen over decades. Accounting charges dominated the retroactive reinsurance line. About $1 billion of the $1.3 billion underwriting loss in 2017 was due to deferred charge amortization. Charges of a similar magnitude would hit earnings in future years and create a strong headwind to an overall underwriting profit. Another $264 million foreign currency loss related to reevaluation of foreign-denominated liabilities also impacted results. The $100 million net adjustment from the AIG contract discussed above made up the difference. Property casualty earned premiums grew 5% to $7.6 billion. The 20% quota share agreement with Insurance Australia Group from NICO Group represented 40% of its $4.5 billion earned premiums. Gen Re's property casualty business increased earned premiums 21% to $3.1 billion despite continued headwinds from high industry capacity by adding new business and increased participation for renewal business. Losses from Hurricanes Harvey, Irma, and Maria, an earthquake in Mexico, a cyclone in Australia, and wildfires in California caused $2.4 billion of losses for the combined property casualty segment. Profit on other property casualty contracts and $295 million favorable loss development mitigated the overall loss to just $1.6 billion. A change to assumption used in workers' compensation reinsurance illustrated the leeway management had over financial statements. Prior to the fourth quarter of 2017, Berkshire discontinued its workers' compensation claim liabilities assumed under reinsurance contracts, reflecting the fact that payments in the future were worth less than in the present. The change eliminated the discount to make those contracts consistent with other contracts. This resulted in a $1.43 billion increase to losses and loss expenses and hit the shareholders' equity to the tune of $931 million. This move demonstrated Berkshire's conservatism and highlighted how managements could influence financial statements. Accounting for insurance was full of such assumptions and sometimes tempted unscrupulous management teams to hide losses or even engage in outright fraud. In every round of accounting versus economics, Buffett and Berkshire leaned towards realism, even if it made results look worse. A $52 million loss in the life health line resulted from changes in underlying assumptions. Gen Re reported a loss largely from such charges related to its U.S. long-term care business, while gains were reported from the Berkshire Hathaway Life Insurance Company of Nebraska related to its variable annuity business. The periodic payment annuity business reported a $671 million loss. Part of that loss was due to the depreciation of the U.S. dollar against the U.K. pound and a reduced discount rate, which increased the liability. Geico reported its first underwriting loss since the year 2000, but growth in float more than offset the loss. Its 86.6% loss ratio was the highest on record under Berkshire's ownership and included $450 million, 1.5% of earned premiums, of losses from Hurricanes Harvey and Irma, and $517 million, 1.75% of earned premiums, from unfavorable loss development on prior year claims. The $310 million pre-tax underwriting loss represented a combined ratio of 101.1%. The top line was a different story. Earned premiums grew 15.5% to $29.4 billion, driven by a combination of 8.6% growth in policies in force and 6.9% higher pricing. GEICO's float was not detailed, but estimating float at 65% of premiums earned, its historical average, put it at approximately $19 billion, an increase of about $2.5 billion over the prior year. GEICO's market share increased from 12% to 12.8%. Berkshire Hathaway Primary Group. The primary group was in the black and delivered both 14% growth in premiums earned to $7.1 billion and 9% higher profit to $719 million. Double-digit growth at Guard, 26%, and BH Specialty, 23%, led the group, and growth from MedPro and the home state companies also contributed to premium growth. Losses from the many catastrophe events in 2017 negatively impacted results. Favorable loss development amounted to 10 percentage points compared to 8 the prior year. In each of the last 3 years, favorable development occurred in healthcare malpractice and workers' compensation lines. Regulated capital-intensive businesses. Revenues at BNSF grew 8% to $21.4 billion and pre-tax earnings 11% to $6.3 billion, with volumes and pricing contributing to results. Carload volumes increased in the mid-single digits in each of the consumer products, industrial products, and coal. Volume in agricultural products was flat. The full-year results masked somewhat slower growth in the second half of the year. The change in coal volume over the prior 2 years illustrated the basic economic principle of substitute goods, one that can be substituted for another. In the case of BNSF and coal, natural gas was the cheaper substitute good due to a decline in natural gas prices during 2016. This led consumers and electric utility generating plants to switch to natural gas. As natural gas prices rose during 2017, coal again became attractive and demand increased. Substitute goods are part of all business cycles, and which side a product or service falls on seals its financial fate. EBIT at Berkshire Hathaway Energy was flat at $3.4 billion, with little change in operational results at most units. The 2 natural gas pipelines increased EBIT 8% to $446 million. That resulted from a rate structure change at the beginning of the year, which allowed Kern River to be more competitive with existing customers in order to retain more business. AltaLink, the Alberta, Canada-based electric transmission utility, increased its revenues 39% due to a regulatory decision allowing it to recover construction in progress quicker. Some units, such as Northern Power Grid, located in the UK, were hurt by foreign exchange rates, specifically a decline in the US dollar against the UK pound. The accounting for interest expense illustrates the importance of understanding the nuances of accounting. During the year, BHE completed the tender offer for some of its debt. This was favorable from an economic standpoint, but the transaction caused a large one-time charge that accounting rules dictated be recorded on the interest expense line. On the books, it appeared interest expense increased from $465 million to $844 million, even though actual interest expense declined 7%. Including the accounting charge, Berkshire's share of net earnings fell 9% to $2.1 billion. Impact of the 2017 tax cut. The 2017 tax law change that contributed to the outsized increase in net worth had an important subtlety. The key question was, who would benefit from the lower tax rate? The answer depended on the industry. Heavily regulated businesses, customers. Utility businesses like BNSF and BHE were allowed a rate of return on equity calculated on an after-tax basis. Any benefit must be passed on to customers via lower prices. Berkshire put this figure at about $6 billion. Unregulated businesses with strong moats, companies. A business like See's would keep all or most of the benefit since it faced low pricing pressure from competition. The reduced liabilities associated with deferred tax on unrealized investment gains accrued to Berkshire's benefit too. Unregulated businesses facing competition, customers. These businesses would find they had to give most or all of the benefit of lower taxes to customers in order to retain business. Businesses without a moat would have to lower prices to compete, thus losing most of the benefit of the lower taxes. Manufacturing, service, and retailing. When Buffett told shareholders in 2016 that competitors read Berkshire's annual reports, he was setting the stage for a new format with less discussion of Berkshire's individual businesses. This new format was implemented in 2017, and the table summarizing the balance sheet and earnings for the MSR business was entirely gone. Only a rough calculation could be made using the business segment data provided in the notes to the financial statements. Buffett suggested that more detail, while desirable to shareholders, wasn't as important when Berkshire was smaller. Be aware, though, that it's the growth of the Berkshire forest that counts. It would be foolish to focus over intently on any single tree. Buffett long counseled that profits must be analyzed in relation to the capital that produces them. Calculating return on tangible equity became all but impossible without the summary balance sheet historically provided to shareholders in the chairman's letter. Information previously provided on the balance sheet was largely absent, aside from amounts for goodwill and identifiable assets at year-end. Industrial products. Revenues of $26.4 billion, up 6.8%. Earnings, up 4% to $4.4 billion, were hurt by one-time charges related to the Precision Castparts (PCC) acquisition, which led its pre-tax earnings to fall 12.5%. Its earnings were not detailed, nor were the earnings of IMC and Marmon. The footnotes disclose strong revenue growth at those two companies, IMC up 13%, Marmon up 7%, but did not specify how much translated into earnings. Lubrisol's earnings were detailed. On just 3% revenue growth, Lubrisol's pre-tax earnings grew 17% due to a combination of factors, including a lower comparable year in 2016 as a result of the $365 million write-off of an underperforming business. Building products. Revenues of $11.9 billion, up 10.8%. Pre-tax earnings grew 17% to $1.4 billion. Half of the increase in revenues was due to bolt-on acquisitions at Shaw and Mytech, which presumably also contributed to earnings. About half of the increase in earnings was a result of a lower base in 2016 from $107 million of asset impairments, pension settlements, and environmental claim charges from Shaw and Benjamin Moore. Consumer products. Revenues of $12.1 billion, up 10%. Earnings from the consumer products businesses swelled 35% to $1.1 billion. Forest River contributed to organic growth from existing operations, not bolt-on acquisitions. Its revenues increased 14%, and its earnings increased by 23% as strong demand for RVs bolstered results. Duracell bounced back strongly. Its results in 2016 were penalized by transition and restructuring costs. In 2017, its revenues increased 25% compared to a 10-month period in 2016, and pre-tax earnings amounted to $82 million. Apparel and footwear increased earnings 5%. Service business. Revenues of $11.2 billion, up 8%. Segment pre-tax earnings grew 12% to $1.3 billion. Results at TTI and NetJets led the growth within the service segment. Higher demand for electronic components and increased flight hours translated into higher revenues and earnings for the two companies. Earnings for the service businesses increased strongly, even with lower earnings, unspecified, from flight safety, the media companies, and the logistics businesses. Retailing. Revenues of $15.1 billion, flat. Berkshire's retailers had flat revenues but managed to increase earnings by 19% to $785 million. Earnings growth came from Berkshire Hathaway Automotive, which represented 63% of revenues within the segment, the home furnishing retailers, and the Pampered Chef. Results for the jewelers, Sears, Oriental Trading Company, and Detlev Lewis Motorrad were not discussed in detail. McLean. Revenues of $49.8 billion, up 3.5%. McLean had a bad year. While revenues increased, earnings fell off a cliff, down 31% to $299 million. The large decline in earnings was attributed to a 50% decline in grocery business, attributed to pricing pressures from competition and higher costs. Here, too, the analyst was left wanting reasons behind the large shift in business fortunes, especially one that had been relatively stable in prior years. Luckily, Buffett received a question from Jonathan Brandt, an analyst at Rune, Cunniff & Goldfarb, one of 3 analysts invited to ask questions at the 2018 annual meeting. The decline in grocery was worse than it appeared since McLean's liquor distribution business was relatively more profitable. McLean had large and strong suppliers on one side and equally formidable customers on the other side. What was left, less than 1% of revenues pre-tax, is what McLean had to live on. Buffett said McLean's woes would likely persist and were evidence of the competitive pressure of capitalism. Finance and financial products. Pre-tax earnings in the finance and financial products business declined 3% to $2.1 billion. Clayton's earnings increased 3% to $765 million on much stronger revenue growth of 18%. Clayton's $13.7 billion loan portfolio acted as a counterweight to manufacturing results, good or bad. Part of Clayton's revenue growth came from an increase in site-built homes. It acquired 2 additional site-built home builders in 2017. Revenues from conventional construction were expected to top $1 billion in 2018, a large increase for Clayton but a tiny fraction of the overall industry. Clayton remained a powerhouse in manufactured homes. Its 49% market share was 3 times its nearest competitor. Earnings from transportation equipment leasing fell 9% to $869 million. Industry supply was part of the problem. Railcar capacity was thought to exceed demand, causing lower lease rates. Since depreciation and other fixed costs do not vary with revenues, a modest 2% decline in revenues translated into the larger drop in earnings. Investments. 2 investment moves in 2017 made big splashes, but neither was mentioned in the text of the 2017 chairman's letter. If shareholders hadn't already heard about it in the business press, they would have noticed that IBM disappeared from the list of top investments, where it was formerly third in market value, and Apple vaulted from 5th to 2nd. Berkshire's initial stake in Apple was credited to one of the 2 investment managers, Todd Combs or Ted Weschler. Buffett again wouldn't specify. The enlarged Apple position with a market value of $28 billion at year-end 2017 was Buffett's move. Buffett admitted to not understanding technology and being wary of such companies, so why divest of IBM and invest further in Apple? The answer? Apple had a huge moat, and IBM did not. Apple's moat was wide and deep. While its first successful business reinvention was the iMac personal computer in the late 1990s, the company hit true pay dirt with the very portable iPod, which replaced bulkier CDs and CD players, and then again with the iPad, a tablet that can browse the internet, an iPhone, a smartphone that could be a telephone or used to browse the internet. These innovations made Apple more of a consumer products company than a technology company. They sold products people liked and created an app technology ecosystem around those products that consumers invested in. Every time a new device or version of a device came out, people rushed to buy it. Having an iPhone was a status symbol, and Apple became a household name. The consumer habits combined with significant switching costs created and maintained Apple's moat. Consumers would invest in apps and music that could only be used on Apple devices. Over time, the market had consolidated to 2 large competitors, Apple and Google's Android system. Consumers had little incentive to adopt the competing system since it offered little added benefit compared to the large cost of repurchasing the apps and music already on their Apple system. IBM, meanwhile, was a technology and service company. Its products are not as easily recognizable in day-to-day life, but that is not the reason for its narrow moat. IBM's products include supercomputers and various cloud computing services, including storage. That market proved to be more prone to competition from other large technology players such as Amazon, Microsoft, and Google than Buffett first realized. When Buffett first invested in IBM in 2011, he named it among 4 exceptional companies and praised its financial management. Years later, he admitted his investment had been a mistake. It was not that IBM did not make Berkshire money, it did, primarily through share repurchases and dividends, but another investment could have made Berkshire more. Berkshire's loss was one of opportunity cost. Its investment stagnated while the market advanced. Apple's success as a business enterprise is captured in one remarkable statistic. The company required no tangible capital to operate. Payables, accruals, and deposits exceeded everything needed to operate the business, from receivables, inventories, and fixed assets. In other words, Apple's suppliers and customers financed all its operations and then some. Shareholders didn't need to supply any capital but were entitled to profits. What was such a company worth? Berkshire paid $21 billion for its 3.3% stake in the company. This valued Apple at over $635 billion. See Table 9.15. Was Apple worth that much? The answer was yes, and more. Apple had $238 billion of cash and investments on the book at the end of its fiscal year in September 2016. Adjusting for excess cash and investments and the debt the company had on its books, Berkshire's going-in pre-tax return was around 12%. Berkshire's margin of safety was inherent in the quite satisfactory going-in return and Apple's business moat. stemming from strong customer habits reinforced by high switching costs. That Apple could grow without needing additional capital was yet another benefit. In effect, we're betting on the ecosystem of Apple products led by the iPhone, and I see characteristics in that make me think it's extraordinary. Perhaps chastened by his experience with IBM, Buffett added, "But I may be wrong." He was not wrong, and nor was he alone in his bet. In July 2016, Apple hit the $1 billion mark in iPhone sales. Apple also warmed Buffett's heart by buying back its own undervalued shares. "I'm delighted to see them repurchasing shares. With the passage of a little time, we may own 6 or 7% simply because they repurchase shares." A similar result played out with Berkshire's investment in American Express over its long holding period. Berkshire's initial position had grown from 13% of the company to almost 18% over the prior decade, simply by virtue of share repurchases costing Berkshire nothing. Berkshire exercised its Bank of America warrants in 2017 and exchanged its $5 billion preferred for 700 million shares of Bank of America. Those shares were worth $20.7 billion as of year-end, giving Berkshire a 6.8% stake in the bank. Shares of Kraft Heinz had a market value of $25.3 billion at year-end. More exciting was the triple play 3G Capital nearly pulled off in 2017. Berkshire and 3G Capital acquired Heinz in 2013 for $29 billion, and then Kraft in 2015 for $57 billion. 2 years later, it was bidding for the consumer products giant Unilever. Price tag? $143 billion. The deal ultimately fell through after it was revealed the company wasn't interested in merging. The team at 3G Capital mistakenly thought Unilever was open to a friendly offer. Buffett told shareholders they were only interested in friendly transactions, and the deal quickly died. Berkshire and 3G Capital were each prepared to inject an additional $15 billion of new equity to make the deal work. Restaurant Brands International redeemed Berkshire's preferred stock investment in December 2017. The $3 billion return of capital added to the growing cash pile at headquarters. The continued low interest rate environment meant Berkshire wouldn't be able to come close to matching the 9% yield it obtained on the investment made 3 years before. Protege bet. On December 19, 2007, Buffett made a 10-year bet through longbets.org that concluded on the same date in 2017. Longbets was an organization set up to take long-term bets for a period of 5 years, stretching far into the future. Each side put up money and the winner's charity received the proceeds after the bet concluded. Buffett bet that the S&P 500 index would outperform a portfolio of funds of the hedge funds net of fees and expenses over the course of a decade. His bet put his own money, not Berkshire's, where his mouth had been for many years. He thought most investors would do better over time sticking to an unmanaged index and that the fees hedge funds charge clients would negatively impact performance. Buffett bet against Ted Seeds, a co-manager of Protege Partners, who stepped up and contributed the $318,250 necessary to seed its $500,000 position. The money purchased zero-coupon bonds that would mature in 10 years at the face value of the bond, no different than a savings bond. After an initial period of underperformance, the S&P 500 came out far ahead. At the end of the 10 years, the S&P gained 125.8%, 9.5% per year, compared to 36.3%, an average of 3% per year, for the group of 5 funds of funds. Buffett wrote that the managers of the 200-plus hedge funds and the fund of fund managers all had incentives to do well over that time, and all of them likely did well personally owing to the fees they charged. But in each case, the performance of the funds they managed fell short of an unmanaged index. The bet offered an unforeseen lesson. The low interest rate environment that accompanied the Great Recession drove the price of the zero-coupon bonds to almost 96% of par in just 5 years. Remember that the proceeds at maturity would be par or 100%. Buffett thought more money for charity could be had by switching from bonds to Berkshire stock. Protege agreed to cash in the zero-coupon bonds and invest the proceeds in 11,200 shares of Berkshire Hathaway stock, B shares. Buffett personally guaranteed their value would be at least $1 million at the end. At the conclusion of the bet, Girls Incorporated of Omaha received much more. Over $2.2 million went to Buffett's charity, and he also took home bragging rights. Buffett used the publicity to reinforce his message that fees matter and that an investor could do well by betting on America via a low-cost fund and sitting tight. Chapter 16, 2018 to 2019. 2018. Berkshire's 2018 business results were helped by the reduction in the corporate tax rate from 35% to 21%, which became law late in 2017. Operating results were strong in addition to, and perhaps partly because of, the reduction in the tax rate. Each of its major segments reported gains, including insurance, which returned an overall underwriting profit. The dry spell for major acquisitions continued, but the stock market, including a downdraft late in the year, presented the chance to invest tens of billions into equities. Most of that money went into Apple, Berkshire's newest and largest holding. A major change to accounting rules left Buffett opening his chairman's letter with a lesson on accounting. Beginning in 2018, GAAP required unrealized gains and losses on equity securities to flow through the income statement instead of directly to book value, as had been the practice for decades. Buffett primed shareholders on the change in his 2017 chairman's letter, and actual figures in 2018 proved the analytical limitations. Berkshire's record $24.8 billion of after-tax operating earnings resulted in $24.6 billion of net income under the old rules and relatively dismal $4 billion net income under the new rules. See Table 9.16. Which should shareholders believe? It came down to two questions: how best to present results to shareholders, and what constitutes earnings. The accounting authorities, the Financial Accounting Standards Boards, the rulemaking body for GAAP, deemed the change beneficial to users of financial statements. Buffett and Munger disagreed. They suggested shareholders ignore realized gains and losses long before this rule change. Including unrealized gains and losses was going further in the wrong direction. Buffett warned in 2017 it would create wild and capricious swings in earnings that render the bottom line useless. That's exactly what happened in 2018. The accounting was at odds with the reality of common stock investment. Owning stock means owning businesses. Business values fluctuated, but the magnitude of those changes was at odds with what the stock market would suggest through its frequent ups and downs. Importantly, the accounting changes did not affect Berkshire's true economic performance. The unrealized gains or losses included in earnings were adjusted for taxes, but did not create an actual tax bill. Like before, taxes would be due on realized gains only when a sale was made. From a financial statement presentation perspective, ASU 2016-01, the name of the rule change, simply moved unrealized gains and losses from the Statement of Comprehensive Income to the income statement. The Statement of Comprehensive Income is often an overlooked statement that contains items affecting net worth, but not necessarily a component of income. This was another case of accounting versus economic reality. In both instances, the unrealized gains and losses were presented net of taxes, so the impact to net worth was the same. Buffett worried that too much emphasis would be placed on Berkshire's reported bottom line. Most reporters used the net income figure in their reporting, and many, unfortunately, were not trained to dig much deeper. This was not as much of a problem at many companies. Berkshire was different in its huge holdings of marketable securities. The daily, quarterly, or yearly fluctuations of its $173 billion portfolio could overshadow the operating results at its many businesses. Buffett's advice to shareholders: focus on operating earnings, paying little attention to gains or losses of any variety. Capital gains, whether realized or unrealized, were important to Berkshire over time, but short-term movements were devoid of analytical information. In years past, a solution to the accounting issue discussed above would be to focus on the change in book value per share. The fluctuations in marketable securities price would find their way to book value under either accounting method, but that metric gradually lost its relevance as Berkshire allocated more capital to owning businesses in their entirety. Berkshire's change in book value per share made its last appearance in the 2018 annual report. It can still be easily calculated in the future. Preparing for this change, Buffett first presented market value data in 2014 as an imperfect but better guide over time. Kraft Heinz is a perfect example of why book value was a bad metric. Berkshire's many companies were on the books at their purchase price and never revalued upward to their market value. Although Berkshire didn't own 100% of Kraft Heinz, the accounting treatment was very close. Kraft Heinz was on Berkshire's book for $17.6 billion at year-end 2017, but its value based on publicly traded shares was $25.3 billion. Nowhere on Berkshire's books did the excess value show up. Berkshire's shift toward owning businesses in their entirety made book value an increasingly poor measure of performance as time went on. When marketable securities represented a larger portion of Berkshire's net worth, their value was reflected in book value immediately. Change in book value per share as a measurement tool would become even more problematic as Berkshire began returning capital to shareholders. In fact, Berkshire repurchased $1.3 billion in 2018 at an average price of $295,000 per A share. We can be confident the price paid was below Berkshire's intrinsic value, otherwise Buffett and Munger would not have done it. We know for a fact that the price paid was above book value. Such purchases would create a wide gap between intrinsic value and book value that would only intensify as time went on. The Berkshire Forest. Buffett used the analogy of a forest and its trees to provide shareholders a way to estimate Berkshire's intrinsic value. Forget the mind-numbing exercise of trying to assess every tree, he said. Fortunately, it's not necessary to evaluate each tree individually to make a rough estimate of Buffett's intrinsic business value. That's because our forest contains 5 groves of major importance, each of which can be appraised with reasonable accuracy in its entirety. 4 of those groves are differentiated clusters of businesses and financial assets that are easy to understand. The 5th, our huge and diverse insurance operation, delivers great value to Berkshire in a less obvious manner. The 5 groves are: Grove number 1, non-insurance business with ownership between 80 and 100%. This most valuable grove includes Berkshire's many businesses, ranging from twigs to redwoods, from the smaller bolt-on acquisitions to giants BNSF and Berkshire Hathaway Energy. These businesses earned $16.8 billion after tax in 2018. All expenses, including interest, depreciation, and corporate overhead, were deducted to arrive at that figure. Grove number 2, equity securities. The market value of the second most valuable grove at year-end was $173 billion, but Berkshire would owe $14.7 billion in tax on the amount of unrealized gains. That left approximately $158 billion of net value. Grove number 3, control group businesses. The grove contains businesses where Berkshire shares control with other parties. This includes Berkshire's 26.7% ownership of Kraft Heinz, 50% of Berkshire and Electric Transmission Texas, and 38.6% of Pilot Flying J. Together, these companies earned $1.3 billion in 2018. Grove 4, cash, U.S. Treasuries, fixed income, bonds. At year-end, Berkshire had $112 billion of cash and $20 billion in fixed income investments. Buffett noted that $20 billion, a coincidence with the value of bonds, would always be reserved as a buffer. Grove number 5, insurance. The insurance businesses were a source of value on the liability side of the balance sheet. Through the float they generated, $123 billion at year-end, Berkshire could hold far more assets than it otherwise would be able to. Buffett said float financed the first 4 groves, but stopped short of saying it could be considered equity. Considering the long-term profitability of Berkshire's insurers, one could make the argument its float was at least as valuable as equity. I believe Berkshire's intrinsic value can be approximated by summing the values of our 4 asset-laden groves and when subtracting an appropriate amount for taxes, eventually payable on the sale of marketable securities. The analysis was an extension of the previous method of adding cash and investments per share to a capitalized amount of per-share operating earnings. Buffett's equation left out one important variable in both cases. How should shareholders think about capitalizing their earnings from groves 1 and 3? Berkshire's earnings might be worth more or they could be worth less depending upon where interest rates went long-term. There was a factor Buffett could not control, so he left it up to shareholders to decide. We can approach the valuation problem in 2 ways. First, by assuming an interest rate, and second, by determining the going-in rate of return implied by Berkshire's market capitalization. See Table 9.17. To be consistent with our previous valuations of Berkshire, we'll use 15 times after-tax earnings as our multiple to capitalize earnings. This is consistent with our use of 10 times pre-tax earnings under the 35% tax rate. The decline in interest rates up to this time means our analysis is conservative, if anything. For a business like Berkshire with modest levels of debt and subsidiary businesses' earnings good to great returns on capital, a meaningful margin of safety existed in the shares around 2018. The market appeared to completely discount any potential for growth or the optionality in its significant cash resources. Berkshire was undervalued by at least 14% under the first framework. Using the second method, the implied return of over 9% suggests the market discounted Berkshire's earnings too heavily. With book value no longer a worthwhile proxy, Berkshire's board authorized repurchases anytime Buffett and Munger thought the price went below intrinsic value, conservatively calculated. Previously, Berkshire could repurchase shares when they reached 120% of book value. Price to value would always be a key consideration for repurchases, and Berkshire would always put its own businesses first. Growing existing operations and buying new businesses would come before share repurchases. All capital allocation decisions would be weighed against opportunity costs. Insurance. The insurance group returned to profitability in 2018 with a $2 billion pre-tax underwriting gain on earned premiums down 5% to $57.4 billion. That brought the record of profits to $27 billion in 15 of the prior 16 years. Better still, float grew 7.2% to $122.7 billion at year-end. A new acquisition bolstered results. On October 1, 2018, National Indemnity acquired medical liability mutual insurance company, MLMIC, for $2.5 billion. The company changed its name to MLMIC Insurance Company upon joining Berkshire. MLMIC was a New York City-based writer of medical professional liability insurance that demutualized. The acquisition was a long time coming. National Indemnity first agreed to the acquisition in 2016, but the required demutualization process, which converted it from a mutual company owned by policyholders to a stock company, took some time. MLMIC wrote $400 million in premiums in 2018 and brought with it $5.4 billion of cash and investments. Its results were reported with the primary group. Berkshire Hathaway Primary Group. The Berkshire Hathaway Primary Group, of which MLMIC was a part, grew earned premiums 13.6% to $8.1 billion. Written premiums increased 32% at VA Specialty, 19% at Guard, 14% at NICO Primary, and the home state companies increased volume 8%. Catastrophe losses of $190 million from Hurricane Florence and Michael and wildfires in California, as well as lower favorable loss development, led profitability to slip slightly. The primary group's combined ratio of 91.8% in 2018, compared to 89.9% in 2017, remained strong and reflected the strength of this collection of insurers. Geico. Buffett had nothing but praise for Geico's Tony Nicely. Nicely retired as CEO in 2018 after almost 60 years with the company. Buffett credited him with leading Geico to become the second largest U.S. auto insurer with a market share of 13%. He estimated Nicely increased Berkshire's intrinsic value by $50 billion over his tenure, leading Geico from 1993 to 2018. Nicely passed the reins to Bill Roberts, another longtime Geico insider, and remained on as chairman. He chose a fitting year to depart as CEO, as the company had one of its best years ever. Geico rebounded sharply in 2018. Earned premiums grew 13% to $33.4 billion from a combination of 3.3% policyholder growth and 6.4% higher premiums. Geico successfully increased premium rates to compensate for the elevated levels of losses experienced over the prior 2 years. The loss ratio declined 7.8 percentage points compared to 2017 to 78.8%. Even after $105 million in catastrophe losses, leading Geico's profit to swell to record levels at nearly $2.5 billion, a combined ratio of 92.7%. Favorable loss development of $222 million also played a part in the gain. Berkshire Hathaway Reinsurance Group. Berkshire Hathaway Reinsurance Group was the only major insurance segment to report a loss, although that loss was significantly less than the prior year. A comparative year that included the world's largest retroactive reinsurance contract, the $10.2 billion AIG deal, caused the unit's earned premiums to decline by a third to $15.9 billion. Earned premiums were up 13% over 2016. BHRG improved to a pre-tax underwriting loss of $1.1 billion from a loss of $3.6 billion in 2017. Considering the significant drag from accounting charges and more normal year for catastrophe losses, such a result was not bad. Property casualty earned premiums grew 18% to $8.9 billion. Property casualty line faced 4 catastrophe events in 2018, from Hurricanes Florence and Michael, Typhoon Jebi, and wildfires in California. Together, these cost $1.3 billion and led to $207 million loss. Results were bolstered by $469 million of favorable loss development. Back-to-back years with catastrophe losses were expected occasionally. Berkshire remained committed to pricing appropriately regardless of the timing of the catastrophe events. Annual repricing of policies is an important factor in catastrophe underwriting. Assumptions about the long-term impact of things like climate change could be worked into pricing over time. As a rule, Berkshire did not write catastrophe contracts for more than a year. After the record $10.2 billion AIG contract in 2017 that swelled earned premiums to $10.8 billion, retroactive reinsurance premiums fell to $517 million in 2018. The AIG contract alone was responsible for $611 million of the $778 million loss in this segment, most of which was related to deferred charge amortization. The retroactive line also benefited from favorable loss development that contributed $185 million and exchange rate effects that added $169 million to segment results. Gross unpaid losses from retroactive reinsurance contracts were $41.8 billion at year-end, and deferred charge assets amounted to $14.1 billion. Life health reinsurance was the only BHRG line to report a gain. It swung from a loss of $52 million in 2017 to a gain of $216 million in 2018 on earned premiums up 11% to $5.3 billion. The gain was due to lower losses from U.S. long-term care business and gains, though lower than the prior year, from variable annuity guarantee contracts. Earned premiums grew 29% to $1.2 billion in the periodic payment annuity business. Volumes in that business, like all of Berkshire's insurance line, ebbed and flowed based on pricing. These produced a pre-tax underwriting loss of $340 million compared to a loss of $671 million in 2017. The losses included a $93 million gain in 2018 and a $190 million loss in 2017 from changes in foreign exchange rates. Regulated capital-intensive businesses. BNSF benefited from the strong U.S. economy with a 4.1% increase in overall unit volume and 6.2% higher average pricing that increased revenues 11.5% to $23.9 billion. Car loadings totaled $10.3 million and increased in each freight category except for coal, which declined 0.8%. Volume increases came from industrial products, up 16%, driven by strength in end markets, and agricultural products, up 9%, driven by exports. The advantage of rail over trucks during a time of tight trucking capacity brought gains in consumer products freight, but an unspecified contract loss muted the overall volume increase in consumer products to just 2.9%. Pre-tax earnings grew 8.5% to $6.9 billion. Higher pre-tax earnings and the new lower federal tax rate translated into a 32% increase in after-tax earnings to $5.2 billion. The new tax law immediately impacted Berkshire Hathaway Energy. Its regulated utilities began passing on savings to customers in various forms, including lower electric rates and regulatory modifications that indirectly affected consumer rates. The largest unit, PacifiCorp, experienced a 4% decline in revenues, with most attributed to the impact of the tax cut. Pre-tax earnings, however, fell 34% to $745 million from a combination of reduced revenues and accelerated depreciation on a thermal generating facility. The increased depreciation expense was a non-cash charge in 2018. After all, physical depreciation does not increase due to a change in tax rate, but it would lower the rate of assets on which future revenues could be based. A similarly large decline in pre-tax earnings, 26% to $417 million, occurred at NV Energy due to the tax cut. The natural gas pipelines benefited from colder weather and higher volumes, leading to a 14% increase in pre-tax earnings. No major changes were reported from Northern Power Grid, the UK utility, or the other energy businesses. Mid-American Energy Company, the Iowa and Illinois utility, was impacted by the tax bill but still reported 9% higher pre-tax earnings, which reflected higher volumes and prices unrelated to the tax cut. The net effect across all BHE utilities was a 14% decrease in EBIT to $2.9 billion and a 1% decline in pre-tax earnings to $2.5 billion. Berkshire's share of net earnings increased 29% to $2.6 billion, in large part due to taxes. BHE's tax rate was negative in 2018, causing higher after-tax earnings than pre-tax earnings. Tax credits for wind-generating assets more than offset any tax liability. Berkshire Hathaway could take advantage of such credits immediately because it paid federal taxes on a consolidated basis. Such tax credits were less valuable to standalone utility companies. At year-end 2018, BHE's cumulative investment in renewables such as solar, geothermal, and biomass was $25 billion. Manufacturing, service, and retailing. Perhaps of the result of the work of classifying Berkshire's many businesses into groves, Berkshire consolidated the finance and financial products businesses into the manufacturing, service, and retailing businesses beginning in 2018. As a result, Marmon's UTLX, the railroad and mobile crane leasing business, went back with its parent company within industrial products. Clayton Homes became part of the building product segment. Extra and Court were reported with the service businesses. These changes accounted for approximately $1.7 billion of 2017 pre-tax earnings reclassified to the MSR presentation. The remainder, about $375 million, went elsewhere. Table 9.19 contains the modified presentation with 2017 revised by Berkshire to reflect the new arrangement. The MSR businesses performed impressively considering its 13% increase in pre-tax earnings was not affected by the tax rate explicitly. After-tax earnings grew 29% to $9.4 billion through a combination of the gain in pre-tax earnings and lower taxes. Earnings were not boosted by acquisitions. Berkshire spent a total of $1 billion on bolt-on acquisitions in 2018, not necessarily all within MSR. A strong U.S. economy provided a tailwind to most MSR businesses, although specific factors impacted each differently. New tariffs imposed by the U.S. hurt demand in certain businesses, while others reported higher earnings in part due to a weaker dollar. Industrial products. Revenues of $30.7 billion, up 7.4%. Pre-tax earnings grew 15% to $5.8 billion. Part of the strong gain in industrial products in 2018 resulted from one-time charges at Precision Castparts and Lubrizol the prior year. Those charges notwithstanding, strong demand for aerospace parts and additives led to unit volume growth and higher pre-tax earnings at both companies. IMC grew revenues and earnings because of higher demand for its products and weakness in the dollar. CTB and Marmon were the only two businesses whose pre-tax earnings declined. Marmon achieved 6% higher revenues, but weakness in the railcar leasing business and its food service technologies and the retail solutions sectors weighed down results and caused a 6% decline in pre-tax earnings. Building products. Revenues of $18.7 billion, up 10.2%. Pre-tax earnings in this segment grew 9% to $2.3 billion, mostly due to strength at Clayton Homes and Shaw. Clayton Homes led the building products businesses with a 19% increase in pre-tax earnings to $911 million. Clayton now boasted 8 site builders in addition to its manufactured home operations. Earnings at Berkshire's other building products companies increased just 3.1%. Shaw and Johns Manville both grew revenues in the high single digits, but cost pressures left John Manville with lower earnings. The shortage of truck drivers that benefited BNSF hurt the building products companies as their products required short-haul transport. They also faced higher input costs for raw materials, not all of which could be immediately passed on to customers. Some of the factors above might have played a part in Acme Brick closing several brick, concrete, and limestone plants in 2018. Acme depended heavily on basic materials and short-haul trucking. Consumer products. Revenues of $12.5 billion, up 3.2%. Pre-tax earnings grew 9% to $1.2 billion, but results from these businesses were mixed. Forest River's unit sales were flat year over year, but that belied significant changes throughout the year. Unit sales declined 7% during the second half of the year, and the company was negatively impacted by higher material costs. Fourth quarter earnings declined 28%. The company was lucky to escape the year with a pre-tax decline in earnings of 9%. Larson Jewell's earnings also declined, though they were not detailed. The weakness in those businesses were more than made up by the increased earnings at Duracell, also not detailed, and in the apparel and footwear business, up 6.4%. Service businesses. Revenues of $13.3 billion, up 9.7%. TTI, the electronic components distributor, led the service businesses to a 21% increase in pre-tax earnings to $1.8 billion. Its results accounted for almost 84% of the increase in pre-tax earning, a result of strong demand industry-wide on top of acquisitions and favorable effects from a weaker dollar. Political advertising boosted revenues 21% at WPLG, the Miami, Florida television station. Charter brokerage saw its top line grow by half. Its earnings increased but were not disclosed. Earnings increased at Extra and NetJets, but flight safety again lagged. Lower margins on simulators and an impairment charge to fixed assets, likely in outdated simulators, reduced earnings. Retailing. Revenues of $15.6 billion, up 3.6%. Pre-tax earnings grew 10% to $860 million. Berkshire Hathaway Automotive dominated the retailing segment, accounting for over 60% of its revenues. Berkshire did not disclose its earnings, only stated that BHA and Lewis, the German motorcycle accessory retailer, were the primary reasons for the increase in pre-tax earnings. We can surmise that some of the other retailers, such as the jewelry businesses, See's, Dairy Queen, and Pampered Chef, also contributed at least something to earnings growth, as they were not identified. The home furnishing businesses were identified. Their revenues increased in part due to increased same-store sales from some markets and a new store, but their earnings fell 2.4%, in part due to higher costs at Star Furniture. McLane, revenues of $50 billion, up 0.4%. Competitive pressures continued to weigh on McLane's results. Grocery revenues, which accounted for two-thirds of overall revenues, increased 1%. The loss of a large food service customer largely negated that gain. Higher operating costs ate into the company's already thin margins, leading to another double-digit decline in earnings, which fell 18% to $246 million. Berkshire saw no let-up of the difficult operating conditions. Investments. Apple took center stage in Berkshire's investment portfolio in 2018, with Berkshire investing another $15 billion in the iPhone creator. It ended the year with 255 million shares, or 5.4% of the company. At year-end, Berkshire's investment in Apple was worth over $40 billion, making it the largest holding in almost a quarter of the equity portfolio. The top 5 positions, in order, Apple, Bank of America, Wells Fargo, Coca-Cola, and American Express, represented 68% of the entire portfolio. Despite its size and the difficulties finding attractive investments in a continuing bull market, Berkshire hadn't lost his penchant for concentrating his investments. Banks received the bulk of the remaining net investments made in 2018. Berkshire added to several of its holdings in banks and brought in a new one. Another $6.6 billion went into Bank of America, ending the year with 9.5% of the company. Berkshire also topped off its holding in Bank of New York Mellon and U.S. Bank, but stopped short of breaching the 10% threshold. Crossing the 10% mark would bring unwanted regulatory headaches. Berkshire sold shares in Wells Fargo to counter the effect of the bank repurchasing its own shares and remained below the threshold. Another $1.7 billion went into Goldman Sachs and $5.6 billion into a new position in J.P. Morgan Chase. Altogether, banks comprised 36% of the equity portfolio. And that wasn't counting the 8% of the portfolio in American Express, a financial services company. Berkshire reported Kraft Heinz outside the investment portfolio because of its large ownership position, but it remained publicly traded. In 2018, the market value of Berkshire's Kraft Heinz shares fell 45% to $14 billion. Kraft Heinz took a massive $15.9 billion write-down of its goodwill and intangible assets that reflected weakness in its iconic brands. Remember, Berkshire and 3G Capital paid a huge premium over the net tangible assets of both Heinz and then Kraft. In 2018, Kraft Heinz management determined those intangible assets weren't worth as much and wrote them down. Berkshire's financial statements weren't affected by the precipitous drop in the share price of Kraft Heinz because it accounted for its investment using the equity method. It hadn't been affected by the strong gains either. It was as if the market for Kraft Heinz shares did not exist. If Berkshire's ownership in Kraft Heinz had been below the 20% threshold for equity method accounting, it would have necessitated flowing the market value decline through the income statement and reducing shareholders' equity by the after-tax amount of the decline. Instead, the asset impairment charges flowed proportionately to Berkshire and through its income statement. Berkshire's share was $2.7 billion after tax. The equity method of accounting also meant its $814 million dividend received in 2018 was recorded as a reduction to Berkshire's investment in the company. But that cash was real, as were similar accounts received in the 2 prior years. Not a terrible result for an investment with a cost basis of $9.8 billion. The impairment charges taken by Kraft Heinz reflected real weaknesses in what Berkshire and 3G Capital originally thought it was worth. Buffett admitted they erred. "I was wrong in a couple of ways on Kraft Heinz." The Heinz purchase was sensible, but Berkshire and 3G Capital had overpaid for Kraft. While its brands were well known and continued to be purchased by consumers, it had lost some of its bargaining power with retailers due to the emergence of strong private label brands. For example, Costco's younger Kirkland signature brand had revenues greater than all of Kraft Heinz. Costco customers choose Kirkland not just because it's at a lower cost, but because the products are of high quality and easily recognizable. Kirkland brands accounted for about 27.5% of Costco's sales in fiscal 2018. Store brands at many retailers have taken an increasing share, while branded products lost ground. Buffett was aware of these trends and competitive forces, but concluded Kraft Heinz brands would be more resistant. The issue wasn't so much the company, it was the purchase price. Kraft Heinz' underlying business was excellent. It earned approximately $6 billion pre-tax on $7 billion of net tangible assets. But the all-in purchase price was about $100 billion more. Berkshire thought it was paying a fair price for the great company. Instead, it found itself with a great company unable to produce the returns needed to justify the rich price its owners paid. Kraft Heinz was a reminder of 3 important investing concepts. 1. A great company could become a poor investment if the price paid is too high. 2. Competitive advantages aren't static. Competition and changing preferences can affect the strongest of companies. 3. A margin of safety protects the investor from unknowns, and it can come in the form of quality. Kraft Heinz had many iconic brands that remained ingrained in consumer purchasing habits. The underlying business reflected those advantages. The mistake of paying too much resulted in a lower rate of return than initially expected, but Berkshire hadn't lost money on Kraft Heinz. It intended to hold on to the investment and would continue to collect cash dividends. Outside of the equity portfolio, Berkshire made a $2 billion secured loan to Seritage Growth Properties. Seritage was a real estate investment trust holding properties leased back to Sears, the struggling retailer. The loan was made by Berkshire Hathaway Life Insurance Company of Nebraska. Terms of the deal included an initial funding of $1.6 billion at an interest rate of 7%, with a 1% annual fee on the undrawn commitment of $400 million. A glimpse into succession. Buffett received countless questions on Berkshire's succession planning over the decades, but as he neared the end of his 80s and with Charlie Munger already into his 90s, the question came up more and more. Part of the question had been answered. His role would be split into a non-executive chairman, likely his son Howard, a CEO, and 2 more investment managers. Berkshire already had 2 highly capable investment managers, Todd Combs and Ted Weschler, and Howard's appointment was all but certain. That left the CEO post. Berkshire's move in early 2018 removed some of the fog, but left the question open. Berkshire's board voted Greg Abel, age 56, and Ajit Jain, age 67, as vice chairman alongside Charlie Munger. Abel, the longtime chairman and CEO of Berkshire Hathaway Energy, became vice chairman, non-insurance operations. Jain became vice chairman, insurance operations. Buffett said the move was long overdue. You and I are lucky to have Ajit and Greg working for us. Each has been with Berkshire for decades, and Berkshire's blood flows through their veins. The character of each man matches his talents, and that says it all. A layer of management between Buffett and the many managers of Berkshire's businesses left him and Munger with the primary job of investment and capital allocation. Not much would change for Buffett. Berkshire's policy of giving extreme autonomy to the managers of its many subsidiaries already made his job easier than almost any other CEO of a large conglomerate. The Salomon Brothers incident in the early 1990s already proved Berkshire could function without Buffett there day to day. Uncle Sam, business partner. Discussion of taxes provided Buffett a unique way to explain the taxing power of governments. Like it or not, the U.S. government owns an interest in Berkshire's earnings of a size determined by Congress. In effect, our country's Treasury Department holds a special class of stock. Call this holding the AA shares that receives large dividends, that is, tax payments, from Berkshire. The reduction in the U.S. corporate tax rate from 35% to 21% equated to Congress appropriating 40% of its ownership back to Berkshire's other shareholders. Viewed this way, it's easy to see that a reduced tax rate equated to a higher intrinsic value for all companies. The key question was how much would remain after the effects of competition. Buffett touched on the subject in his prior chairman's letter. BHE would give back all the benefits of lower taxes explicitly through regulation. Other Berkshire businesses would find competition eroding the newfound profits. A few, such as Seas, might be able to hang on to the entirety of the benefit. All things being equal, Berkshire is better off with a lower tax rate. 2019. Berkshire's results again required explaining thanks to another round of accounting versus economics. A strong stock market in 2019 following weakness in 2018 changed reporting profitability significantly. But the nonsensical GAAP accounting rules caused Berkshire's bottom line to grow 1,900%. The GAAP requirement that unrealized gains and losses flow through the income statement made the bottom line useless for analytical purposes. Berkshire's results were good in 2019, just not that good. What really counted, operating earnings after tax, amounted to $24 billion, a 3% decline from the prior year. Buffett reminded shareholders once again that it was the long game that counted and the reality trumped accounting, even when it showed results to be worse. Charlie and I urge you to focus on operating earnings, which were little changed in 2019, and to ignore both quarterly and annual gains from investments, whether they are realized or unrealized. The details of Berkshire's operating performance in 2019 revealed a year very much on par with the prior year. The insurance group delivered another year of underwriting profits. Growth in float brought more investable assets and higher investment income. The railroad and the utilities, along with the manufacturing, service, and retailing businesses, all reported higher profits. Berkshire found no major acquisitions. An opportunity to invest $10 billion in a negotiated preferred stock deal soaked up some of the continually growing cash pile. So too did repurchases that reduced Berkshire's share count by 1%. Nonetheless, cash and equivalents swelled to $128 billion at year-end. Amid the longest bull run in American history, Berkshire waited patiently for opportunity. Valuation and share repurchases. Berkshire spent $5 billion repurchasing its shares in 2019. The sum was large but represented a small fraction of the company. We can estimate that Berkshire's intrinsic value increased by about 15% in 2019, using the same valuation methodology suggested by Buffett and presented in the section on 2018. Recall that Buffett divided Berkshire into 5 groves, 4 of which were used to calculate value, insurance was the 5th, and supplied the float to fund the other groves. Those 4 groves were: Grove number 1, non-insurance businesses with ownership between 80 and 100%. Grove number 2, equity securities. Grove number 3, control group businesses. Grove number 4, cash, U.S. Treasuries, fixed income, bonds. It's unclear why Berkshire did not repurchase more of its own shares during the year. The discount between the calculated value, see Table 9.20, and the level at which Berkshire repurchased its shares appeared wide. The highest price paid during the fourth quarter implied a valuation of around $545 billion. The price-value relationship appears favorable even if we use an average of the estimated year-end intrinsic values. Yet Buffett's comments suggested the repurchases were not a screaming bargain. Calculations of intrinsic value are far more precise. Consequently, neither of us feels any urgency to buy an estimated dollar of value for every real 95 cents. Valuation and share repurchases. Berkshire Hathaway Energy. Berkshire wasn't the only entity that repurchased its shares in 2019. Little press had been given to Berkshire Hathaway Energy's, BHE's, repurchases of its shares. This despite Buffett at times mentioning the modest increases in Berkshire Hathaway's majority ownership of the utility. When Berkshire first purchased BHE in 1999, its ownership amounted to 76%. Additional purchases of equity to assist BHE in making certain acquisitions and purchases of stock from BHE, non-controlling shareholders, raised its interest to almost 91% at year-end 2019. Its more recent purchases shed light on the value of the company, see Table 9.21, and backed up Buffett's assertion that BHE was worth far more than its carrying value. Regulated capital-intensive businesses. The higher implied valuation for BHE reflected its financial results. Pre-tax earnings grew 6% to $2.6 billion. Another year of tax credits from wind power generation again caused after-tax income to exceed pre-tax income, which grew 7.5% to $3.1 billion. Beginning in 2019, Berkshire began presenting a table in the footnotes to do the annual report detailing after-tax earnings of the utility businesses, reflecting how the energy businesses are managed and evaluated. Mid-American Energy, the Iowa and Illinois utility, had significant wind-generating capacity and experienced strong demand from industrial customers, even in the face of lower demand from residential customers because of weather. Its after-tax earnings grew 12% to $781 million and benefited from higher tax credits. NV Energy experienced a smaller increase in after-tax earnings, up 15% to $365 million. Higher volumes and rates led to earnings of $422 million for the gas pipelines, up 9%, and Northern Power Grid increased earnings 7% to $256 million. Pacific Corp's earnings fell 3% to $773 million. The real estate brokerage division increased after-tax earnings by 10% to $160 million. This was largely driven by its mortgage business and acquisitions. No explanation was given for the lower volume and margin at existing brokerage offices, but a shortage of homes nationwide could have played a part. Volumes declined 4.5% to 10.2 million units at BNSF. Revenues declined at a slower 1.4% to $23.5 billion because of an increase in average prices. Weather, including flooding, played a part. So too did competing forms of freight transport and international trade policies. Consumer products, agricultural products, and coal volumes fell by 5%. Industrial products fell 3%. Operating expenses benefited from cost controls and the curtailment of a retirement plan, which more than offset higher weather-related costs. These were in addition to lower expenses due to lower volume. Pre-tax earnings grew 5.6% to $7.3 billion from a combination of lower operating expenses and higher average pricing. Insurance. The insurance group underwrote to a second consecutive year of profits. A $417 million pre-tax underwriting profit in 2019 brought the record to $27.5 billion in total profit in 16 out of 17 years. The loan loss year in 2017 was caused by numerous catastrophe losses. Float grew 5.5% to $129.4 billion at year-end. Geico. Geico was the star of the show most years, and in 2019 it delivered again. Its value proposition led to over 1 million new auto policies in force, which represented unit growth of 6.4%. Geico ended the year with a 13.6% market share, up from 13%. Lower average pricing offset some of the strong growth in policies in force as the company fine-tuned its pricing to balance profitability while passing savings on to the customers. Higher loss severity drove losses up 2.5 percentage points to 81.3% of premiums earned. Severities increased in the middle single digits for property and collision damage and in the high single digits for bodily injury. The footnotes to the financial statements do not detail why bodily injury severity increased at such a high rate. Claims frequencies increased low single digits. Earned premiums grew 6.6% to $35.6 billion, and a 95.8% combined ratio delivered a pre-tax underwriting gain of $1.5 billion. Berkshire Hathaway Primary Group. The Berkshire Hathaway Primary Group reported a strong 15% growth in premiums earned, but tax underwriting profits fell 43%, $383 million. Combined ratio of 95.8%. Because of higher losses and lower, but still positive, favorable loss development. It is important to remember that insurance profitability comes from two components, underwriting and investing. Berkshire's insurance managers focused solely on underwriting, while the investing component was handled centrally in Omaha. A decline in underwriting profit is not as good as an increase, but it is still a satisfactory result because it means a negative cost of float. Additionally, the strong growth in premiums very likely led to an increase in float. The value of Berkshire's insurers come from the low-cost capital they provide. That capital can come in the form of float and profits. A very rare event occurred in 2019 that affected the results of the primary group. In October, Berkshire sold its 81% interest in Applied Underwriters. The company increasingly came into conflict with other Berkshire insurance units selling the same workers' compensation product. Berkshire sold the ownership interest back to one of its founders, Steve Menzies, and an investment firm. The $920 million price tag valued the company at $1.1 billion, about equal to annual premium volume. Berkshire purchased 85% of Applied Underwriters in 2006 for an estimated $290 million. Berkshire Hathaway Reinsurance Group. Premiums earned in the reinsurance unit increased 2.5% to $16.3 billion. Pre-tax underwriting losses widened from $1.1 billion in 2018 to $1.5 billion in 2019. Individual segment results reflected the basic design of the reinsurance units. Losses widened in retroactive reinsurance and periodic payment annuity, two lines tied to long-duration float with recurring accounting charges, and profits increased property casualty and life health compared to the prior year. Property casualty delivered underwriting profits of $16 million from a loss of $207 million on earned premiums, up 11% to $9.9 billion. Volume included $1.7 billion from the 20% quota share agreement with Insurance Australia Group. The barely break-even profit was a good result considering it was after $1 billion in losses from catastrophe events, typhoons Faxia and Hagibis, and wildfires in California and Australia. Favorable loss development added $295 million to the bottom line. The life health unit recorded underwriting profits of $326 million, up 51% from the year before. A contract amendment with an undisclosed major reinsurer was responsible for a one-time pre-tax gain of $163 million that swelled the bottom line in 2019 but reduced premium volumes. A single $228 million contract covering health insurance risks replaced some of the volume but still left earned premiums down 9% for the year to $4.9 billion. Periodic payment annuity premiums declined 25% to $863 million, and the loss widened from $340 million in 2018 to $549 million in 2019. Berkshire took pains to note that this business is almost entirely price dependent. Berkshire stood ready to write large amounts of business when other market participants stepped away for whatever reason and pricing firmed up. Like the retroactive reinsurance business, unpaid losses in periodic payment annuities were large. At year-end 2019, the discounted value of the liabilities at a 4.1% rate was $13.5 billion. Premiums written and earned in retroactive reinsurance were the result of a few contracts booked during the year and amounted to $684 million, up from $517 million. Such low volume was typical of the business, which came in spurts. Results were penalized by $125 million of unfavorable loss development, net of changes to unamortized deferred charges, compared to favorable development of $185 million in 2018. Deferred charge amortization related to contracts booked in prior years caused most of the reported loss of $1.3 billion. Unamortized deferred charges, the asset placed on the books at inception of the contract comprising the difference between the premium received and the estimated ultimate losses, related to retroactive reinsurance amounted to $13.7 billion at year-end. That sum would eventually work its way through the income statement along with any future loss development. The 2017 AIG contract alone was responsible for $646 million of deferred charge amortization in 2019 that directly flowed to the bottom line as a loss. Berkshire estimated that total deferred charge amortization would be $1.2 billion in 2020, an amount that would produce an underwriting loss absent any changes to reserves. Cash flows often illustrate economics better than accounting. See Table 9.23. In 2019, Berkshire's income statement said it lost $1.3 billion on retroactive reinsurance, but it paid just $909 million to claimants under these policies. It also brought in $624 million of cash from premiums. That means just $225 million went out the door, net, costing less than 1% of the average float. The results remain favorable even assuming no written earned premium activity. Berkshire would eventually have to pay out the full amount of its incurred losses, a whopping $42.4 billion, assuming it reserved appropriately. In the meantime, it had a huge amount of float to invest for its benefit. The ultimate economic result hinged on the timing and amount of future payments. Manufacturing, service, and retailing. The headline result of a 0.5% increase in pre-tax earnings from the MSR businesses masked a wide range of individual business results. Results from the 6 major subsegments ranged from an increase of 17% to a decline of 8%. Industrial products, revenues of $30.6 billion, flat. Pre-tax earnings fell 3% to $5.6 billion. Results lagged largely due to weakness at Lubrizol and IMC. A fire in one of Lubrizol's plants in France caused its pre-tax earnings to fall 15%, including a 50% drop in the fourth quarter, negatively impacting the segment. One of Lubrizol's major insurance companies was Berkshire Hathaway, an irony Buffett noted in his chairman's letter. In Matthew 6:3, the Bible instructs us to let not the left hand know what the right hand doeth. Your chairman has clearly behaved as ordered. That was perhaps a reflection of the breadth of Berkshire's operations and an illustration of how risk can combine within an entity. IMC's pre-tax earnings fell 13% from a combination of foreign currency effects, sales of lower margin products, and impacts from an ongoing trade war between the U.S. and China. Precision Cast Parts increased earnings 5%, although a part of the favorable comparison had to do with one-time gains in 2019 and one-time losses in 2018. The company did not expect the suspension of Boeing 737 MAX aircraft, a new plane that was beset with major issues, to have a major impact on its businesses. Marmon's results were flat when considering the effects of the new acquisition. On October 31st, it acquired 60% of Colson Medical Companies and agreed to purchase the remainder over time. Colson was the second act for Marmon founder Robert Pritzker. Pritzker founded Colson to acquire companies in the orthopedic surgery field after he left Marmon. Building products, revenues of $20.3 billion, up 8.8%. Pre-tax earnings in building products increased 13% to $2.6 billion. Clayton Homes again led the strong results. Its pre-tax earnings swelled 20% to $1.1 billion from higher sales of manufactured and site-built homes. Strength in home sales also translated into strong 12% higher earnings in its financing unit. The other building products companies within the segment increased pre-tax earnings by 8% as a result of higher selling prices and lower costs. Earnings would have increased more if not for the facility closure costs. Consumer products businesses, revenues of $11.8 billion, down 5.7%. Pre-tax earnings increased 4% to $1.3 billion. Duracell benefited from a new product line. The apparel and footwear businesses experienced headwinds from private label products. Brooks, a running shoe company, increased revenues 3.5% despite problems with a distribution center. Cost controls improved pre-tax margins for the consumer products businesses by a full percentage point to 10.6%. These factors more than offset continued weakness at Forest River, where revenues declined 13% on lower unit sales. Berkshire provided no information on its earnings. Service businesses. Revenues of $13.5 billion, up 1.2%. Pre-tax earnings declined 8% to $1.7 billion. TTI and flight safety caused the decline in pre-tax earnings in this sector. TTI came off a strong year in 2018 and was hurt by softer demand for its products, lower margins, and higher expenses from acquired businesses. Currency-related losses and tariffs compounded the pain. The loss of a government contract hurt earnings at flight safety. Higher revenues and margins increased net jet earnings. Charter brokerage divested a low-margin business during the year, but the impact on the bottom line wasn't disclosed. Retailing. Revenues of $16 billion, up 2.5%. A small 2% increase in pre-tax earnings to $874 million hid wide differences in fortunes. Strong pre-owned car sales and financing activities led to a 23% increase in earnings from Berkshire Hathaway Automotive. That was the only good news in the segment. Pre-tax earnings at the home furnishing companies, representing 20% of overall segment revenues, fell 15% on a 1.3% decline in revenues and higher costs. The remainder of the segment, which included such companies as the jewelry retailers and See's Candies, fell 8%. McLane. Revenues of $15.5 billion, up 0.9%. McLane's earnings rebounded strongly as its margins clawed back some ground lost in prior years. Pre-tax earnings grew 17% to $288 million. The business remained very competitive with no apparent end in sight. The comparison of McLane's earnings benefited from an extra week of results since its business operated on a 52-53-week fiscal year. Investments. Berkshire's investment portfolio swelled along with strong double-digit advances in the overall stock market. The S&P 500 rose 31.5%. Berkshire sold $14 billion worth of equities and purchased $18.6 billion for a net purchase of $4.6 billion. But a privately negotiated $10 billion preferred stock investment was classified as an equity security. Adjusting the information presented on the statement of cash flows downward to reflect the preferred investment meant Berkshire sold a net $5.4 billion in other equities. Sales included 4.4 million shares of Apple, 3 million shares of Bank of New York Mellon, 104 million shares of Wells Fargo, and its entire stake in USG Corp. Berkshire added to its holdings of Bank of America, JP Morgan Chase, and US Bank Corp. Buffett used an obscure book from 1924 to illustrate the power of retained earnings. In Common Stocks as Long-Term Investments, Edgar Lawrence Smith illustrated how companies grow by retaining earnings. In the case of Berkshire's 10 largest holdings, their retained earnings were more than double dividends. Buffett reminded readers that the only dividend showed up in Berkshire's financials each year. He also pointed out that some of Berkshire's investees used their retained earnings to repurchase stock, an act that enlarges Berkshire's share of the company's future earnings. Looking at the table Buffett provided, we can see that Berkshire's ownership in American Express increased from 17.9% in 2018 to 18.7% in 2019 without Berkshire buying a single share. Even more amazing was Apple. Berkshire's ownership increased from 5.4% in 2018 to 5.7% in 2019 despite the sale of some shares. He also used a more recognizable historic reference to make his point. It was no secret that mind-boggling wealth had earlier been amassed by such titans as Carnegie, Rockefeller, and Ford, all of whom had retained a huge portion of their earnings to fund growth and provide even greater profits. These titans, like him, were among the most successful of their time. The sale of shares in USG Corporation amounted to a relatively small dollar amount, under $2 billion. But it represented one of the rare occasions that Buffett both disagreed with and voted against proposed directors of a company. Berkshire owned 31% of USG Corp., a maker of gypsum wallboard, sheetrock, that it purchased in 2006. The business struggled over the ensuing decade. In 2018, Koff, a competitor, offered a buyout that Berkshire thought attractive, but USG's management team and certain board members opposed the deal. Buffett thought the deal was good value for shareholders and publicly criticized the directors, saying they did not represent our interests. After voting against the directors, the deal with Koff was ultimately approved, and the company was sold midway through 2019. In August, Berkshire again acted as a creditor in a privately negotiated preferred stock deal. Unlike prior deals, it was not the result of a general pullback in available credit. Instead, the $10 billion deal assisted Occidental Petroleum with its acquisition of competitor Anadarko. The deal was almost immediately criticized, but not for Berkshire's involvement. The criticism fell on Occidental's management for providing an astute investor with a sweetheart deal to finance an overpriced acquisition. Leading the criticism was legendary investor Carl Icahn. Buffett received praise for his shrewd business deal that included an 8% yield for Berkshire's preferred stock, a benefit worth $800 million a year. Berkshire also got warrants to purchase 80 million shares at $62.50 per share and 105% liquidation preference. The deal also included a provision that Occidental could pay its preferred stock dividend in shares. Berkshire's cash continued to build amid the dearth of opportunities to allocate large amounts of capital amid sky-high valuations for public and private businesses. Yet it continued its practice of borrowing money when favorable terms were available. For the first time, Berkshire issued Japanese yen-denominated bonds, raising $4 billion to bolster its war chest. Its $128 billion of cash at year-end 2019 was criticized by those wanting the Oracle of Omaha to return some of it to shareholders. But Warren Buffett's 55-year seat at the helm of Berkshire Hathaway gave him confidence that an intelligent use of capital would present itself sooner or later. Berkshire was prepared for anything. Half-decade in review. In just 5 years, Berkshire Hathaway generated more capital than the entirety of the prior decade. See Table 9.25. Operations produced about half of it. High prices for business created headwinds that stemmed the flow of acquisitions. Those headwinds broke the trend of increasing contributions from wholly owned operating subsidiaries. That holds true even if one-time gain from the tax law change in 2017 is removed. Making that adjustment, operations produced 61% of the increase in net worth during that period. Strong gains in the stock market led to significant realized and unrealized gains for Berkshire's portfolio, but hurt Berkshire's relative stock performance. It also made it more difficult to find attractive places to put Berkshire's large and growing cash pile. Figure 9.3 breaks down the sources of Berkshire's after-tax operating income for the half-decade. Taken together, BNSF and the utility businesses generated over a third of after-tax operating earnings in the period. Berkshire's 14-year record of underwriting profits came to an end in 2017 on the heels of 6 catastrophes. But it generated a profit in each of the other 4 years, which meant Berkshire's cost of float was negative. Better still, average float grew from $81 billion to $126 billion. A large part of the growth in float came from the retroactive reinsurance contract with AIG in 2017. The $10.2 billion premium Berkshire received was the largest in history and solidified Berkshire's reputation as one of, if not the, go-to reinsurer in the world. Berkshire found reasonable opportunity to allocate capital during the 5 years under review. Acquisitions soaked up the most capital. 1. $4.2 billion. Van Tool Automotive Group joined the Conglamerate in 2015 and changed its name to Berkshire Hathaway Automotive Group. Such renaming reflected the growing power and name recognition of the Berkshire Hathaway brand. 2. $33 billion. Precision Castparts was the only elephant or large acquisition that soaked up cash in 2016. 3. $2.8 billion. Pilot Flying J put one foot in the door with Berkshire's initial 38.6% stake in 2017. The deal called for Berkshire to increase its stake to 80% in 2023. 4. $2.5 billion. Medical Liability Mutual Insurance Company converted to a stock company to put itself up for sale to Berkshire in 2018. 5. $7.9 billion. Berkshire and its subsidiaries completed numerous bolt-on acquisitions. Another cash-rich split-off transaction brought Duracell into the Berkshire fold. The partnership with 3G Capital found opportunity to invest another $5 billion in equity to acquire Kraft Foods Group. Berkshire also invested an additional $32 billion in growth capital spending during the half-decade. The bulk of that capital went into BNSF and Berkshire Hathaway Energy. Berkshire also allocated additional capital to marketable securities. It continued its practice of concentrating its investments by buying $35 billion of Apple stock that was worth more than double the purchase price by year-end 2019. Berkshire also invested $10 billion in a privately negotiated preferred stock deal with Occidental Petroleum. Two statistics from Berkshire's investment portfolio are too irresistible to pass over. Berkshire's share of 2019 earnings from American Express and Coca-Cola amounted to an exceptionally large proportion of their cost basis. Its share of American Express's 2019 earnings was $1.26 billion, almost equal to its $1.29 billion cost basis. Its share of Coke's earnings amounted to nearly two-thirds of the purchase price. These statistics reflected the long holding periods and Berkshire's view of the investments as close to permanent. Both holdings were proof of the value of long holding periods. Deferred taxes on the significant unrealized gains allowed significantly more dividends than if the investments had been sold and reinvested elsewhere or back into the same company. Berkshire's stock price continued to track the underlying progress being made in the business. Shares advanced past the $300,000 mark for the first time in late 2017, and Berkshire's market capitalization was in the $550 billion range by the end of 2019. While the price-to-book value during this time was steady, evidence pointed to the conglomerate being undervalued. Berkshire did its best to communicate this to shareholders and brought about a more rational valuation. When this failed, Berkshire repurchased undervalued shares to the benefit of continuing shareholders. Figures 9.5 and 9.6 present 10 years of data for context. Lessons 2015 to 2019. 1. It is okay to admit you were wrong about an investment thesis. Acting to correct a wrong move is difficult but important. Buffett initially invested in IBM stock, thinking the company had a stronger competitive advantage. A few years later, he realized he was wrong and sold Berkshire's investment in the company. Buffett also overcame the human tendency toward maintaining a commitment when you have publicly stated your opinion. Berkshire went on to purchase a large stake in Apple, which subsequently doubled in value. 2. Don't let cash burn a hole in your pocket. Berkshire's cash continued to build despite billions spent on growth capex and acquisitions. Buffett resisted pressure to invest cash in a market unsuitable for a major investment and waited patiently for opportunity. 3. Compounding is a powerful force. In just 5 years, Berkshire generated more capital than the previous decade in over 40% of the entire total since 1965. Assessing future capital allocation becomes that much more important for a company that retains a significant portion of its earnings. 4. Incentives are superpowers and can have unintended consequences. The scandal that enveloped Wells Fargo related to opening fraudulent new accounts was unintentional but unfortunately a result of the design in its incentive systems. Berkshire's businesses are managed in a very decentralized manner, but there are protections in place. For example, Berkshire maintains a hotline and a way to send direct and anonymous written communications to headquarters. When a problem arises, the best thing to do is act quickly. Problems usually do not get better with time. 5. Focus on the right variables. Buffett said Berkshire's 2016 acquisition of Precision Castparts would undoubtedly come with some problems. He focused his thinking on the company's long-term economic position. Similarly, Buffett suggested an analyst would do better viewing Berkshire as a few collections of businesses rather than try to gain insight into each of Berkshire's many operating subsidiaries. 6. Accounting is a language and only the starting point. The 2018 accounting change that required unrealized gains to flow through the income statement caused Berkshire's bottom line to become analytically useless. Investors must understand the accounting rules as written and then use the financials to determine economic reality. 7. Productivity creates wealth for all citizens. The way a civilization advances its well-being is by producing more goods and services per individual. The process is disruptive in the short term as businesses figure out ways to do the same work with fewer workers. But in the long term, productivity gains help all citizens. How to distribute those productivity gains and the best way to mitigate the impact on individuals affected are important political questions. Chapter 17. World's Greatest Conglomerate. The many pages written on Berkshire Hathaway thus far give away the ending. Berkshire Hathaway is the world's greatest conglomerate and will remain the standard by which all future conglomerates are measured. By any measure, Berkshire Hathaway has secured its spot in the pantheon of successful modern businesses. While Warren Buffett runs a conglomerate, he in some ways has more in common with the industrial greats than he does the historical conglomerate executives. Andrew Carnegie, John D. Rockefeller Sr., Henry Ford, and Cornelius Vanderbilt all built huge business empires and wealth within a particular industry that earned them lots of ink in history books and significant name recognition. These men had an outsized impact on the Industrial Revolution, directly impacting steel production, mass-market car production, and the expansion of the railroads, depending on the individual. Conversely, most people haven't heard of Charles Bluedorn or Royal Little, unless they are students of history or business. Yet those men were integral parts of the history of the conglomerate as a business structure. Buffett, too, is a household name. Why? Because the success of Berkshire Hathaway earned him that reputation. Berkshire has stood the test of time as the standard bearer for the best of business, investing, and value creation. This is Buffett's legacy, a formula for long-term sustainable success that maximizes human potential. Like the switch to mass production automobiles, Ford, and the revolution of steel production, Carnegie, Buffett's innovative business approach stands the test of time. The conglomerate craze of the 1960s saw the rapid growth of conglomerates, including Textron, founded by Royal Little, Litton Industries, Lingo Temco Vought, and Gulf and Western, founded by Charles Bluedorn. Their strategies included artificially inflating share prices and acquiring companies by issuing shares and borrowing heavily. Those companies made the usual lists and headlines for their successes and failures, but they weren't sustainable. The results of these strategies was often a whole that was eventually worth less than the sum of its parts, a conglomerate discount, and a company producing accounting fictions rather than real results. This often led to the companies being broken up, sold off, or both. Berkshire achieved its position as the world's best conglomerate through a combination of business mastery and a bit of luck. The luck component is easy to observe. Warren Buffett and Charlie Munger were born at the right time to fill their sails and that of their conglomerate with incredible tailwinds. They were lucky to begin solidifying Berkshire's economic position when market inefficiencies were much more prevalent. Taking advantage of these inefficiencies paid handsomely. Second, the dawn of Berkshire Hathaway as a modern conglomerate powerhouse of today began at the end of the conglomerate craze of the 1960s. Buffett and Munger had the good fortune to observe what worked and what didn't. Critically, their minds wouldn't let go until they figured out why. These lessons were then applied to their canvas at Berkshire to create a masterpiece. Business mastery is the only term sufficient to convey the decades of study and application necessary to forge one of the most respected companies in the world from a dying textile company. Yet that is what Warren Buffett and Charlie Munger did, along with much help and a few mistakes. We can observe this business mastery in the way they maximized every element of business while allowing managers to independently run their businesses. Many of Buffett and Munger's techniques have since been copied by modern operators. As they say, imitation is the sincerest form of flattery. Capital allocation. Berkshire's philosophy. Treat subsidiaries as investments, providing for operational independence. Use the cash flow from them, along with capital gains from investments, for organic expansion. Early conglomerates. Acquire diverse businesses to achieve synergies or take a hands-on approach to managing them post-acquisition. A successful business of any kind is the result of rational capital allocation over time. Berkshire Hathaway grew out of the philosophy Warren Buffett internalized from Benjamin Gray early in his career. A bedrock principle was that stocks represented ownership in a business. This framework gave Buffett an important vantage point to survey the economic landscape. No business or industry would be out of reach if Buffett could understand the business and its economics. Berkshire could allocate capital to wholly owned businesses or buy pieces of businesses in the stock market, depending on which was more attractive at the time. Crucially, the ownership philosophy set the stage for decentralization. Buffett and Munger's early years were spent buying stocks as part of a portfolio. Berkshire was constructed using what might be termed a portfolio approach. It became a collection of businesses and not one large business with operational oversight of multiple business activities. This is an important distinction. Berkshire's capital allocators were accustomed to acting as owners, not managers. If a hands-off approach worked for passive investments in stock, why should the approach change much upon gaining control? Berkshire could view ownership of a subsidiary as equivalent to a stock in a portfolio and let it operate independently. The only difference between the two approaches was that Berkshire had a much higher threshold for divesting an operating subsidiary. The advantages of buying good businesses arose organically. For example, Berkshire purchased the Illinois National Bank and Trust of Rockford because it was a good business. Once part of Berkshire, the bank's tax bill was reduced by losses arising from its new sister companies. The acquisition was not made because of the tax savings, but a consolidated tax bill was one advantage. Another advantage was the ability to move capital between subsidiaries without tax consequences. Two stocks owned within a portfolio might have one common owner, but cannot share resources without tax implications. Once owned through a conglomerate, this barrier is removed. The conglomerate structure also provided an important relief valve to subsidiaries. Berkshire's subsidiaries could grow to their optimal size and send surplus cash flow to headquarters. Buffett and Munger were in the best position to allocate capital to the highest use once it could not be used for expansion at the subsidiary level. This afforded Berkshire the opportunity to buy businesses with strong competitive positions but little growth potential. See's is perhaps the best example. The capital that remained within See's would earn a great return, and the cash it generated could earn a great return too, just not in See's. Economics over accounting. Berkshire's philosophy. Act based on economics over accounting, but present business results that are accurate, even if the economics are worse than the accounting. Some early conglomerates. Use financial engineering to artificially increase earnings per share. From Buffett's earliest communications with Berkshire shareholders, he stressed he cared more about economics than accounting. Berkshire's 1965 chairman's letter highlighted that its reported earnings were significantly more than reality. That statement was made at a time when some other companies, but certainly other conglomerates, did everything in their power to make earnings look better. Buffett and Munger saw the spectacular rise and fall of the 1960s conglomerate leaders that were made possible by financial engineering designed to increase earnings per share. Their fatal flaw was reliance on accounting to paint a picture of robust health and growth that wasn't fully supported by the businesses they purchased with expensive shares. In short, their strategy wasn't sustainable. Berkshire let others make business decisions based on accounting while it used opportunity cost as a guide. When more earnings could be purchased through the stock market, which was frequently the case, Berkshire purchased those. It didn't matter that only a part of the earnings accruing to its ownership interest was reflected in Berkshire's financials. That philosophy extended to its acquisition of entire businesses. Accounting consequences do not influence our operating or capital allocation decisions. When acquisition costs are similar, we much prefer to purchase $2 of earnings that is not reportable by us under standard accounting principles than to purchase $1 of earnings that is reportable. Berkshire's entry into the reinsurance field was aided by the fact that Berkshire cared more about the long-term economics of insurance than short-term accounting implications. It wrote huge retroactive reinsurance contracts and other time value of money policies that penalized earnings immediately but were economically sound transactions long-term. Separate management of assets and liabilities. Berkshire's philosophy. Opportunistic borrowing even when capital is not needed and using low-cost insurance float to fund growth. Other companies. Borrowed heavily and focusing on short-term returns over long-term gains. Berkshire focused on maximizing the value of each side of its balance sheet, largely independent of the other. Decisions on what assets to buy were not predicated on available financing because ample resources were usually on hand. Conversely, availability of cheap financing did not by itself lead to asset purchases. The assets, whether whole companies or pieces of companies via stocks, had to stand on their own. Berkshire bought businesses with an all-equity mindset. It viewed acquisitions as entirely financed by equity, even if some debt was used or assumed. Attention was on the economics of the underlying business and not what financial returns could be had by enhancing equity returns with debt. This properly focused attention on better businesses. Insurance float is undoubtedly a major reason for Berkshire's rapid growth. It provided Berkshire with low-cost way to finance the asset side of the balance sheet. Buffett recognized that float was only valuable if it could be attained at a low cost, and he used the government's own borrowing rate as a benchmark. In most years, Berkshire could finance at a lower cost than the U.S. government. Beginning in the 1990s, it realized a consistent profit in underwriting. Berkshire intentionally structured its insurance liabilities to ensure near permanence of capital. The primary insurers, including Geico, were in short-tail lines that could consistently generate float so long as they maintained their cost and underwriting discipline. The reinsurance contracts stretched out over years and contained limits on maximum payouts. Underwriting discipline pervaded Berkshire's insurance underwriting culture. It only wrote business that made sense. Structured this way, Berkshire could never be called on to remit large amounts of capital at one time. If Berkshire's float did begin to decline, it would be very gradual and could be offset by underwriting profits. From an economic standpoint, Berkshire had structured its float to act very much like equity. Some other insurance companies recognized the value in float but did not properly calculate its cost. These companies would push down premiums to be competitive. By exchanging long-term profits for short-term gains, their actions affected the entire industry. Berkshire maintained its discipline in the face of ebbs and flows of capital into the industry and only wrote business it thought had a reasonable expectation of profit. Its conservatism effectively allowed it to capture business from weaker pricing environments by writing more advantageously priced reinsurance deals later to shore up the balance sheet of competitors. Modern-day conglomerates have also used insurance as fuel for their growth too. Companies like Markel, Allegheny, and Canada-based Fairfax Financial, which are just a fraction of the size of Berkshire, have similar structures to Berkshire. All three employ largely the same strategy of discipline of underwriting insurance and reinsurance, and opportunistic acquisition of well-understood and profitable non-insurance operating businesses and marketable securities. The only disadvantage these modern conglomerates have is starting later when asset prices were more expensive than Berkshire's early purchases. Other, even smaller mini-conglomerates have been formed to duplicate Berkshire's success in insurance in the modern era. Discussion of Buffett's management of Berkshire's liabilities is often limited to insurance float. Float was a huge factor in Berkshire's success, but not the only one. On several occasions, Berkshire borrowed money with no clear immediate use for it. This was because the optimal time for financing did not necessarily coincide with the optimal time to buy assets. Even as late as 2019, Berkshire borrowed low-cost funds in euros and yen at a time when it was flush with cash. Berkshire's subsidiaries benefited from lower borrowing costs by being part of a conglomerate. In some cases, Berkshire borrowed the money directly, then relent it to the subsidiary that needed the capital. An important aspect to financing arrangements like this was the subsidiaries were charged a spread that amounted to a fee for using Berkshire's pristine credit and corporate guarantee. This reduced the distorting effects that a heavily subsidized interest rate might have on the subsidiary. Even BNSF and Berkshire Hathaway Energy, whose debt Berkshire does not explicitly guarantee, benefit to some degree by having a well-capitalized parent. Deferred taxes are also a misunderstood liability that provided Berkshire with additional capital. While these arose from the primary objectives of holding investments for a long time, deferring capital gains taxes, and capital spending to build out future earnings, deferring income taxes, they nevertheless provided Berkshire with real economic benefits. Risk management. Berkshire's philosophy. Take a long-term approach to business acquisition and investing that incorporates wide-ranging possibilities and probabilities. Other companies. Place short-term profits ahead of considerations of long-term risks and fail to account for risk aggregation and correlation. Berkshire benefited from astute risk management. By using insurance float to fund assets, it could generate a higher return on equity while taking less risk. It consistently operated with far more capital than insurance regulators required. This conservatism allowed Berkshire to invest in better assets like businesses, while its peers were restricted to lower-yielding bonds. When it gave up in additional underwriting premiums, it gained in the certainty attached to equity ownership compared to cash-dominated investments over longer periods of time. Berkshire's stable of cash-generating non-insurance businesses then backstopped the insurance businesses. This made them even stronger. The unsurpassed capital strength of the insurance company balance sheets brought reinsurance transactions into the billions that no other insurer could handle. It also allowed Berkshire to accept higher expected returns in exchange for bearing large but infrequent losses. Each individual risk mitigation factor looked unduly conservative on its own. Taken together, they provided Berkshire with valuable advantages. Berkshire gained from judicious risk management in other ways. It was willing to accept huge risk for the right premiums in its insurance operations and make concentrated investments in marketable securities. When it came to Berkshire's cash, however, nothing but U.S. Treasuries would do. Buffett only wished to make investments with certain payouts over long periods of time. In the short run, anything could happen. The September 11th terrorist attacks and the Great Recession, when markets froze, proved him right. Buffett's awareness of risk also saved Berkshire money by avoiding unnecessary costs. Taking the very long-term view, Buffett knew the cost of hedging over time resulted in unnecessary costs. When he was asked whether BNSF had insurance to cover large accidents, Buffett explained that Berkshire was basically self-insured. Why would Berkshire pay another insurer to cover the same type of risk as insurers would be willing to write itself? Another nuanced risk Berkshire successfully managed was trust. Berkshire understood there were risks related to its policy of extreme autonomy. A delicate balance existed between maximizing human potential, and by extension business potential, by being hands-off, all the while maintaining adequate oversight. Berkshire took the position that it was better to overtrust and incur infrequent but public embarrassment than impose strict controls that were a net negative. It continually reinforced the message that it cared for Berkshire's reputation first and foremost. Berkshire successfully managed risk in the businesses it purchased, but it did make mistakes. Berkshire lost money on those investments, but its winning bets, by far, exceeded losers. The largest loss Berkshire suffered was Dexter's shoe. Yet the shares issued for Dexter represented just 2% of Berkshire's outstanding shares, an extremely good result for a loss considering the degree of concentration Berkshire employed elsewhere in businesses and investments. With insurance, Berkshire had not only more assets working in its favor, but safer assets too. The key was recognizing risk as a factor that could interrupt or destroy years of profitable compounding. These examples of Berkshire's risk management prove it gained by thinking carefully and long-term. Governance. Berkshire's philosophy. Let managers run businesses independently. Some early conglomerates. Meddled in subsidiary management and/or attempted to find synergies between subsidiaries. Another element of Berkshire's success was its governance practices. Its policy of delegation just shy of abdication rested on first acquiring businesses that could be managed autonomously. Buffett's skill at recognizing managers who cared more about their businesses than the money they would receive is often overlooked. By carefully selecting and then placing an enormous amount of trust in its managers, coupled with proper incentives, Berkshire created what amounted to ownership of individual subsidiaries. Managers were rewarded for the contributions they made to their specific businesses without any regard to Berkshire as a whole. Tying incentive compensation to factors like return on capital focused attention on the variables that would drive long-term business success for its owner, Berkshire. Berkshire's acquisitions came intact and without any illusion that managerial skill would further enhance their operations. The wholly owned businesses were managed like Berkshire's investments in marketable securities. No attempt was made to find or create synergies between operating units. Buffett kept his distance even when opportunities for cross-sales seemed obvious, because he knew meddling in the affairs of subsidiaries would ultimately cost Berkshire far more. No attempt was made to have Clayton Holmes buy from Shaw, Johns Manville, or Benjamin Moore, for example. When Van Tuyl joined Berkshire with an insurance arm of its own, its new owner did not require it to offer Geico insurance to buyers of its automobiles. The key was allowing operating managers to act independently and locally. Communication between operating units was inevitable and not discouraged, but it was organic and spontaneous, not forced. Berkshire left its managers alone to focus on what they did best. The hallmark of a Berkshire manager is a long tenure with no required retirement age. Think Mrs. B. Per-share thinking. Berkshire's philosophy. Rarely issue shares to keep business and per-share results in line. Some early conglomerates. Grew by issuing shares often coupled with copious amounts of debt. Berkshire Hathaway differentiated itself from the early conglomerates by a marked respect for the individual shareholder. This is not surprising given Buffett and Munger's pre-Berkshire days operating investment partnerships for close family and friends. They treated Berkshire Hathaway shareholders with this same respect as business partners. Berkshire's share count increased by just 44% during the first 50 years of Buffett's control. The largest increase came with the 1998 acquisition of General Re and increased Berkshire's shares outstanding by 22%. Berkshire's reluctance to issue shares meant the results from its underlying businesses translated into nearly equivalent results for its shareholders. Berkshire understood that issuing shares was the economic equivalent of selling pieces of its existing businesses, which it was hesitant to do since those businesses were of such high quality. The conglomerates of the 1960s that issued shares to grow, in some cases many multiples of their beginning share counts, were forced to turn inward after the go-go years ended. Many of the conglomerates were turned over to managers that could attempt to maximize the value of assets accumulated during the prior decade. In the worst cases, executives were fired and bankruptcies occurred. In the better cases, divestitures shrunk the business and raised needed cash. In some cases, companies grew, but the executives were not as mindful or respectful of shareholders as Berkshire was. Reputation, brand. Berkshire's philosophy. Acquire and invest in strong brands with good reputations that protected strong returns on capital and build a trustworthy brand in the insurance industry. Protect Berkshire's reputation first and foremost. Some early conglomerates chose companies with well-known names but whose economics were often average. Berkshire Hathaway recognized and maximized the power of reputation in brands. Buffett's appreciation for brands started before he took control of Berkshire. In the mid-1960s, he purchased a stake in American Express for his investment partnership, Buffett Partnership Limited. The credit card company became embroiled in the then-famous salad oil scandal that almost took down the company. Buffett recognized the power of the American Express brand and put almost one-third of the partnership's assets into its stock. When the brand prevailed, Buffett and his partners realized a significant profit. Charlie Munger also appreciated brands and pushed Buffett in the direction of buying better businesses at a fair price over fair businesses at a great price. The first was See's Candies, which had a powerful brand name on the West Coast. Berkshire went on to acquire other companies that had a strong brand awareness that translated into valuable economic benefits. Berkshire's investments in publicly traded companies such as Coca-Cola reflected this strategy. Many of these businesses, due to their reputation and operations, also had business moats protecting them. Berkshire grew the insurance group by leveraging its reputation. Insurance, Buffett said, is nothing more than a promise. The insured pays the premium, and the insurance company promises to provide coverage as agreed. Nowhere is that promise more important than reinsurance. As Berkshire built its reinsurance operations, its reputation became more and more valuable. Berkshire was capitalized far greater than industry minimums or even norms. Over time, this became a powerful advantage that attracted reinsurance business that very few competitors could even have a shot at bidding on. Berkshire became the gold standard of the insurance industry, a reputational and brand advantage that will only grow as Berkshire grows. Over time, Berkshire cultivated a reputation for fast and fair business dealings with sellers of businesses. Families that built businesses over generations turned to Berkshire as a permanent home for their businesses. They could realize all the advantages of selling, such as liquidity, diversification, and estate planning, while maintaining what amounted to full operational control of the business if they so chose. In exchange for this operational control, the sellers accepted a slightly lower selling price than if they marketed the business more widely. Berkshire received a fair price and a turnkey operation that wouldn't require much from headquarters. Under the conglomerate swing, the family business would be spared meetings with bankers, analysts, and investors, and they would have access to almost unlimited capital for worthwhile projects. A classic win-win scenario. Berkshire's promise never to sell unless under exceedingly rare circumstances, and the way it treated its existing businesses created a powerful reputation and brand for the conglomerate. Tax advantages. Berkshire's philosophy. Use the conglomerate structure to move capital without tax consequences. Some early conglomerates. Let taxes drive business decisions or disregard the impact of taxes on long-term results. The conglomerate structure provided meaningful tax advantages. Berkshire could move capital between subsidiaries without tax consequences. Capital could be taken from a business like See's that had strong returns on capital but little reinvestment opportunity and moved to opportunities elsewhere at sister companies. Businesses not united by a corporate parent or smaller ownership stakes owned in a portfolio would not have this advantage. The conglomerate structure also allowed Berkshire Hathaway Energy to maximize the tax incentives available to utilities. These tax savings represented real value creation. While Berkshire took full advantage of the tax code, it did not let taxes drive the business. Some operators past and present have let taxes dictate business decisions, choosing companies to acquire based on the tax advantages they would bring. Short-term this could work, but businesses that are losing money are doing so for a reason, and there are often long-term consequences. Other factors. The factors discussed so far could be considered a blueprint to create a successful conglomerate. As was discussed at the beginning, Berkshire also benefited from a degree of luck, and this cannot be controlled. Other factors help too. Buffett and Munger did not have to worry about outside shareholders or a board of directors that would second-guess them. Buffett controlled enough of Berkshire's voting power for so long he could make the best long-term capital allocation decisions. Berkshire also treated shareholders as partners and cultivated like-minded manager partners that shared their vision and reinforced the strategy. Berkshire had one corporate office and one board of directors. The savings surely added up from the elimination of multiple boards of directors, proxy statements and annual reports, and other regulatory and compliance costs. Tenure at the company is another important factor. With a tenure closing in on 60 years, Berkshire benefited from the compounding of business knowledge over time as Buffett, Munger, and many other managers remained committed to the business well beyond a typical corporate retirement age. Berkshire even went so far as to minimize the cost of its own public company status. No corporate-level human resources, legal, or investor relations existed. Communications to shareholders consisted of the annual chairman's letter and annual meeting, in addition to 3 quarterly reports and the annual report, 10K. Berkshire shunned analysts and maximized the time as capital allocators could spend working on things that benefited the business directly. As a testament to the efficiency at Berkshire, it prepares its quarterly reports in-house and doesn't consolidate the financial statements of its many businesses monthly. Why Berkshire Hathaway is the world's greatest conglomerate. The factors above created a lollapalooza, to borrow a phrase from Charlie Munger. Its success stemmed from maximizing every aspect of business. Over a long period, Berkshire found the optimal finance structure, use of a permanent and low-cost source of capital, motivated and properly incentivized and managed teams, judicious risk management techniques, care for the individual shareholder, and a base of owners that supported the company's strategy. It would be foolish to state categorically that the record of Berkshire Hathaway will never be overtaken. However, considering the alignment of all the factors discussed, the probabilities are against it. Berkshire added an element to the conglomerate structure, long-term sustainability, that was missing from the early conglomerates, and it had the benefit of doing it first. Warren Buffett and Charlie Munger were driven by a desire to paint their own canvas and achieve business mastery. It's no surprise they did not succumb to the short-term strategies employed by the early conglomerators who sought short-term gains or a quick rise to fame. Berkshire Hathaway's record transcends business history to enter the full pantheon of human achievement. Berkshire today represents an ideal of business and human accomplishment, not just in financial terms, but in setting an example for taking the high road in all walks of life. Warren Buffett and Charlie Munger and their many associates have shown us how to conduct business in the very best way possible. Berkshire mastered its domain and left a complete record for anyone to see. Today, there are a host of smaller contemporary conglomerates and a legion of followers emulating and building on their work. That is proof enough that Berkshire, Buffett, and Munger mastered not only business, but the art conveying wisdom to future generations. Berkshire Hathaway is the world's greatest conglomerate because it was a good teacher, and that is perhaps the highest praise to bestow. Chapter 18. Afterward. Berkshire after Buffett. The question of Berkshire Hathaway after Warren Buffett has been asked since the beginning of his tenure running the company. It had more validity during the early years when a large part of the conglomerate was comprised of stocks which Buffett managed. Back then, the question wasn't age, but the proverbial bus. What would happen if Berkshire shareholders woke up one morning to find Buffett no longer able to run the company? No one can argue that Berkshire would have been quite different if Warren Buffett left the scene prior to, perhaps, the mid-2000s. As Warren Buffett instead entered his 10th decade of life as this book was being finalized, different questions faced Berkshire Hathaway and its shareholders. Buffett turned 90 years old in 2020. Biology guarantees Berkshire will one day be without the man synonymous with creating one of the world's most admired businesses. Buffett guaranteed the conglomerate had a bright future by hiring skilled investment managers, continually seeking companies with sound economics, and widely sharing his business principles. After all, as Buffett himself said, if a business requires a superstar to produce great results, the business itself cannot be deemed great. Management succession. Not much will change in the immediate period surrounding Buffett's departure from Berkshire. Management of the individual business units will continue unchanged. The question of who will take over Buffett's role has already been partially decided. Buffett's role as chairman, CEO, and chief investment officer will be split into 3 parts. 1. Non-executive chairman. Buffett has strongly suggested his son, Howard Buffett, be chosen for this role. His sole purpose will be to ensure that the culture of Berkshire remains intact. That includes serving as a safety valve of sorts in the remote chance that the next CEO is unfit for the job. 2. One or more investment managers. The addition of Todd Combs in 2010 and Ted Weschler in 2011 largely completed this step. 3. Chief Executive Officer. The addition of Greg Abel and Ajit Jain in 2018 as Vice Chairman, supervising non-insurance and insurance operations respectively, solidified the suspicions of outside observers that one of those two men would succeed Buffett. The background and skill set of Greg Abel suggests the board will choose him as CEO. The primary reason is his extensive experience with capital allocation. During his time running Berkshire Hathaway Energy and later as Vice Chairman overseeing non-insurance operations, Abel oversaw many acquisitions. He is also much more comfortable in the spotlight and about 10 years younger than Jain, which would give him a longer run at the helm. Jain, by contrast, is a brilliant handicapper, more comfortable evaluating insurance risks, though he is also one of the best executives in the world, having overseen acquisitions of his own. Capital allocation. Perhaps the single most important question regarding Berkshire is its future capital allocation. After all, Buffett acquired companies whose management he trusted to independently run operations and hired skilled managers, most importantly the insurance business, who increased float. The excess money made by these businesses and their leaders was then sent back to Berkshire for redeployment. The conglomerate is already one of the world's largest companies and consistently in the top 5 on the Fortune 500. Most observers agree with Buffett and Munger that Berkshire's size makes matching the results of the past impossible. How then should Berkshire proceed? Berkshire's earning power all but guarantees it will have enough cash to invest in worthwhile projects at the subsidiary level and ample cash to make opportunistic acquisitions. That means cash will need to be returned to shareholders. Here, Berkshire has two main options and a blended third. 1. Pay a dividend. This option is the most logical on its face as it immediately provides a relief valve. It is also something Berkshire avoided doing for years and with good reason, as dividends have drawbacks. Perhaps the biggest is imposing a uniform standard on all shareholders of the company. Some shareholders might prefer receiving their share of earnings in cash to pay for retirement, say. Others might be younger and in savings mode and therefore prefer the company reinvest their earnings without incurring unneeded taxes. But Berkshire's net profits continue to grow and have reached a level that will require returning capital to shareholders. Dividends may be the only option if repurchasing shares is unavailable. 2. Share repurchases. Returning capital to shareholders via repurchases makes the most sense from an economic standpoint. It allows the company to increase intrinsic value per share while reducing excess cash. Shareholders wishing to maintain or increase their ownership can hold their shares. Those wanting income can simply sell a portion of their shares to raise a desired amount of cash. Having the company in the market as a buyer means the price will be better, theoretically, than if it wasn't. The only drawback to share repurchases as the primary means of returning capital is that it is price dependent. The Berkshire Board of Directors will be limited to repurchases only during times of undervaluation. What happens when shares are fully valued? 3. Combination of regular and special dividends and share repurchases. The middle ground option would see Berkshire implement a small regular dividend that provided an automatic relief valve to drain excess cash off the books. This might be set equal to 25% of normalized annual operating earnings. Then, irregular special dividends could be declared to reduce excess cash when earnings cannot be fully utilized internally or for share repurchases. If a large acquisition materializes, Berkshire's management would have an easy lever to pull to rebuild its cash position. Should Berkshire be dismantled? Some commentators have argued that Berkshire should be partially or wholly dismantled in the post-Buffett era. The idea is that the sum of Berkshire's parts would be worth more as separate businesses than as one. The logic of this argument rests largely on market multiples. The analyst takes Berkshire's many businesses and compares the multiple of revenues, earnings, or book value the market is valuing other similar companies. The analyst then arrives at the conclusion that Berkshire's conglomerate structure is causing a conglomerate discount, where the whole is worth less than the sum of its parts. Ergo, dismantling the company would unlock value for shareholders. There are several flaws to the argument for dismantling Berkshire Hathaway. To summarize some of the points that have been discussed elsewhere in this book, Berkshire gains more from having its businesses under one roof. Here is why. 1. Tax efficiency. Capital can flow between operating units without taxation, and the utility subsidiaries can take full advantage of tax incentives because of Berkshire's consolidated tax bill. 2. Diversification. Berkshire can operate each business unit to its full potential because of the many businesses under its corporate umbrella. This also reduces the risk of the entire enterprise. The diverse collection of cash-generating businesses, combined with a conservatively financed balance sheet, additionally allows for lower borrowing costs. 3. Capital allocation. Diversification extends to Berkshire's opportunity set. There is value in having the ability to buy whole companies or invest in the stock market, buy bonds, or act as the merchant banker to facilitate an acquisition, all depending on relative availability and valuation. Separate companies would be restricted to reinvesting internally or be forced to pay the cash to shareholders, incurring taxes on dividends if the shareholder is taxable in the process. Many of Berkshire's businesses and investments have been a part of it for decades. Breaking up Berkshire would face a major hurdle in the form of taxes on top of the lost advantages just enumerated. It is possible Berkshire might be required to spin off or sell a subsidiary for anti-competitive reasons or choose to for other reasons. This could be done in a tax-efficient way, but a wholesale dismantling of its many businesses would face a large tax bill. A policy of spinning off subsidiaries could harm Berkshire's future in another way. One of its major advantages is a permanent home for family businesses. If Berkshire began selling off units to maximize their value, it would lose out on future value creation if sellers thought this trust would be broken. Perhaps the strongest argument for keeping Berkshire Hathaway whole is the problem of reinvestment. If broken up by selling off business units, Berkshire's shareholders will be trading productive assets, businesses, for an unproductive one, cash. Cash in hand, Berkshire shareholders would face the problem of what to do with their newfound liquid wealth. They could leave it in cash, spend it on current consumption, or reinvest it, likely at high prices, into other businesses. Buffett put it succinctly in his chairman's letter, "Truly good businesses are exceptionally hard to find. Selling any you are lucky enough to own makes no sense at all." A spin-off strategy where shareholders own the exact same businesses with value unlocked, i.e. higher valuation, would lose the connecting conglomerate structure and create the same reinvestment problem at the company or shareholder level too. It seems likely that present value would be diminished, even considering a hypothetical higher breakup value of the parts compared to the consolidated whole. The crux of the argument comes down to what constitutes value. Berkshire is built on the notion that value is independent of the market's appraisal of that value. The value of a company is the present value of all future cash flows. In short, the underlying cash flows of Berkshire's many subsidiaries would not change upon being separated into pieces. In fact, as separate businesses, they would incur additional costs for boards of directors, financial filing requirements, and financing costs, among other factors. This is to say nothing of the very real but often invisible cost of lost time to attend to various internal and investor-related meetings. Even setting these added costs aside, cash flow and therefore value would not increase post-breakup. The subsidiaries already take advantage of opportunities for organic investment and bolt-on acquisitions that come their way, and Berkshire is taking care of the reinvestment problem by allowing excess cash to be sent to headquarters. No additional value could come from the underlying businesses themselves, which means the argument for breaking up Berkshire is a chimera. Without question, Berkshire Hathaway's potential for incremental value creation compared to a broadly diversified list of companies will be minimal going forward. This is okay so long as some value can be achieved. After all, compounding even a small edge adds up over time. Berkshire's future value creation will likely come in the form of minimizing the downside to allow infrequent but meaningful advantages to accrue and accumulate to the benefit of ongoing shareholders. Value can be created by 1. Time arbitrage. Taking advantage of the short-term thinking that guides markets to properly evaluate and capture the long-term value of businesses, whether public or private. 2. Private market discount. Berkshire's reputation as a permanent home for businesses will continue if nurtured and protected. The small amount of value given up by sellers for this permanence will accrue to Berkshire shareholders. 3. Alternative sources of financing. Berkshire will be able to act as a lender of last resort to businesses that need lightning-fast access to capital. The so-called Buffett blessing of the past will be replaced by the Berkshire blessing. Berkshire's prudence in lending in one-off situations will make it sought after for companies wishing to telegraph to the market their staying power during crisis. 4. Opportunistic share repurchases. During times of market turmoil or when Berkshire becomes out of favor, it can repurchase undervalued shares to the benefit of continuing shareholders. Berkshire's operating structure and governance will not change much at all in the first decade following Buffett's death. This is because Buffett's estate will own a significant block of voting stock. These shares are all slated to go to charities, a process that will take time, perhaps upwards of a decade or more. During that time, Berkshire's board and management will have time to prove the system put in place by its modern founders can continue unabated. It will also allow Berkshire to double in size, assuming even a 7% compounding rate. Berkshire's equity will double in about 10 years. This will make it extremely hard for corporate raiders on Wall Street to attempt to break up the conglomerate. The ultimate fate of Berkshire Hathaway rests with its shareholders. As the owners of Berkshire's assets, shareholders hold the key to Berkshire's future governance and capital allocation. Shareholders have a duty and obligation to ensure the conglomerate holds true to its culture and values. This has always been true, but will become more important as Buffett, Munger, and the first generation of Berkshire's builders step down. This will happen during a period of transformation in ownership that sees some of Buffett's early partners and longtime Berkshire shareholders pass their ownership interests to the next generation. If this new generation of shareholders steward and safeguard the culture so carefully built and maintained by the first, it will allow Berkshire to thrive for the next 100 years. Berkshire will undoubtedly not look the same in 25, 50, or 100 years, but it's not inconceivable that it maintains a reputation for upholding proven and timeless ideals of business and investing. Berkshire's future after Warren Buffett has been studied extensively. In his book, Berkshire Beyond Buffett, The Enduring Value of Values, Lawrence A. Cunningham, a well-recognized Berkshire scholar, discusses the momentum the conglomerate already enjoys. That momentum is a result of the long history and cultivation of an enduring culture, now separable from the man who put it all in motion. Buffett was once asked how Berkshire would continue to find the types of deals conducted under his tenure after he is gone. "I like to think I'll be missed a little bit, but you won't notice it." The short answer to the question of Berkshire after Buffett is that the conglomerate will thrive without Warren Buffett. That is perhaps the highest praise one can give a man who took a blank canvas and turned it into one of the finest and most highly valued pieces of artwork the business world has ever seen.